is Emmanuel Ramoni-Rousseau. I'm the Director General at Market Operations here at the ECB. It's a real pleasure to welcome you to the 2025 ECB Money Markets Conference here in Frankfurt, but also to everyone joining us online. This year's conference is again fully booked, so it's nice to see so many of you. And comes at a pivotal moment for money markets and for monetary policy implementation. A special welcome to our distinguished speakers and panelists today, including senior central bankers from across the globe, leading academics, as well as market participants. Your diverse perspectives, combining theory and practice, are what makes this conference so unique. As central banks navigate the transition towards leaner balance sheets and reassess the optimal level of reserves, money markets are again in the spotlight. Across jurisdictions, operational frameworks are being redesigned and recalibrated, and these changes are a reminder of how essential smooth functioning of money markets is for transmitting monetary policy to the real economy. Over the next 2 days, our program will explore these themes across four academic sessions. Session 1 will focus on central bank operations, balance sheet, and the optimal supply of reserves. Session 2 will look at repo markets and the evolving role of collateral. Session 3 will explore the interplay between global funding markets and cross-border spillovers. Finally, Session 4 will touch on the growing influence of non-bank financial institutions. We will also hear keynote speeches from Isabel Schnabel, John Williams, and Jeremy Stein, who will make us the privilege of sharing with us their unique perspectives on monetary policy implementation and transmission via money markets. And last but not least, the conference will conclude tomorrow with the market panel, which I have the honor to chair. We will hear leading practitioners from the official sector, banks, asset managers, and hedge funds share their view on today's most pressing issues for money markets. This conference is designed as a platform for open and informed dialogue, bridging the worlds of policy, research, and markets. I encourage you to engage, question, and exchange during these 2 days, because this is how new ideas take shape and how we push the boundaries of our understanding. Before we start, some important housekeeping rules, So the full agenda and speaker list are on the conference webpage and also accessible via a QR code displayed in the lobby. Each session includes a presentation followed by a discussion and a Q&A. To the speakers here, please help us stay on schedule by keeping to the allocated time. A little bit on questions. So audience questions are not only welcome in this conference, but strongly encouraged, though we can only accept them in person. To kick off the Q&As, we have lined up some practitioners to ask the first question, but there will be ample time for spontaneous exchange afterwards. Coffee breaks take place in the foyer here, just outside the room. The first one at 10 minutes past 11. Lunch will be served at 10 minutes past 1. ECB staff in dark blue fleece sweaters, you can see them over there, will guide you to the venue. And please be back promptly as Jeremy Stein's keynote begins at 2:30 sharp. This afternoon at 3:30, we'll have an extended coffee break featuring a poster session, you see the posters, showcasing ECB analytical work on money markets. The authors will be there for you to walk you through their findings. So do take the opportunity to stop by, ask questions, and exchange ideas. The conference will close today at 6, followed by a networking reception, and for invited guests, a dinner starting at 7:15. It will restart tomorrow at 9. We look forward to 2 days of stimulating discussions and opportunities to learn, share, and connect across disciplines and institutions. And now, it's my great pleasure to hand over to Isabel Schnabel, member of the ECB Executive Board, for her opening remarks. Isabel.
Thank you very much, Iman, for your great introduction. And I would like to also take the chance to welcome all of you to this conference, which has turned, actually in a relatively short period of time, into one of our flagship events. And the fact that all of you are here today is a testament to that. So I would like to talk to you today about the new Eurosystem balance sheet. And the Eurosystem balance sheet is a mirror of the shocks that have hit the euro area over the years. It tells the story of crisis and recovery, of inflation and disinflation. And after reaching a peak in 2022, the size of our balance sheet has now been declining for 3 years. Over this period, our holdings of monetary policy-related assets have fallen by 45%, steadily reducing our financial market footprint. And I think it's fair to say that this process has been remarkably smooth. Banks' liquidity positions remain strong, and the 10-year GDP-weighted sovereign bond yield for the euro area stands almost exactly where it was when we started the gradual rundown of our monetary policy bond portfolios in March 2023. Although balance sheet normalization still has a long way to go, it is worth reflecting on what the Eurosystem balance sheet should look like in the future. And this is what I would like to do today. My remarks today reflect my own current thinking on the matter, which may evolve as the Governing Council reviews the key parameters of our operational framework, a process we will start in the course of 2026. Central banks are the monopoly supplier of base money, which consists of 2 main parts: banknotes and central bank reserves. Base money is the main liability of a central bank and determines the size of its balance sheet in normal times. The demand for base money can be met in different ways. In the euro area, prior to the global financial crisis, the Eurosystem primarily provided reserves through collateralized lending to banks, or repos. At the end of 2006, these loans accounted for almost 40% of our assets. So that's the dark blue part on the left-hand side. This changed dramatically when the Eurosystem started to implement balance sheet policies to safeguard monetary policy transmission and stave off downside risks to price stability. During this period, the asset side of our balance sheet became a policy instrument in its own right, and as a result, the main driver of the size of the balance sheet. After the full repayment of the targeted longer-term refinancing operations, or in short, TLTROs, at the end of 2024, securities accounted for more than 70% of our assets. So that's the red part on the right-hand side chart, while loans to banks constituted less than 1%. With the gradual unwinding of our monetary policy bond portfolios that began in March 2023, we entered a new phase in the evolution of our balance sheet. This process is commonly referred to as quantitative tightening, a term that is, however, misleading. When we raised our key policy rates, we made a distinction between monetary policy normalization and tightening, Normalization describes the process of bringing policy back to a broadly neutral setting, whereas tightening refers to raising interest rates above neutral territory to curb inflation. This distinction is also relevant for balance sheet policies. Today, as displayed on the right-hand side, 10-year sovereign bond yields in the euro area are estimated to be still some 60 basis points below the level that would have prevailed in the absence of quantitative easing. By running down our monetary policy bond portfolio, we contribute to a normalization of our balance sheet and thus bond term premium. In that sense, the term quantitative normalization, or QN, better captures the mechanics and intent of the current runoff of our policy portfolios, as we are gradually removing the residual monetary stimulus from the system. QN, however, is more than balance sheet normalization. It is a transformative moment that raises important questions. What role do central bank reserves play in the post-pandemic world? What mix of assets and liabilities best supports the effective implementation of monetary policy? And how will these choices affect market functioning? These are not merely technical questions. They are strategic choices that will influence how monetary policy will operate in the decade ahead. In our operational framework review last year, we provided insights into our thinking on these questions and how we see the future destination of our balance sheet. At the heart of our framework is the recognition that central bank reserves play a different role in the financial system today than they did before the global financial crisis. Back then, banks hardly ever held more deposits with the central bank than needed to fulfill their reserve requirements. They relied heavily on government bonds and interbank markets to manage liquidity. This was also the result of central bank choices. Until 2008, in the euro area, for example, banks had to pay 100 basis points of interest to keep funds they had borrowed in our standard refinancing operations as overnight deposits with the ECB. High opportunity cost disincentivized banks from holding excess reserves. QE has turned that system on its head. As liquidity has become abundant and effectively cost-free, the way banks are treating reserves has changed fundamentally. Today, reserves are an important part of banks' efforts to comply with liquidity regulation. Moreover, the introduction of instant payments and digital banking services more broadly are likely to have prompted banks to hold larger precautionary reserve buffers. Surveys suggest that banks want to hold a substantial amount of reserves as part of their liquidity, also in the future. And there are also normative reasons why scarce reserves may no longer be desirable from a social welfare perspective. To understand why, we can look at how banks' liquidity holdings have evolved recently. Over the past 3 years, the repayment of the TLTROs and QN have reduced the overall supply of reserves in the system by more than 2 trillion euros. That's shown on the left-hand side. As excess reserves count one-to-one towards the high-quality liquid assets that banks hold, the decline in reserves mechanically leads to a fall in their HQLA, unless banks choose to absorb the newly issued bonds replacing the maturing central bank holdings. In a counterfactual scenario, without such bond purchases, this is the dashed yellow line on the right-hand side, the liquidity coverage ratio of significant institutions would already have fallen below 130%. In reality, however, we have seen banks purchase sizable amounts of government bonds, effectively transforming part of their reserve holdings into securities that qualify as HQLA. As a result, the aggregate LCR of significant institutions in the euro area has fallen only marginally since 2022 and remains well above pre-pandemic levels. In fact, banks' HQLA holdings have even marginally increased over this period, as you can see on the left-hand side. In some countries, government bonds as a share of common equity tier 1 capital are now at the upper end of the historical distribution, as illustrated on the right-hand side. To some extent, this shift in the mix of banks' HQLA simply reflects changes in relative returns. For the first time in years, it is more profitable to invest in government bonds than to hold excess reserves with the ECB. But to the extent that current large HQLA holdings also reflect banks' liquidity preferences, their composition will ultimately also depend on central bank decisions. In particular, excessively high opportunity costs for holding reserves incentivize banks to hold a larger part of their HQLA in government bonds. This may be undesirable, as the liquidity position of banks would weaken if the value of government bonds were to fall, as illustrated on the right-hand side. Reserves, on the other hand, are risk-free. They don't fluctuate in value and can be immediately used for payments. In other words, in today's world, where HQLA is a central tool of banks' liquidity management, it is not socially optimal for a central bank to make reserves scarce. We should hence not excessively discourage the holding of reserves. A balanced approach, which considers central bank reserves as an integral component of banks' liquidity holdings, helps strengthen resilience, preserve market functioning, and reduce systemic risk. And this fundamental insight is embedded in our operational framework. Through our standard refinancing operations, we provide as many reserves as banks demand at a fixed rate against a broad set of collateral. Supplying reserves elastically as balance sheet normalization proceeds will go a long way towards allowing banks across the currency union to hold what they find to be an optimal level of reserves. A key advantage of a framework in which the marginal unit of liquidity is provided on demand rather than through asset purchases is that liquidity is always available when banks need it, but it is never intentionally supplied in excess. Another advantage is that it frees the central bank from having to estimate the uncertain volume of reserves necessary to steer short-term money market rates towards the key policy rate, as would be the case in a supply-driven framework. If reserves are primarily supplied through asset purchases, as in the US Federal Reserve System's operational framework, the central bank needs to calibrate the pace of QN carefully, as money market rates could rise abruptly if liquidity becomes scarce. By contrast, in a demand-driven framework, there is no direct link between the pace of QN and interest rate control. In the euro area, a rise in repo rates would therefore not lead to a slowdown in or the end of QN. We expect that our monetary policy bond portfolios will be run down completely, unless monetary policy considerations were to require renewed asset purchases at some point in the future. Rather, a persistent rise in money market rates to levels closer to the rate on the main refinancing operations would lead to more banks accessing our standard refinancing operations, thereby endogenously adding new liquidity to the system. So far, we have not seen this happening. Even if the number of banks participating in our operations has steadily increased over time, as shown on the right-hand side, the overall volume of demand for reserves has remained limited so far, for two main reasons. One is that excess liquidity remains abundant. While in other countries, upward pressure on short-term interest rates has been rising as liquidity conditions have tightened, repo rates in the euro area have remained close to the deposit facility rate, shown on the left-hand side. The other is that reserves, which are unevenly distributed across both banks and countries, are being redistributed effectively. In a demand-driven framework, Interest rate control requires two elements. One is to set the appropriate price for holding reserves. That is a spread between what banks pay for borrowing reserves and what they receive when depositing them back with the ECB. The famous Friedman rule suggests that in a frictionless world, central banks should provide reserves at the marginal social cost, which is approximately zero. However, applying the Friedman rule in a world in which central bank balance sheet expansion is costly from a social welfare perspective implies that a marginal cost should be attached to reserve provision. For example, providing reserves for free would risk disintermediating private markets. By contrast, a positive opportunity cost for holding reserves incentivizes banks to trade reserves in the market. Research also suggests that providing reserves for free could undermine sound liquidity management and lead to a ratcheting up of the central bank's balance sheet, with potentially negative consequences for financial stability. Against this backdrop, the Governing Council decided that a spread of 15 basis points between the main refinancing operations rate and the deposit facility rate appropriately balances this trade-off, also considering our broad collateral framework. Such a narrow policy rate corridor effectively limits interest rate volatility and sets the right incentives for liquidity management. The second element needed for interest rate control is to ensure that banks are ready to use the operations if and when they need liquidity. In a demand-driven framework, the central bank's operations are not a liquidity backstop. They are there to be used by banks as part of their day-to-day liquidity management, which is also acknowledged by banking supervision. Our framework also relies on large dealer banks supporting financial intermediation. The more connected these banks are to our operations, and the more frequently they use them, the less likely it is that repo rates will spike, as dealer banks often act as liquidity hubs within countries and banking networks. Ensuring a broader use of our operations may require these banks to set up appropriate governance processes to cater for liquidity needs arising not only from treasurers, but also from bond and repo desks. To make sure that banks are ready to use our operations, it is important to conduct coordinated testing exercises for banks across the Eurosystem. A natural outcome of our operational framework is that, over time, and as excess liquidity declines, collateralized loans to banks are going to once again gradually become the main asset that the ECB holds on its balance sheet. This does not mean, however, that we will return to the past, neither regarding the size nor the composition of our balance sheet. Since 2006, currency in circulation has more than doubled. Moreover, banks today may want to hold a significant buffer of excess reserves. According to scenario analysis by ECB staff, demand for reserves could drop to 600 billion euros if banks held only 10% of total HQLA in reserves and allowed the aggregate LCR to drop from 158% today to 130. But it could also drop no further than 2.2 trillion euros if reserves were to account for 30% of the HQLA and the LCR was allowed to decline only marginally from today's level. And these scenarios are depicted on the slide you see. Even if demand for reserves was ultimately at the lower end of this range, it would not be prudent for a central bank to rely exclusively on short-term refinancing operations. Concentrating liquidity provision in just one instrument would give rise to operational risks and encumber a significant amount of collateral. For these reasons, we clarified in our operational framework review that in the future, we will also offer structural operations, including new longer-term refinancing operations and asset purchases under a new structural securities portfolio. These operations are expected to make a substantial contribution to covering the banking sector's structural liquidity needs arising from autonomous factors and minimum reserve requirements. Importantly, they will provide liquidity for monetary policy implementation rather than steering the monetary policy stance. And while the date for launching these operations is uncertain and will depend on how fast excess liquidity declines and how banks react to this decline, our framework suggests the following sequence. And if there's one chart you have to take home today with you, it's this one. First, before we launch structural operations, we need to see a persistent and broad-based rise in the take-up of our standard refinancing operations. This is the dark blue area in the chart. These act as our marginal instrument to provide liquidity. And as QN proceeds, there will come a point when the level of outstanding reserves is no longer sufficient to meet the aggregate demand from the banking sector, meaning that it will not be possible to satisfy liquidity demands via the redistribution of reserves. At that point, overnight and term repo rates could rise more meaningfully, and take-up of our operations will increase. However, this would not be a signal of looming stress, but rather a sign of a functioning system that endogenously steers banks towards our refinancing operations. Second, once the recourse to our standard refinancing operations reaches a level where banks constantly roll over a significant amount of short-term borrowing to meet their liquidity needs, we should consider offering structural operations. Given the still large legacy bond holdings from earlier monetary policy operations, this naturally starts with structural longer-term refinancing operations. One option would be to shift a fraction of the recurring demand from our standard operations into structural longer-term refinancing operations at regular intervals. So this is the green area in the chart. Under this approach, the Eurosystem could, for instance, allot a fixed quantity of reserves in a variable rate tender, where the quantity to be allotted could be revised over time, just like we used to do before the global financial crisis. In choosing the appropriate length of the operation, central banks face a trade-off. On the one hand, the longer the tenor, the lower the operational cost of rollover and the higher the regulatory benefits for banks. Any central bank borrowing with a residual maturity above 6 months counts not only towards the LCR, but also towards the net stable funding ratio. On the other hand, the longer the tenor, the less agile central banks are in adjusting their balance sheet to unanticipated shocks, and the higher the risk of crowding out market-based funding solutions, which may conflict with regulatory objectives by making banks overly dependent on the central bank to meet regulatory requirements. In the past, the ECB has varied the maturities of the loans it provided to banks, and only in exceptional circumstances, such as in response to the sovereign debt crisis or the pandemic, did the term of these operations exceed 1 year. In any case, the structural LTROs have to be designed in a way that preserves the crucial feature of our operational framework, which is that the marginal unit of liquidity is provided via our standard refinancing operations. Finally, sometime after the launch of the structural LTROs, we will start building up a new structural securities portfolio, and that is the purple area in the chart. The size of this portfolio will depend on the decision by the Governing Council on the relative contribution that securities holdings should make to covering banks' structural liquidity needs arising from autonomous factors and minimum reserve requirements. The timing of the launch of this portfolio is therefore closely linked to the runoff in our legacy monetary policy bond portfolios. In addition, national central banks also have non-monetary policy security holdings, including euro-denominated asset portfolios. And this is the red area in the chart. These non-monetary policy holdings fall under the Agreement on Net Financial Assets, which limits the amount of liquidity national central banks can create via non-monetary policy activities, referred to as the net financial asset position. During QE, for example, this position declined, thereby providing monetary policy space, shown on the left-hand side. More recently, it started to grow again, also reflecting efforts to rebuild financial buffers. So, as was the case before the global financial crisis, these national portfolios will make a contribution to covering the euro area banking system's structural liquidity needs in the future, together with the new structural operations. As a result, purchases under the new portfolio will only start once the liquidity injected through our legacy monetary policy bond portfolios and the net financial asset positions falls short of covering the share of reserves the Governing Council decided to provide through securities holdings. Passive balance sheet runoff implies that this point is still far away, as shown on the right-hand side. The final question that I would like to address this morning is the type of assets the ECB may choose to buy as part of its new structural securities portfolio. In taking this decision, we must weigh up a range of factors. For example, in our operational framework review in 2024, we announced that we will aim to incorporate climate change-related considerations into the structural monetary policy operations. Today, I will focus on the considerations related to the maturity structure of the new portfolio. 3 principles are relevant in this context. One is policy stance neutrality. The goal of the operational framework is to implement the desired monetary policy stance and not interfere with it. Outright purchases of long-term bonds transfer interest rate risk from the private sector to the public sector. This eases financing conditions and hence affects the monetary policy stance. Overweighing purchases of shorter-term securities minimizes duration extraction from asset purchases and is hence more stance neutral. A second factor relates to maintaining policy space for future asset purchases. ECB staff estimate that there is still a non-negligible risk of again hitting the effective lower bound in the future. Also, in a more fragmented and shock-prone world, risks to monetary policy transmission may become a concern again. As a result, also in the future, there could be episodes in which the Eurosystem may be forced to purchase significant volumes of longer-dated bonds in its pursuit of maintaining price stability and monetary policy transmission. In view of this, holding shorter-dated assets in the structural securities portfolio could preserve valuable policy space. A third factor relates to the central bank's financial soundness. While central banks are not profit-maximizing institutions, preserving financial soundness helps maintain central bank credibility and independence. One important risk to financial soundness stems from interest rate risk arising from central banks being exposed to a duration mismatch, which occurs when they hold significant amounts of long-term assets with fixed interest rates. While the exposure to such interest rate risk may at times be necessary to preserve price stability, such as during the QE period, it should remain limited in normal times. The design of our operational framework embeds a deliberate alignment of the duration of assets and liabilities. By providing reserves on demand through refinancing operations, the Eurosystem matches floating rate liabilities, reserves remunerated at the DFR, with floating rate assets, namely variable rate repos. By contrast, a framework that supplies reserves largely through fixed rate bonds tends to create more interest rate risk. As a result, when policy rates rise, interest expenses can exceed central bank income. And this is what we have experienced recently. Taken together, the 3 factors speak, in my opinion, in favor of tilting the structural securities portfolio to the extent feasible towards shorter maturities. To conclude, let me leave you with 3 central lessons. First, in a demand-driven framework, there is no direct connection between the rundown of our legacy monetary policy bond portfolios and interest rate control. A narrow policy rate corridor and fixed rate full allotment of our standard refinancing operations can limit interest rate volatility and ensure that reserves remain sufficiently ample. We therefore encourage banks to use our operations if and when they need liquidity. Second, there is a sequence embedded in the operational framework for how to supply reserves in the future. Our standard refinancing operations are the marginal source of liquidity for banks. Once the Eurosystem balance sheet begins to grow durably again, we will start launching structural operations, beginning with longer-term refinancing operations and followed later by the build-up of a structural securities portfolio. The latter will be launched once the legacy monetary policy portfolios have run off sufficiently, also considering non-monetary policy securities holdings. Finally, policy stance neutrality, the need to maintain policy space, and considerations related to financial soundness are important factors that will guide the maturity of assets the ECB will buy under a new structural securities portfolio. And these factors suggest tilting the structure towards shorter-dated assets. And with this, I would like to stop and thank you very much for your interest and attention.
So, thank you very much, Isabel, for these deep insights into the future of central bank balance sheets and the implications of the design of operational frameworks. I'm sure that they will shape our discussions over the next 2 days. Now, I'd like to invite to the stage the first panel, and the chair of this panel, Anne-Marie McKiernan, and Director of Financial Operations at the Central Bank of Ireland. Anne-Marie.
So good morning, everybody. Very nice to be here for the conference. I'm going to invite up to the stage now our presenters for the 2 papers this morning. So starting with Shreya and Bill. Good morning, Shreya. And then the discussant for Shreya's paper, Carla Soares. Carla, from Bank de Portugal. And then the second paper that we'll have this morning, our presenter will be Johannes Breckenfelder, ECB. Thank you, Johannes. And our discussant will be Olivier Darmouny. Thank you. Thank you. So welcome all of you to the stage and to presenting and discussing these interesting papers. It's been a great start so far. Thanks, Isabel, for a fascinating speech and overview of the plans in relation to the monetary policy implementation and operational framework of the ECB. And here we have 2 really interesting papers and giving perspectives from the US and the EU. So I think that's a great start in terms of some of the research and issues that we can learn. So just an outline of what we will have this morning in terms of running order. We'll start with Shreya presenting on behalf of your co-authors from the Federal Reserve, which include Sebastian Infante and Zeynep Senyez, who are both here too. That'll be 25 minutes, and followed by Carla doing the discussant piece for 15 minutes, and then we'll have time for Q&A, about 10 minutes. So I ask you all to be very firm with the timing. So that gives us a starting session then that brings us up until 10:20. And then we'll move on to the second paper. So with that, I think I'll hand over to you, Shreya, for 25 minutes. Thank you. And Shreya, I'll give you a sort of 5-minute hand.
Really?
Yeah.
I think.
Excellent. Okay.
Okay, thank you so much, Anne-Marie, and thank you so much to the conference organizers for accepting our paper to the program. I'm absolutely thrilled to be here, and as Anne-Marie said, this work is joint with Sebastian Infante and Zeynep Senyez, who are both here today, who are also at the Board of Governors with me. And before I begin, let me just first say our disclaimer that the views expressed in this presentation are ours and should not be reflected as the ideas of the Board of Governors, its staff, or anyone associated with the Federal Reserve System. Okay, so Zeynep, Sebastian, and I are in a section at the Board of Governors that think a lot about how monetary policy implementation affects short-term funding markets. And I am sure that many of you know that the Federal Reserve uses what is called an ample reserves monetary policy framework. And you can probably guess, if you are not familiar with this framework, by the nature of the name, that means that there is ample reserves or aggregate liquidity that is abundant, that is supplied to the financial system. But the issue with that could be that this implies, by construction almost, a very small or non-existent, some might argue, interbank market. And this is because there's so much aggregate liquidity, banks have no need to trade reserves, which is just cash held at the Fed, with one another. And this might not be a problem, but it might be difficult for the Federal Reserve to assess liquidity conditions among banks if there's no interbank market to observe. There are no prices or volumes. But why is this question suddenly so interesting? Is because, the Federal Reserve has been doing an ample reserves monetary policy framework that has worked quite well over the last 10 years, is that the Fed started reducing the size of its balance sheet on June 1st, 2022, and in fact, last week announced that it would stop reducing its balance sheet effective December 1st of this year. But since that day in June 2022, the Federal Reserve has the assets of over $2 trillion have rolled off the Fed's balance sheet, meaning mechanically that liabilities have also been reduced by $2 trillion. And then knowing when to stop reducing the balance sheet depends on understanding this demand for aggregate liquidity and how much liabilities the Federal Reserve should provide. And there is a growing literature right now that is looking at trying to understand this demand curve, if you will, for aggregate liquidity. But in this paper, we want to take a little bit of a different approach. We argue that some of this literature thinks about the demand for aggregate liquidity in an aggregate sense. And a very typical time series regression that many of these papers use is that they regress the effective federal funds rate, changes in that rate, which is the main policy rate of the Federal Reserve on the left-hand side, and they regress that on changes in aggregate reserves on the right-hand side. And the idea is that if you have an ample reserves, abundant reserves, if you will, if you did that time series regression, the coefficient on that regression would be statistically insignificant, meaning that small changes in the aggregate quantity of reserves doesn't affect the price of reserves. That's going to be the effective federal funds rate. But as the Fed undergoes balance sheet runoff, reduces the size of its balance sheet, thereby removing aggregate liquidity from the financial system, at some point you will see that coefficient become statistically significant. And this is usually interpreted as the kink, if you will. This is the onset of reserves becoming scarce because now small changes in the quantity of reserves affect the price of reserves. That is the effective federal funds rate. And so in this paper, we think we're going to take an alternative approach. Perhaps this aggregate approach overlooks the heterogeneity of how banks demand reserves, and that could be important for the federal funds market, which is the main interbank market in the United States. And so this brings me to my research questions. Can the current interbank market, and it's very small, I'll be the first to tell you that, can it reveal any information about bank liquidity conditions and perhaps signs of reserve tightness? Can we learn anything from it the way it is today? So before I get into talking more about that, let me just spend some time kind of level setting and explaining how monetary policy implementation works in the United States. So I am sorry if this is very familiar to many of you, but just to level set, hopefully this is a very familiar picture for many of you. So I have here the demand curve reserves, and that's the red line. And the x-axis is the amount of reserves supplied by the Fed, cash held at the Fed by banks. And the y-axis is the price of reserves. So that's going to be the effective federal funds rate. Now, I interpret the ample reserves framework to be the blue vertical line, which is the supply line. And that means that the amount of reserves provided by the Fed is on the flat portion of the demand curve. And you can really see here that small changes in the quantity of reserves are not going to affect the price of reserves. Here I have 3.3 trillion. It's a little outdated. Right now it's 2.9 trillion, around there. But you can see here that because small changes in reserves don't affect the price of reserves, the Fed uses two administered rates to essentially maintain interest rate control. And the first is called the interest on reserve balances, and that's the rate that banks receive if they put cash held at the Fed. And the second rate is called the overnight reverse repo facility rate. And I like to say that that's the non-bank interest rate. That's the interest rate that non-banks, namely money market mutual funds, receive when they put cash held at the Fed. But how does this monetary policy implementation affect interbank markets? So I'm going to go back in time here in March 2022 when the Federal Reserve started to raise these administered rates that I just discussed to combat inflation. And this is when the deposit channel of monetary policy kicked in. So in the United States, banks have market power. So when the Federal Reserve raises interest rates, they do not raise their deposit rates on their checking accounts nearly as fast as non-banks, and I'm thinking specifically money market mutual funds. So as the Federal Reserve started to increase rates quite quickly, we saw deposits flow out of banks and into these non-banks, money market mutual funds. And so this just means that banks have just less deposits to do stuff with. And at the same time, the Federal Reserve also began reducing the size of its balance sheet on June 1st, 2022. And how does that mechanically occur? So Treasury securities are allowed to mature, also agency mortgage-backed securities, but I'm going to ignore that for now, if you will. So over $2 trillion of Treasury securities have matured. And what that does is it mechanically reduces the short-term liabilities that the Fed creates, this aggregate liquidity of reserves and the non-bank reserves, which is that overnight reverse repo facility. And at some level of reserves, you will reach this X, which is this magic level of when you reach this upward sloping portion of the demand curve that I showed on the previous slide. And this is supposedly when repo rates will start responding to changes in aggregate liquidity. But what does this mean for the interbank market? So at this point, banks should have some need to trade reserves with one another because aggregate liquidity has been removed. And so interbank trading, in theory, should revive. So let me go now and explain how the interbank market works in the United States. So the interbank market is called the federal funds market. And so this is the only interbank market in the United States. This allows banks to trade reserves. It's overnight, but unsecured. But it is not an interbank market today, really. There are only two types of trades, and it's a very idiosyncratic market. So the first type of trade is where federal home loan banks lend to foreign banks. Now, despite having bank in the title, federal home loan banks are not actually banks. They are called government-sponsored enterprises. They were actually created after the Great Depression to support the US housing market. And because they are not banks, they do not enjoy interest on reserve balances. So they are incentivized to lend at an interest rate below the interest on reserve balances. Who do they lend to? Foreign banks. They are happy to borrow at a rate below interest on reserve balances because they can just take that money and park it at the Fed, and we call that the Fed arbitrage trade. And that is the lion's share of trading in this market, probably about 90% of volumes, and I'll show you that a little later. The remaining 10% of volumes is domestic banks borrowing and lending from one another. And the effective federal funds rate, which is the main policy rate at the Federal Reserve, is calculated using a volume-weighted median of transactions in this market. So much of the transactions that go into this rate are these Fed arb trades. And so here's a picture of volumes and prices. So the effective federal funds rate, just in levels, is the black line. And you can see that the blue shaded area is volumes. So zooming, this is over the last 10 years, but over the last year, volumes are roughly about $100 billion a day, which is, quite small to those of you familiar to the US Treasury repo market, which is over $12 trillion a day. Now, let me zoom in on the interbank market. So the interbank market here I've plotted in blue over the last 10 years, which is how long we have data. You can see it's quite small. It's range bound between $2 to $8 billion a day. And if I plot it against that Fed arb trade, you can barely tell the differences between the blue line and the black line, which is the Fed arb trade. It's essentially splitting out these two types of trading in the Fed funds market. But what I've only shown you here is volumes. I haven't shown you prices. So now I'm going to show you prices of the blue line versus the black line. And you can see it here. So now the prices here, I've now subtracted the interest rate from the interest on reserve balances, so you don't see movements in the policy rate. And so the black line is the effective federal funds rate, which is going to be an amalgamation of both of these types of trades. And the blue line is just the volume-weighted median rate between domestic banks in this market. And I would argue that the blue line moves a lot or more than the black line, right? It could be actually indicative of actual liquidity conditions. And so that is what we spend most of the paper trying to figure out, is that does this blue line actually tell us something about monetary policy implementation, liquidity conditions, and just constraints across banks? So the benefit of working at the Federal Reserve is we get access to a lot of confidential data, and so I think that was one of the advantages of this paper, the richness of the data set. So we are going to create a panel data set using 3 collections that the Federal Reserve does. So we're going to have daily deposit data, daily reserve data, and all the transactions in the federal funds market. One of the little quirks of the FR 2420, which is the second report here that we're using, is that while we observe borrowers in the federal funds market, we only observe lender types and not lender identities. So we actually use our payments data, which is the FedWire Fund Service, to identify those lender identities. So we're going to arrive at a panel daily set of roughly 2,000 banks over the last 10 years, which is what we have data for. And we're going to divide them into different size buckets. So we're going to say banks that are less than $10 billion or small banks, anything greater than $100 billion in assets, or large banks. And we get these size buckets basically of how our supervision and regulation division assesses small versus large banks. And our regressions are going to be at the weekly level. So first, let me just show you some summary statistics of how banks might demand reserves and what might make them trade in our interbank market. So a lot of the literature thinks about how banks demand reserves is usually in some sort of shock to deposits. So what I've done here is I have plotted reserves to deposits for roughly 2,000 banks in our data set by all, which is the top left. The top right is just the small banks, and the bottom left is medium and large. So the takeaway here is that medium and large banks, they really like reserves. There is not so much of a tail. A lot of them hold a lot of reserves. Whereas the small banks, which is the top right, it's very different, very heterogeneous in how small banks hold reserves. Some of them hold a lot, some of them hold very, very little. So right here, just from the summary statistic, perhaps a uniform demand curve for reserves in the United States may not be the right approach. So the second thing we do in the paper is say, okay, if there's not a uniform demand curve, how does that affect prices in the Fed funds market? Essentially, we want to estimate what we call as a supply elasticity. The first problem we have is that banks do not trade every day in the Fed funds market. And then the second issue is that we have an endogeneity problem. If we are trying to understand how the supply curve moves, we need to be able to isolate the demand curve. And this is how we do it. So here I've plotted here is I have on the x-axis here is essentially how much I'm going to borrow in the Fed funds market, and on the y-axis is the price I might pay. And the black solid line is essentially the demand curve. I am a small bank, I receive a deposit shock, I want to borrow more reserves, that's going to shift up the demand curve to the dashed line. What we're trying to do in our regressions is estimate how much the supply curve shifts because my demand has increased. So that is illustrated by the dotted green lines, which you can't really see, that's green, my apologies, which is the change in the Fed funds rate divided by the change in Q. So essentially, all of the coefficients that I'm going to show you is essentially for a $1 more borrowing that I'm going to do in the Fed funds market, what's the price increase that I might have to pay? And in order to essentially isolate this, the supply curve to understand the supply elasticity, in the paper we use shocks to small domestic bank deposits as a shock to aggregate borrowing in the Fed funds market. So very briefly, I'm just going to show you the regression because I think it helps kind of understand one of the only 2 regression tables I'm going to show you today. Is we do 2 types of regressions in the paper. So on the left-hand side here, I have the change in the price that I might pay as a bank. And the subscript capital L is if I'm borrowing from a bank lender versus a non-bank lender. And so this is going to be that Federal Home Loan Bank that I introduced to you. And on the right-hand side, I'm doing changes in volume, and we're instrumenting that in equation 2 with changes in demand deposits at a small bank. The supply elasticity is the gamma 1 prime. So that's going to tell me if I'm going to borrow from a bank versus an FHLB, this non-bank, how much more I'm going to have to pay from that type of lender for every single incremental dollar that I want to borrow. So here are those results. So columns 1 and 2 is just all lenders. Columns 2 and 3 are bank lenders. And columns 3 and 4 are those non-bank lenders, those Federal Home Loan Banks. And so you can see that gamma 1 prime, the supply elasticity, if I want to borrow from a bank, is 0.2, versus if I want to borrow from this non-bank, this Federal Home Loan Bank, it's even negative. So what this means, the first thing to see is that the 0.2 is much bigger than the minus 0.035. And what that means is that non-bank lending is quite elastic, but bank lending is very inelastic. And to interpret these coefficients, a $10 billion increase in bank volume is associated with a 20 basis point increase in the rate. So essentially, banks demand a much higher price for every single dollar that you might want to borrow from them in comparison to these federal home loan banks. And to see that in a picture is here. So these are not coefficients of any regressions. These are just plotting prices and volumes in this market over the last 10 years. And all we're trying to do is plot an equilibrium curve. So on the x-axis is the cumulative amount of volume that I want to borrow, and on the y-axis is what I pay as the spread to the interest on reserve balances. A blue dot is if I borrowed from a bank lender, and a red dot is if I borrowed from a federal home loan bank, a non-bank. So you can see that the red dots are much flatter, right? So this shows that this minus 0.035, for every single dollar that I want to borrow from a federal home loan bank, I don't pay too much of a higher price. But if I'm going to borrow from a bank, that supply elasticity is very, very steep, as you can see from that right tail. And what that means is if I want to borrow from 12 billion to 13 billion, for example, I might have to pay 80 basis points more just to go for that incremental 1 billion. And this is over the last 10 years. So the next part of the paper tries to understand the slope of that right tail, of the blue line, as blue slope, essentially. We want to understand if there is a lot of aggregate liquidity in the system, does that slope become flatter? And then who are the lenders? Who is providing this marginal liquidity to banks in this market? So to first kind of motivate that aggregate reserves can actually affect the slope of the price, essentially, in the Fed funds market, here I've plotted aggregate reserves in comparison to bank prices and non-bank prices. So the bank prices, which you've seen before, this is essentially the volume-weighted median transaction price in the federal funds market. That's the yellow line. The purple line is if I was just to borrow from the federal home loan banks, and that's the Fed arb trade. The red dashed line is aggregate reserves to total banking assets in the US. And so you can see here, maybe it's a little bit harder to see, but that the yellow line is negatively correlated with reserves to assets, meaning that if there is a lot of reserves in this financial system, domestic bank lenders charge a lower price. I would argue that the purple line is not nearly as responsive, and we show that formally in the paper. One thing that I also find quite interesting is I've plotted one of the vertical lines, the repo spike. That's the day of September 17th, 2019, the day when the federal funds rate actually printed outside the target range. You can see that the yellow line, which is the rate that banks traded with one another, that didn't really move on September 17, 2019. It is the purple line, which is the FHLB's lending to foreign banks. That is what moved on September 17, 2019. So you could make the argument that it was repo market frictions that really caused the increase in September 17, 2019. And at least among these banks in the Fed funds market, they did not experience any frictions on that day. So let's talk a little bit about who these bank lenders are. So as I mentioned before, the FR 2420 report on selected money market rates, where we get the transactions for the federal funds market, this only provides us with lender types, not lender identities. So we merged this data with the FedWire Fund Service. So this is all the payments data for all the banks in the United States to get the identities of these bank lenders. And we find that the majority of all bank lending in the federal funds market to domestic banks is done by 12 bankers' banks. So who are bankers' banks? So it might come to a surprise to you that there are roughly 5,000 banks in the United States. Of these 5,000 banks, only 3,000 have actual accounts at the Fed to trade reserves, access to the discount window, et cetera. And this is just because of the nature of how the banking system in the United States was set up over the last 200 years. The remaining 2,000 banks use bankers' banks, essentially to access Federal Reserve services. And so these bankers' banks are essentially correspondent banks to support community and regional banks. So I'm talking about the First National Bank of Arlington, Virginia. I'm not talking about the JP Morgans of the world. And they are defined in interpretation of Regulation D under the Monetary Control Act of 1980, and they do not compete for retail deposits. So they're really here to support the small community banks, which are roughly 2,000 banks in the United States. And as of year-end 2024, of these 12 bankers' banks, they had a combined assets of about $10 billion, but their clients are 1 in 3 of these community banks. So now I've shown you now I've taken aggregate reserves to assets, and now I've plotted the green line here now is the reserves to assets at these bankers' banks. And so you can see here that the yellow line, which again is the volume-weighted median transaction price of banks trading with domestic banks in the Fed funds market, it is far more responsive to the green line than aggregate reserves. And so this is the amount of reserves held at bankers' banks. So all their clients, all these small community banks, are essentially depositing reserves at these bankers' banks for them to place at the Fed or trade in the Fed funds market. And what is really interesting is you can see once the Fed started raising rates in March 2022, the precipitous decline in the green line. And this is the deposit channel of monetary policy. So as the Fed was increasing rates, banks experienced a loss in deposits to these non-banks. We believe it is these bankers' banks that are kind of like the marginal lenders, the marginal losers of deposits, if you will. So the last part of the paper is to show formally that the Fed funds domestic bank prices really respond to positions at these bankers' banks. So we've taken that regression that I showed you, the changes in volume, and now we interact that with the amount of reserves held at these bankers' banks by all their client banks divided by their total assets. And you can see that that gamma 1 prime, the supply elasticity, if you will, is 0.46, which is much higher than the 0.2 that I showed you. However, when we interact that with bankers' bank assets divided by bankers' bank's reserves divided by total bankers' bank's assets, you can see that the coefficient is negative at minus 0.05. What this means is that for an increase, if bankers' banks have more reserves that are deposited at their banks, then they're going to give you a lower rate in the Fed funds market, which is consistent with this idea that aggregate liquidity will actually lower the rate provided by domestic bank lenders in the Fed funds market. And so to put some context of what this means is a 1% increase in bank volumes is associated with about a 34 basis point increase in the price you might receive if you borrowed in the Fed funds market. So in conclusion, we do believe that the interbank market, although very small, could be informative to study liquidity conditions among banks. And we find that reserves among these bankers' banks, they are the ones that predict interbank pricing in the Fed funds market. And that signals from the effective federal funds rate, which include these bank and these non-bank transactions, this FHLBs lending to foreign banks, they might obscure signs of liquidity conditions, at least just among these banks, these small 2,000 roughly community banks. And so the rates offered by bankers' banks could offer a clean read of reserve demand among banks, liquidity conditions among banks, where these banks are not usually affected by repo market frictions. Thank you very much for your time.
Yeah. Over to you, Carla. Thanks, Ria.
Okay. So first of all, thank you very much for inviting me here to discuss this very nice paper. Thank you to the organizers for giving me the opportunity to attend to this year conference. So let me start with a brief summary of the paper in 2 sentences. So first, as Ria said, the interbank market is not dead and can give us informational content. And 2, heterogeneity matters. And the third sentence, additional one, here is the practical policy implication that this can have. So we can monitor closely the microstructure of the Fed funds market in order to give us information about the possible reserve scarcity that we can see in the market. So this can be a policy implication that we can also think for the euro area. So we need to follow, be paying attention of what the heterogeneity in the players in the market to give us more details about really the reserve position. So let me go into a bit more detail of the paper in these very basic pictures that I usually like. So the reserve demand curve that we see here of the Fed funds market, and with this usual kink that we care about that can take us away from the ample reserve regime, and then we can start seeing rates being pushed up. And then what the paper does is, let's look at also the supply of reserves. Because we've seen in many of the presentations here in previous money market conferences, papers estimating this reserve demand, but this can also be perturbed by the supply of reserves. And first of all, the main player are the non-banks that have this flat supply of reserves that can only access to the Fed at a discount relative to the banks. And then there are the other players. So there are these domestic banks that also supply reserves, and that they tell us that they are more sensitive to the price changes. And moreover, they get even more sensitive as reserves go down. So these banks turn their supply more price inelastic as reserves go down, and so then you can start seeing rates coming up in this domestic market segment faster. They also tell us more about this interbank market. So they also tell us that there is a demand for reserves that reflects liquidity management. And this part of the demand comes mostly from these small domestic banks. And they tell us this, as Ria showed us, because these banks have less reserves compared to their deposits. This makes them more vulnerable to the deposit shocks. So they really use this market for old-fashioned liquidity management. So this matters then because as reserves decline, you may start to see some pressures coming up in the margins in this interbank market. And we may start seeing lending from reserve poor banks start showing up in the lending to the small domestic banks. And by monitoring the conditions and the possible local scarcity issues, reserve scarcity issues in the interbank market, we can have information on the positions of the reserves, the regime and of the Fed funds. And then they proceed empirically to estimate, to prove this hypothesis. And how do they do this? And she also showed this. So they take they take reserve demand shocks to these small domestic banks to identify the slope of the supply curve. So let's have the full blue line of the reserve demand. Then they identify these reserve demand shocks that push the reserve demand to the dashed blue line. And this allows to estimate the slope of the demand curve. And what is this reserve demand shock? They use the changes in demand deposits, and they claim that this is an exogenous shock to the reserve demand. And their findings, Sri did not show you this picture, but what they find confirms their hypothesis. So that the non-banks have a perfectly elastic supply. So this is the flat line. So this is what they plot here is the estimated slope of the supply curve relative to the aggregate reserves. And on the top chart, you see the flat line. It's the estimated slope for the non-banks, and the estimated slope for the overall domestic banks. And that you see that it becomes more inelastic as reserves go down. And on the bottom chart, it's the relationship with the bank's aggregate reserves. And you see here also that this relation is even more stronger for the banks. Okay, so I really like this idea, and I think that I've looked at last week at the revised version of the paper, which I think it's even better. But although although I think that the real interbank market can have informational content, I miss a bit more about the discussion of what are these distributional frictions among the different players and what can it be the aggregate impact that they can have, that in the end can matter for the policy implications. So let's go back to the curves. So we have the domestic banks, but then we also have the foreign banks that are the main borrowers in this market, and they have basically a flat demand curve. Okay, and in the aggregate depends on each player's weight, and also what they say is, okay, in the aggregate, this is a market that is determined by the foreign banks borrowing and by the non-banks supplying the liquidity. So with the current institutional and regulatory framework and the liquidity regime seen so far, the market is really determined by the foreign banks and the non-banks. So what would it take for this domestic bank segment to matter for the aggregate? So my question here is when and in what conditions can we expect this domestic bank segment to spill over to the overall market that can justify an intervention by the Fed? So if we start seeing some pressure in the domestic banks, can we expect to see also the banks going more into the non-banks? Is there a price? So under what conditions can we expect to see a bit of this redistribution of liquidity among the different market participants? Is there a price at which we can expect to see the banks going to the non-banks, or even the small banks? This is part of, I don't know much about the structure of the Fed funds, but could the small banks also diversify away their reserve demands? Or in the end, is such a segmented market that some potential issues just stay there in that market, and in the end we do not see anything in the aggregate, because then in the aggregate, okay, in the end the reserve supply is determined by the Fed. So second comment, and then now that you want to maybe keep a little bit away the repo market, but there is this part that I think that it's still a bit missing with the interaction with the repo market. So, and you discussed it, some spikes, namely the 2019 spike, was clearly a spillover from the repo market among the features that we see also on this market and the regulatory restrictions, as we see in other papers. But given that the repo market is an early day market and the Fed funds it's a late day market, we can also see some spillovers daily going from one market to the other. And for instance, as the reserves go down, this could go hand in hand with the need for collateral going up. So the lower elasticity of the supply of the banks, can it also just reflect the greater importance of the repo market for these banks? So this is an IV paper. I think I would add to discuss the instrument now. So my question then is, can you say that deposits are truly valid instrument? And you present some arguments about the alternative explanations of that do not follow. I wonder if you could go more into details or provide more robust evidence that you really think that this is a valid decision. So there is this idea that in the end it's changes in the reserves that drive the changes in demand deposits, comes from these papers from Achari and co-authors. So this undermines indeed the instrument, and they also find that this is even more relevant for the small banks, which are the ones that are crucial for your identification. One thing that could help is that you are looking here at high-frequency changes. So these high-frequency changes can be less relevant. That is the demands that drive the reserves that drive the demand. So I don't know if you could hinge a bit on that to provide more balance of the validity. So then you also talk more about the changes in the deposits. In 22, the fall in deposits related to the policy rates. I wonder also in 23, following SVB, if there could be a fall in deposits related to bank fragility. So I wonder how much these really changes in the deposits are really exogenous, or if this is just also a choice variable of the banks. In the end, I also see from one picture that you have in the paper that there is some seasonality on the deposit evolution. So how much are the deposits a variable that can be anticipated by the banks? And some regression specification choices not so clear to me. It seems to me that you regress the regression of the aggregate lending of the Fed funds activity on individual bank changes. So in the end, it seems like you're limiting here how you explore the heterogeneity of the data. So I know that you don't have the data on the lenders, but then could you just then consider just an aggregate regression of the deposit shock instead of the bank level deposit shock? Because then I wonder also if by using the individual deposit shock, if you're looking at the small banks deposit shock only relative to all banks deposit shocks, this could be just a rescaling of the all banks deposit shocks, and this can affect your coefficients. One way that can also help on this issue of rescaling is to define the deposit shock in aggregate log change. Then you can interpret it really as the percent elasticity. Then you also have here a long period, 10 years almost, with different regimes. So I wonder if you could also explore more the time dimension of the paper, doing a kind of a time-varying elasticity of supply, as Afonso and also co-authors do for the reserve demand, that can also inform you better about the different, how can reserve elasticity, reserve supply elasticity change over time in the different regimes. And this could, if you would have like more granular data, you could also take into account bank time phase effects so that you can take into account that banks may change over this period. And finally, that you will include more than 1,000 banks in your regression to explain a market that is composed of 78 banks. So try to restrict also only to the banks trading in the market. So just to conclude, I really like the paper, and I really like the fact that it highlights these distributional fictions in a market that sometimes we think that it's that, and tell us that this is still relevant for policy and monitoring, but there is still scope for more analysis. And thank you very much.
So thank you very much to Shreya and to Carla. So now we have time for some Q&A. We'll have to restrict it, I think, a little bit to 5 minutes. So please, if you're asking a question, identify yourself and your organization if appropriate. So, yes, we have a hand over here. Would you like to stand up? There's a microphone coming. Yeah, thank you.
Thank you. I'm Balázs Horváth from Central Bank of Hungary. And I was reading the paper. It was really great, so thank you for the contribution. But I wanted to ask, I was looking at this chart of the volumes and the prices borrowing by domestic banks. And what I see is that on the side where the spread is above zero, so where the arbitrage supply disappears, the curve becomes really, really steep. And also, we also discussed that there are only a few banks trading on the market, And does not this tell you that the market is not working at all, in a sense that there are a lot of other banks with excess funds, and they are not lending it out, only on higher prices? So the curve becomes really, really steep after the arbitrage supply disappears. So does not this tell that the market is not working at all in this sense?
Well, first of all, thank you so much for the question. I also wanted to thank you, Carla, also for a very excellent discussion. You are right that when the arbitrage trade disappears, if you will, the curve becomes very steep. But we don't really interpret this market as the marginal market for large banks that have a lot of excess reserves. We interpret this market as a way for smaller banks that don't have access to repo markets. This is where they borrow funds, right? And I don't think we're interpreting it as it's not working, but it is a market where it is probably more difficult to get funding as a smaller bank than if you were like a larger bank that had a lot more access to different sort of funding markets. Our data right now ends in 2024, but the market actually has quite expanded over the last year because as the balance sheet of the Federal Reserve has shrunk. So I do think that it is actually probably, at least for these small banks that don't have access to the repo market, it is reflective of their credit and liquidity conditions. Now, you can say as a policymaker, like, this is a very small portion of the market. Is this a market that we should care about? That is not for us to decide. We're just showing that there is this market that could be interesting. And if you are worried about community banks in the United States, this could be a way to assess their conditions.
Thank you. Okay, we have a question here. Is there a microphone for here? Second row. Yeah. Thank you. Just here. Thank you.
Yes. Bonjour. Eric Scottodi-Rinaldi, Rabobank. Quick question. These domestic banks seem to be suffering from an access to funding, as you said, liquidity availability. And it triggered me to ask the question whether your article, your paper, would suggest a potential need to rethink the framework, either through more targeted operations to make sure that there is this availability of liquidity made to them, or, let me see, going perhaps towards a demand-driven framework. Thank you.
So I'm going to say this is my opinion and not of the Federal Reserve's. So these banks do have access to the discount window, right? So they could potentially use the discount window. Yes, and I'm sure many of you in this room know the problems with the discount window. So I don't know. I mean, we've thought about your question, but I think these banks are just, they're not really thought of right now, right? We usually think of the very, very large banks that are usually involved in repo markets. And what we found interesting is that these banks didn't really have too many frictions in 2019 when it is a day that is touted that reserve demand became scarce, right? So thinking about what does reserve demand mean? But yes, as you point out, like these banks, you know, we would have to think differently if we wanted to help these banks.
Thank you very much. We're tight on time, so what I suggest is we can take some questions with Tria maybe over the coffee break, and we'll move on to our second paper. So I'm going to invite Johannes Breckenfelder to present on his research. Thank you, Johannes.
Thank you. Thank you. Excellent. Thank you. Thank you so much for having me and for putting the paper on the program. It's a great pleasure to be here. This is joint work with Glenn Skeppens. And since we are both at the ECB, now I need my goggles because the views expressed in this presentation represents those of the authors and not necessarily those of the ECB or the Eurosystem. So in recent years, we've seen central banks step in as market maker of last resorts when markets freeze. In this paper, we trace the whole cycle of such an intervention, from stabilizing the market to what happens once the central bank steps back. Let me start by showing you what happened in the euro area commercial paper market in March 2020, which is the starting point of our analysis. Before I go to the nice chart on the right, let me define what is a commercial paper. It's a short-term unsecured debt, maturity below 1 year. It's issued mostly by large firms that are sold to buy and hold institutional investors. And firms use commercial paper to manage their short-term funding needs, so paying wage bills, for instance. In our sample, in fact, commercial paper are 32% of the short-term debt of these non-financial corporations. Turning to the chart on the right, what you see is the number of issuances of commercial paper by non-financial corporations. And on the y-axis is the number of issuances, which are on a weekly basis usually around 200. But in March 2020, they go down to below around 50. Independent of what metrics we look at in the commercial paper market, you will see a similar pattern. For instance, looking at the number of issuers that are usually around 100 on a weekly basis, they go down to about 40. Even more stark so, on the right, the volumes of new issuance. New issuances in terms of actual aggregate volumes, which are usually around 9 billion, and they go down to about 1. So there was a sharp decline and a collapse of this market. Now, this nice dashed line here in the middle is just before the ECB started buying commercial paper. And what you see is a revival of the funding to firms just after. So in an unprecedented move, the ECB started buying the NFC commercial paper as of March 26 and stated the objective to improve monetary policy transmission, preserve reliance on market-based funding, free up bank lending capacity, and foster market confidence. So in this paper, we try to study the full cycle from market collapse to the central bank intervention and eventually to the central bank exit and its impact. Specifically, we asked the questions, why did the commercial paper market suddenly collapse in March 2020? Could the firms substitute lost commercial paper funding via bank credit lines? How effective was the ECB's market maker of last resort intervention? And what happened after the ECB exited? This provides a unique setup because a nice feature for our study of commercial paper is that it has very short maturity. And the ECB, in fact, no longer holds a commercial paper. So we can look at the exit vis-à-vis other asset classes as sovereign bonds, for instance, where quantitative tightening is ongoing. We also have very granular data on firm level that we complement with ECB holdings of commercial paper, so we can study the effects of the market maker of last resort intervention, as well as the bank credit lines to firms to study the substitution between market and bank funding. And we also know who holds commercial paper both before and after the intervention. So to understand the collapse, we look at who is the main investor in this market. It turns out that money market funds played a dominant role, and their behavior, in fact, explains much of the collapse that happened in March 2020. In fact, 60% of all commercial paper was held by money market funds as end of 2019. So what happened to money market funds in March 2020? What we see here is the aggregate net fund flow. The net fund is the difference between inflows and outflows. And what you see in March 2020 is a sharp decline, large outflows in money market funds. Also, after the intervention, the flows didn't come back, so it stayed for quite some time on this level. During this crisis, money market funds, in fact, did not roll over their commercial paper. So now we have to put this into a regression setup and into an empirical framework, this observation. So what we do, we focus on the relationships a firm had with different money market funds prior to the market collapse. So what we need here is firms with more than 2 money market fund relationships, because that way we can control for firm demand in the quasi-Mian sense. And the feature of commercial paper helps us here because typically commercial paper issuances are absorbed by a particular money market fund in full. There's a very concentrated ownership here. So this is a different diff setup that compares commercial paper holdings issued by the same firm across money market funds facing negative versus positive net flows in March 2020. And this is what you see in this regression setup. On the left-hand side, we have the log of outstanding commercial paper on a firm money market fund basis. And money market funds with negative flows, this is what you see here, reduce their commercial paper holdings by 13 to 23%, depending on the specification, column 1 to column 3. All right, so naturally the question is, could firms replace the lost market funding with bank credit? And this is what we look at next. First, we analyze how credit line take-up relates to the commercial paper gap. What is the commercial paper gap? It's the commercial paper maturing minus new commercial paper issuances. So if there is less issuance than maturing, it's a positive gap. A positive correlation will mean that there is a substitution between the bank credit lines and this commercial paper gap. So what we find is that firms with a positive gap could only replace about 27% of lost market funding via bank credit lines, or if you want, 27 cents on the euro, which you see here in the second column. So soon after, the ECB stepped in through the PEP program, and it began buying commercial paper, which is an unprecedented move and did not happen before. So let me review just in 2 bullet points the pandemic emergency purchase program, which was a temporary asset purchase program as a response to the COVID-19 turmoil, and it was the first ever program that included commercial paper purchases. And in fact, during the first month of the PEP, 73% of all private debt purchases were commercial paper. Now, as I told you before, there is the investor base is not as diversified. So what the central bank ended up with is buying on the primary market. 81% was in fact bought on the primary market. And as for bonds, of course, the commercial paper had to satisfy certain eligibility criteria, and it was announced on March 18, 2020, and the actual purchases started on March 26. So thinking about what happened to the main investors. So this is the main investor being the central bank, and what you have here, the central bank holdings of firms' commercial paper in percent. This is taking the firm's view. This is the average holding of commercial paper that was held by the central bank. And you see at the peak, around nearly 80% on average was held by the central bank. So it was a big intervention. And you can also see that right after it declines quite quickly because of the short-term nature of these debt securities. Also, what you see is by 2023, everything was over and the central bank exited. So now we want to put this again into a regression. So the empirical setup is really that we analyze the impact of PEP purchases on volumes, maturity, and yield of commercial paper. And we have this diff and diff setup where we compare PEP impact across eligible versus non-eligible commercial paper securities. And the sample period here is 4 weeks before and 4 weeks after the ECB started buying these securities. So putting this into a graph, what happened? So if we split by those commercial paper that are eligible versus those that are ineligible, what you see is, and this is the blue line, these are the change in amount outstanding relative to before the crisis for eligible commercial paper. And you see that with the intervention, they started going up. But let me draw your attention to the crisis period and before the crisis period, because here both lines go remarkably close to each other, even during the crisis time, where the non-eligible and the eligible both declined. And you can put this also differently in a different metrics, where you have here on the left-hand side the new issuances, and there you can see on a weekly basis, in particular during the crisis, there is a very nice parallel trend. While after, there is this gap opening, which is due to the eligibility. So putting this into a regression, what we have here on the left is the log volume per issuance, and this goes up by about 50%. If we use this and we look at the actual aggregates, that implies a volume increase of 4 to 6 billion, while for the ineligible, it continues going down slightly. What about maturity? Maturity, in terms of days, increases by 70%, and it goes up from 109 to 146 for eligible. For non-eligible, it goes, in fact, down during this period from 91 to 59. Also important is, of course, the yield. Did it have an impact on the yield? Let me start with column 2, where we look at commercial paper below 1 month. And we do not find a significant effect. And in fact, this is not surprising, because the minimum requirement was 30 days. So these were not eligible. While we have a negative sign here in the 1 to 3 months, in the 1 to 3 months, and we see that most issuances happen there, and the funding costs decline by 13.8 basis points. Now, as a final step, what happens once the central bank leaves the market? In fact, the short maturity of commercial paper allows us to study directly this quantitative tightening. Our analysis is around the impact of the exit on commercial, and we regress on commercial paper yields and maturity and commercial paper holdings by money market funds. We'll also look at the new relationships a firm develops. And this diff and diff setup compares the impact across firms with higher versus lower reliance on the central bank. Now, higher versus lower reliance is a definition whether during the PEP episode, you as a firm were more reliant versus less reliant on the central bank interventions. So we can include here time-fixed effects and firm-level dummies for the distance to the ECB exit. So the variation we are left with is this staggered nature event on exit on firm level. So here we look at the yields and maturity. Column 1 shows you the yields. Column 2, the maturity. The less reliant firms had an increase of about 13 basis points compared to pre-COVID once the central bank exited. The more reliant ones had an increase of an extra 20 basis points. So the levels were somewhat higher. Actually, this estimate you don't see in this regression. But the levels were somewhat higher once the ECB exited in general. It has nothing to do with the ECB exit per se. But what you have here is that the more reliant firms, they had an extra 20 basis points. We see no difference when it comes to the maturity. While, let me point you to the period during the PEP, there was no differential in the yield between those that were more reliant and less reliant. They had all access to the intervention. Now, money market funds did come back. So what we look at here is the differential between more reliant and less reliant firms. Money market funds came back, took over the shares the central bank was giving back to the market. But what you can see is that those that were more reliant at the peak, they in fact, their money market funds held around, on average, 183 million less. The same is true for new relationships. This market is much more relationship-based, or is relationship-based. So a natural question is, could they, after the ECB stepped in and held a large share of these securities, could they build up new relationships with their investors, with their money market funds? And in fact, what we see is that 3.7 fewer relationships were made after exit compared to those firms that were less reliant on the central bank. Now, what about credit line drawdowns post-crisis? What we look at here in column 1 is the lock committed amount by banks to firms. And what you see is that during the COVID crisis, these committed amounts went up by about 50%. Non-surprising, they all wanted to have larger credit lines. Now came the PEP. These credit lines, however, continued going up. So there was this precautionary behavior. Even after exit, these credit lines are about 70% higher than pre-crisis levels. What about the drawn amount? That is an interesting one because during the COVID crisis, firms were also trying to get liquidity, and they were tapping into the credit lines. In fact, a threefold increase in credit line usage during the crisis, and it immediately went back to pre-COVID levels once the PEP started. In fact, here, one of the intended effects was to free up bank lending capacity, and this indicates that this worked well. We can put this together and think about what about the undrawn amount? The undrawn amount is growing with PEP, and even after the ECB exits is still very large. So in this paper, what we do, we study the full cycle from collapse to purchases, then to exit. So the collapse of the commercial paper market was driven by the runs on money market fund, which are by far the largest investors, holders of commercial paper. And they faced unprecedented redemption in March 2020. However, only 27% of lost market funding could be replaced via bank credit lines. Then came the ECB and intervened, and the effects of the market maker of last resorts were that it improved the monetary policy transmission to firms. The yields, in fact, went down, issuance and maturity went up. And it reduced credit line drawdowns of these firms and freed up bank lending capacity. Now comes the exit of the ECB. Firms that were more reliant, in fact, on the intervention faced more challenging market conditions with higher yields, less money market funding, and fewer new relationships. And with this, I want to thank you, and I look forward to the discussion.
Thank you. Over to you, Olivier.
Thank you. Great presentation. I have no legal obligation, but I feel pressure to say that these are my views, although I hope by the end they might also be some of your views. So I'm very glad that the organizer asked me to discuss this paper. It's super interesting. This is a topic that is incredibly close to my heart, direct intervention by central banks or asset purchases. I think it's perhaps surprising that it's almost 20 years that we use these policies now in Europe and the US, and there's still so much to learn. So I think this paper is a great example of that. What I'm going to do today in the discussion is to actually try to bring a broader perspective on, I think, what we know or what we think about asset purchases and how this paper fits into that broader narrative. So I think when they started, asset purchases were labeled as unconventional monetary policy. I think at this point, this is a misnomer. This is no longer unconventional. All central banks across the world routinely conduct very large-scale asset purchases program and have done so for years. And today, Isabel's actually talked about new ways that they're thinking about doing structural asset purchases. So I think these are here to stay. So what are these assets that are being purchased? Let's be very concrete. These are overwhelmingly bonds and safe bonds at that. Commercial paper is kind of rare. It's kind of a little bit different, being extremely short-term and issued by corporates. So there's going to be some interesting things to see how that fits in the broader picture. And Johannes touched a little bit on that. Specifically, the paper is going to look at one really interesting program from the ECB, commercial paper in Europe in spring 2020. So again, I'll take a step back in the discussion and try to look back and give a broader perspective on asset purchases and how they work, and then we'll see how the specific intervention comes in. Okay, and I think the paper of Johannes and Glenn is really, really interesting in thinking about the entire cycle. Specifically, I'm really going to try to tell a story, trying to see exactly how asset purchases work. So once upon a time in Frankfurt, there was a small asset purchase program. And when I'll do that, I'm going to use sometime a little bit broader and bolder statement, perhaps, that Johannes and Glenn can when they have to write a serious academic paper. So if you think it's too controversial or you disagree with what I say, feel free to chase me at the breaks and tell me what you think. I think this is interesting things to discuss. Like every good story, there are three acts. There's a beginning, the announcement, a middle, the scaling, and an end, the exit. And I think it's a great thing about Johannes and Glenn's paper that they do go through the full cycle. This is super, super interesting. And again, I think there's a lot to learn about that, even when you think about the problem more broadly. First act is the announcement. So at the beginning, there was an evil dragon. Did I say dragon? Much worse. There was stress in the money market. Much worse. I see everybody recoiling in their chair here. In a macro seminar, people might start to fall asleep, but I'm glad that you actually understand the gravity of these things. So you've seen a version of that picture, commercial paper market collapse in Europe, and with the ECB intervention and announcement of a specific program to buy this commercial paper, the market rebounded. So this is interesting that I like to think about asset purchase program as typically having two sorts of objectives. So I think this is more of an asset purchase program of the second kind. Okay, I'm a big fan of Spielberg. There's like Close Encounter of the third kind. Apparently there's different kinds of encounter you can have with aliens. Well, it's the same with asset purchases. This is the second kind in the sense that it's responding to market turmoil. It's a market maker of last resort, using the words that Johannes used. Okay? Now, not all asset purchases are like that. I think it's important to see that. For example, the first 3 waves of QE in the United States was much more about providing kind of additional stimulus to the economy when you hit the zero lower bound, and you've done a lot of other policies. Okay, so I would call this asset purchase of the first kind. Now, we're still learning about exactly how does that work, and it's a fascinating question. I think, you know, asset purchases rest on the premise that there's some imperfection in financial markets. You know, in financial market, we're perfectly integrated, incorporating information perfectly and things like that. There really wouldn't be much role for asset purchases. You could do a lot with conventional tools. Okay, so that's kind of a paradigm shift for monetary economics in terms of thinking what are the channels. Okay, and I think the channels are very different from traditional frictions that are kind of in more classical monetary models. I think asset purchases, especially of the second kind, are trying to distort prices, but in the right way, right? If you have frictions, they can be financial shocks that are going to distort prices away from fundamental. And so the point of the program is to put them in line with fundamental. So you want to cancel financial shocks without undoing fundamental shocks. So that's how I think at a high level what a lot of these programs are trying to do. Now, channels. Channels are tricky. In my mind, I like to organize it in like 3 broad channels. The first one is a very mechanical one, is buying up supply. To some extent, the demand curve, for some of these bonds sloped down, and if you buy more, the price is going to move. Okay, that's kind of very mechanical. The second, I would say, an expectation channel is about thinking about the first channel, but like anticipating it. So in the future, if I know the central bank is going to buy some bonds and the price is going to go up, then today the price might go up already. Okay, so it have information about future policy support. And then finally, crucially, especially for this kind of intervention, an intermediation channel, right? When you have imperfect financial markets, intermediaries are going to naturally arise to try to alleviate these frictions. And so a central question is, to what extent asset purchase affect the provision of intermediation? We would like to think that they can help them, but perhaps there's possibility in which they can hurt them. Okay, and so today, the paper of Johannes and Glenn talks a lot about specific form of intermediaries, which are money market funds, and whether the effect was all entirely positive. Okay, I've done some works on banks before, insurance, mutual funds. There's a lot of things to think about here about how asset purchases affect the provision of intermediations. Act 2 is scaling. So here, one observation that I often make is how often, if not always, these programs end up cornering the market. You've seen the graph on the left already. At the peak, the ECB is holding 80% of the papers issued by this firm. That's an incredibly large amount. In other markets, there's also very large holdings. So on the other side, you can see corporate bond holding by the same ECB. At the peak, it's in green here. The Euro system holds almost 30% of the market. This is the largest investors class. Okay, so that is not uncommon. Now, I think that one channel by which you get to such large scale is something that I call the expectation ratchet effect. Okay. The idea is that the expectation channel, the second one, kind of loses power over time as intervention becomes expected. And so it doesn't really mean that this channel is weaker, it's just that it's kind of mostly priced in already. Now that means that you have to rely to increase price further beyond expectation much more on the mechanical first channel of buying up the supply. You have to kind of buy more and mechanically go through the order book much more aggressively. I think one way to see that is to look at the Fed balance sheet, actually, and what happened in 2020. In spring 2020, there was turmoil in both corporate and treasury debt markets in the US, so the Fed started 2 programs to support each of these markets, asset purchase program. And it's just striking how the response of these 2 programs went. The first, the corporate bond program, was actually very new. It was actually the first time ever the Fed bought some corporate bonds. The ECB had started to buy corporate bond earlier, but the Fed didn't. And this had a big announcement effect on the corporate bond market. So large was the market rebound that in the end the Fed essentially bought very little. They bought almost nothing. Contrast this with the Treasury market program, a purchase program, that is nothing new, it's the same usual thing, and was, in spite of the large scale of the announcement, there was almost no reaction immediately. And so instead, to move the price up, the Fed had to buy tons and tons of Treasury in what we now sometimes call QE infinity. That's the big jump that you see here, where in a few weeks the Fed bought almost as much as they bought in their entire previous existence. Okay. Now let's think about exit. And I think it's great that this paper is actually being able to look at exit directly. There is more exit happening, and there's a lot of question mark about that. Specifically, there's some concern whether with exit can come trouble. And so I'll talk about two types of potential worries. The first one is coming with quantitative tightening. And I agree with Isabel that this is not a great word, but the tightening comes with this fear. This fear that as you unwind balance sheet, there's going to be a new taper tantrum. I think that is not necessarily the case. And I think the evidence supports that overall. I think by now we understand that asset purchase program are counter-cyclical policy. And so when you scale them down in good times, you are following the rule. You're not breaking it. I think if you can communicate clearly this, I think the risk for financial stability is actually minimum. Okay? I'll do a little parallel with conventional monetary policy here for a second. Conventional monetary policy has a long-term objective, price stability, and an imperfect instrument, short-term interest rate. The way it tries to reach the objective of its imperfect instrument is by trying to credibly and clearly commit to a path, a state contingent policy rule. Well, perhaps by now, unconventional monetary policy is no longer so unconventional that there's a bit of analogy. The long-term objective is financial stability. The indirect instrument is bond purchases. And there's a state contingent rule, but it's in quotation mark. It's a little bit more implicit. So perhaps there can be some gains to try to address this potential worry about QT, that perhaps they could be more clear and credible commitment to a path. A little bit what the structural asset purchase of Isabel already today, laying out the plan for future years, is a kind of a clear example of that, actually. So I'm happy to see that. The last potential worry with exit is kind of the last result that Johannes talked about, which I think is really fascinating, is this idea that potentially it can damage relationships. And there I want to do another parallel with traditional credit crunch. The usual way when there's stress in traditional bank loan market is that policy support will be focused on the liability side. That's the lender of last resort policy. That's where the market making of last resort comes in. It comes from very different style by attacking the liability side. There's a little bit this notion that perhaps we should not mess too much with the asset side because intermediaries in the end were the one that were created to try to be good at lending. And lending directly perhaps could hurt relationships and hurt capital allocation eventually. I think that matters most in primary markets where lenders and borrower actually meets and funds are actually exchanged. And this is why I think a lot of asset purchases program are tilted towards secondary market to try to let underwriter do the job. But here commercial paper is really fascinating because the market maturity is so short that essentially everything is primary market. And so these intermediaries, which are here are non-banks, in fact, in this paper, they are money market funds. The fact that they actually are doing lending on the asset side end up being important. Relationships exist and are perhaps more important than you might have thought going in. So I think it's important to think about non-banks when you think about asset purchases. I think that was a point that wasn't clear decade ago when these programs were being developed and being used. I firmly believe that asset purchases often help the asset side of non-banks, and there's still a conceptual question about whether they're preferable to more traditional lender of last resort liability targeted policies, and we should at least think about them as a joint problem. Okay? I'll just end by a statement that I feel very strongly about, that I think this paper shows very nicely, but I think hold much more broadly, which is that in the end you can't fully understand the effect of asset purchase program if you don't understand non-bank lending. The new forms of intermediation that have done more and more, especially of credit and lending to firms, what are their balance sheets, what are the frictions that they face, but also the frictions that they alleviate. And to understand fully the effect of the policy, we need to think about very carefully about these new forms of lending. Thank you so much.
Thank you very much, Olivier. Very interesting. So now we have about 10 minutes for Q&A. So please put your hand up and identify yourself. Again, thank you. And there's a microphone coming along here.
Johannes, yes, a very quick question. Eric Scotto Di Rinaldi from Rabobank. if I understood correctly, you attribute the increase in borrowing costs to the firms that used to be or became ECB eligible for their issuance, to the exit of the ECB as a market maker of last resort. But the question I have is, has the paper, or have you in your analysis considered how the riskiness of these firms changed between being before, you know, the ECB eligibility and after? Because one of your graphs does show that the issuance volumes did increase, but it's not clear to me that their balance sheets have remained as sound as they were before. Thank you.
Yeah, so maybe I'm going to answer very quickly. Yeah, so we look at firms more reliant versus less reliant. They are all reliant. So even in the group that are less reliant, around 65% in fact at the peak was held. This is the average of the less reliant group. Now, what you're saying is maybe those were more risky, and the money market funds didn't want to hold those commercial paper, and so exposed we have a differential in relationships. So yes and no. So I think what we see is very nicely that the firms. The firms are all purchased, and actually the difference between reliance is relatively small, in the sense that our control group is not firms that are not reliant at all. What I want to rather think of, you have some that are reliant to nearly 100% on the central bank at their peak. So their relationships are completely cut off. And if you think about relationships that they have to form anew after exit or during the QT period, QN period, and then indeed there's this extra challenge. So this is how we think about it.
Other questions? Maybe while you're forming your question, I could ask one, Johannes. So I liked how in your study you highlighted the flight to safety by the money market funds during the crisis, and they reduced their exposure more significantly, as you say, to the small and COVID-exposed firms. So do you think that the central bank's intervention had any effect on reversing that behaviour, or was it really that PEP was simply replacing a missing source of liquidity?
So the views expressed are those my personal views. So I think the market was indeed replaced by a market that didn't exist anymore. So what you really see is that in the crisis period, money market funds, the prime investors, they simply stopped rolling over. It was the first. It's much easier than selling something. If you face redemption as a money market fund, the first thing you do is not reinvest whatever is maturing. And this market basically didn't exist anymore. And the central bank stepped in and took for some time, took over the market. But then actually, because the nature of these securities is short term, the exit was there very, very quickly. So it was effective and it was quick.
Yeah. Another question? Isabel. Yeah.
Just a very quick follow-up. Were you surprised by the fact that only 27% of the...
Wait, you have to...
Microphone is coming. Yeah, it's here. Yeah.
Thanks. Yeah, no, very interesting. I just wanted to follow up quickly. So to what... Were you surprised by the fact that the banks only stepped in 27% of the foregone funding?
Yes, this is a
what is your explanation for that?
Yes, so everybody was scrambling for liquidity in March 2020, right? And as you can see that the credit lines, they were used, right? So the credit lines actually, so the drawn credit increased by 3 times. the amount as it was before. So the credit lines were important, but they were just not enough. And firms also tried to renegotiate, and this is what you saw, that these credit lines actually increased, but they increased still not to enough levels. So that's what we saw, that 1.27 cents on the euro could be replaced, but not more, right? So in the end, that's why I think, again, it was quite an important step for the central bank to step in and to make sure that this market it recovers, or the funding to firms recovers very quickly, because this was really at the heart of the firm. They couldn't pay their bills. This was as close as to real effects, I think, as we could get here. Oh, sorry.
Yeah, Sebastian. Yeah.
Hi, Sebastian Infante from the Fed Board. Very interesting paper and discussion. Thank you. I just had a clarifying question on the overall market. Was there a loss were there a lot of defaults? I mean, it's probably a very hard thing to answer because there were probably support from many, many other places. But I mean, was this truly a liquidity issue, or was this a credit issue? Any comments?
Yeah, excellent question. So what we know is that these are large European firms, and there was no risk of default in this sense. So the issuances, well, there's always, right, but not on this level, that if so that the riskiness would have mattered for the money market funds to stop rolling it over. So these are really the large European firms.
Yes. Ileana Pietraru from Societe Generale. I'm a treasurer for the bank. I remember 2020, when you say that liquidity vanished, it was actually a problem of maturity, because I remember we had all very short liquidity that was stacked up on our balance sheet. So it was a deep transformation between term liquidity and short-term liquidity, actually. Did you factor that in your research or in your paper?
So in what sense would it?
Well, there was liquidity did not vanish from the system, right? Obviously, it was still there. It was just instead of being invested in the medium term with the banks, right, it was left in overnight, roughly. So it was, right, there was a disintermediation between corporate money market funds and banks. But ultimately, liquidity did not disappear. It was on the balance sheet of banks in very short term.
Absolutely. And there was a lot of liquidity in the market because everybody tried to get a hold of as much liquidity as possible at this point in time. And for money market funds, this was the way to get liquidity is to basically get rid of the commercial paper, to not roll over those, and to hold on so they don't have to sell the more longer term securities.
Thank you. Thank you.
Any more questions? Yeah, near the back.
Yeah, so thanks for the presentation. It's Stefan Kreppmeier from the Bundesbank. So I would like to go again forward to the exit results, which I think are very interesting. And I was wondering to get your opinion on to what extent the other big monetary policy movement, namely the hike in the rates, might have played a role in explaining the results, given that, among other things, money market funds benefited from those hikes as they received large inflows, in particular coming from households. So could it be that the investor base of the money market funds, combined with some kind of matching to the commercial paper issuers, also played a role in explaining the differential yield effects?
So what we see exposed is that the yields are somewhat higher in general when we compare it to the pre-period. But further than that, the paper doesn't go. So we really try to make sure that the level is controlled for, while we want to look at the differential. So what we find is this differential is important to tie it to this reliance on the central bank during the intervention. We don't really go further than that.
Okay, so I think we'll draw this session to a close. Many thanks to all of you. That's been really interesting. I must say, as a central banker with responsibility for monetary policy implementation, analysing and researching the effects of our actions and interventions, I'm struck by so much learning to take away, and learning from both the US actions and European actions. So very much appreciative of that. So with just the information that we have a coffee break now until 11:30, and then our next session. But please show your appreciation again to our excellent discussants.
Okay, thank you very much, everybody. Let's start the new session here. I'm Makoto Minegishi from the Bank of Japan, and I'll be chairing on this session on the repo market. Any central banker cannot ignore the repo market, not only because it's big, but also because it plays a crucial function in the transmission channel of monetary policy. And any of us who are engaged in market operations or monetary policy implementation, unfortunately, have had experiences where instability in the repo market ultimately led to the general deterioration of financial conditions and calling for actions, very strong actions sometimes, from central banks. So that's why any research on the repo market tends to have a direct policy implication, which makes the discussion quite exciting and stimulating. Today we have the pleasure of discussing two papers, both which take advantage of granular data to come up with some insights that were not available traditionally from studies based on more aggregate data. Both of them actually analyzed the development in the euro area market, but I'm pretty sure that it has a lot of implication beyond euro market in other jurisdictions as well. So with my thanks in advance to all the authors and discussants, I'd like to begin with the first paper, which is looking at the international dimension of repo market, including the role of US dollar repo funding in the euro area market. So I would like to ask Felix to present the paper. You have 25 minutes. Thank you very much.
All right, thank you for having us and giving us the opportunity to present our paper, which is called The International Dimension of Repo, 5 New Facts. This is joint work with Mike Schmeling and Andreas Schrimpf, who's also here today. And I guess I don't have to repeat the disclaimer again, so let's get right into it. So the post-World War II era has been marked by a rise in offshore dollar markets, most notably the euro-dollar market. And this has allowed non-US banks to take dollar deficits and make dollar loans outside of the jurisdiction of the US, and in particular in Europe. And what we would argue is that today's repo market represents a modern evolution of these euro dollars, with secured transactions replacing the unsecured interbank deposit market. And just like its euro dollar predecessors, this really highlights the deep integration of banking and funding markets across the Atlantic. And so what we want to do in this paper is that we want to contribute to understanding these modern international funding markets by providing a first comprehensive study of foreign currency denominated repo activity. And we achieve this by using novel microdata based on euro area regulation, which I will talk about more in a minute. But first, it is important to mention that we define repo markets based on the currency of denomination. And this is because we would argue that euro repo activity is not limited to the euro area, just as dollar repo activity is not necessarily limited to the US. And therefore, a currency-focused approach avoids conflating currency with location and speaks to this point of breaking free of the triple coincidence, which says you shouldn't treat the currency of denomination, the decision-making unit, and the economic area as one and the same. So all of this then results in 5 facts. Some of these might be more novel to you, some of these might be less novel to you, but overall we aim to provide a framework for understanding these modern international funding markets. But okay, why is this even important to understand? So what we would argue is that on the one hand, this is important to identify vulnerabilities in the financial system and therefore for financial stability. So I guess all of us know that repo markets are key for banks' funding and liquidity management, while at the same time also being a key source of leverage for non-bank financial institutions. So monitoring this multi-currency repo activity really helps supervisors to identify channels of systemic risk propagation due to this high interconnected nature of all these financial institutions active in the market. And on the other hand, we would argue that it's also important for the international transmission of monetary policy and financial conditions. So again, monitoring this multi-currency repo activity helps us to study how shocks influencing one market, such as changes in US monetary policy, ripple through global markets. And that again enables supervisors to assess the degree of integration in funding markets and the global transmission of shocks to financial conditions. Okay, so having said that, we are ready to talk about the data before we get into the actual facts, which is the Securities and Financing Transactions Data Store, or SFTDS. So SFTDS is based on the Securities and Financing Transactions Regulation, which mandates all entities established within the European Economic Area, branches of EEA established entities located outside of the EEA, and branches of non-EEA firms located inside the EEA to report all of their SFT activity. And especially the last 2 points here are really crucial to understand why we can study the international dimension of repo, because it means that the US branches of Euro area entities, as well as the Euro area branches of US entities, do report their activity. And therefore, we don't just capture the Euro area, we also capture the international dimension of the repo market. So we focus on the repo segment of SFTDS, which is highly granular. It includes every aspect of a transaction that you can think of, regardless of currency, clearing type, counterparty, maturity, whatever you can think of. Plus, since this is an ECB data set, we have detailed information on the counterparties, which is merged from YET and Glyph. And we also have detailed information on the collateral, which is merged from CSDB. It took a lot of cleaning in the data, but the data is now clean and usable since January 2021. Okay, so having said that, we can actually get into the 5 facts. Here are all of them, just to give you a bit of a roadmap, but just briefly. So I'm going to talk about the deep embeddedness of Euro area entities in dollar funding markets. I'm also going to discuss the importance of longer-term transactions and collateral orientation. And I'm going to talk about internal capital markets as well as haircuts. But let's talk about them one by one. So the first one is that European banks are deeply embedded in US dollar funding markets. And in particular, we find that, US dollar transactions account for 40% of all of the euro and dollar denominated outstanding volumes in the data. And we believe this itself is already quite a striking fact, given that this is a data set based on euro area regulation, and still the dollar takes up such a large share in the volumes. We then go one step further and define a subcategory of dollar transactions, which we call offshore dollars. And this probably comes closest to what we would think of as euro dollars, as I said at the beginning, because these transactions do not involve any US counterparty dimension, neither in terms of location nor in terms of nationality. So these are really dollar transactions between non-US entities outside of the US. And these account for 1/3 of all of the dollar transactions that we find in the data. So what this really highlights, again, is a deep integration of European entities in US dollar funding markets, and it provides a new perspective on earlier work that argues that repo markets are geographically segmented and exhibit a home bias. And while this is still certainly true within a given currency, we always have that foreign currency component as well. So we also can look at this graphically. So these are 2 network charts showing cross-border repo activity, where we show daily average outstanding volumes here, where the arrow points into the direction of where cash would be flowing. And we distinguish between the residence and the nationality view here, first starting with the residence view, which would be where entities are actually located. And what you notice immediately is that the strongest connections are between France and the United States. But you also notice that there's a strong connection between the US and the UK, right? And this really highlights that SFTDS is able to capture that international dimension of repo, not just whatever happens in the euro area. When we then move on to the nationality view, we see that this connection between France and the United States becomes much stronger. And this really highlights the importance of French banks in global markets, because when you move from residence to nationality and the connection becomes stronger, that just means that all these French entities are operating in various locations, not just from France, obviously. Another point to notice here maybe is that the connection between the UK and the US disappears, and this is by construction of the data set. So US and UK entities don't have a reporting requirement on their own, but entities located there might. So with that, we're ready for the second fact, which is that longer-term repos, so those with a tenure beyond overnight, play a much bigger role than is commonly assumed. So when we went through the literature, we noticed that much of the analysis is restricted to overnight transactions more or less immediately. And when I say overnight, I'm also taking into account spot next and tomorrow next, so whatever has a one-day maturity. And doing this makes a lot of sense when you want to study things like the immediate reaction to shocks, for example. But as soon as you want to study outstanding data when it comes to rollover risks and these kind of things, longer-term transactions become much more important. And I guess this might be obvious to many of you, because in outstanding data, you would need 5 one-day repos to match one one-week repo. However, we still believe it's very important to stress this because the magnitudes can be very, very strong, and I will show that in a second as well. But generally, what we find is that non-centrally cleared transactions, or bilaterals, typically have longer maturities than centrally cleared ones or tri-party transactions, and this is especially pronounced in euro denomination. We also find that funding-driven transactions have longer maturities than collateral-oriented ones, and we find some evidence for maturity transformation based on dealer net positions, which I will also show you in a second. But overall, we believe this fact is very important for assessing funding stability and rollover risks that stem from the repo market. Let's look at this visually again. So this shows the maturity distribution of outstanding volumes, where we distinguish between euro and dollar denominated transactions, and we define 5 broad maturity buckets with overnight transactions or one-day maturities being the shortest and beyond 3 months being the longest category. And what you notice here when we first look on the left side for the euro-denominated transaction, that, by the way, this is the non-centrally cleared segment that we look at right now, so bilaterals. And we find that in this segment, for the euro-denominated transactions, the shortest maturity bucket, overnights, account for only little more than 20% of outstanding volumes, implying that there's a huge role for term repos in this segment. And even when you move on to the dollar-denominated transactions, you still find that the shortest bucket, so the purple part here, accounts for roughly 50% of outstanding volumes in this segment, still implying a very large role for longer-term transactions and therefore for things like rollover risks and funding stability. Next, I want to speak on the point of maturity transformation, where we find some evidence for. These are outstanding net positions by sector, where we again distinguish between the 5 maturity buckets that we define. And the 2 sectors that I want to look at today are dealer banks and investment funds. And when we start with dealer banks, first one thing to notice is that positive values here indicate net cash borrowing, or euro borrowing in this case, and negative values would indicate net cash lending. So when we then look at the dealer banks, we notice that for the shortest 2 maturity buckets, they are net euro borrowers, so for the overnight and the up to 1 week maturity bucket, whereas for all the longer categories, they tend to be net cash lenders. And this is why we say there's some evidence for maturity transformation here, because they seem to be borrowing euros short and lending them out long term. The other category that I want to discuss today are the investment funds. So here we see that they are across all maturity buckets besides the very longest one, they are net cash lenders. And this is in line with behavior that would be associated with the euro version of the basis trade, for example, where you would go short the bond, and therefore this kind of behavior would be how hedge fund would leverage such a position. When we then look at the same thing but for dollar-denominated transactions, first looking at the dealer banks, we basically see the same pattern, although with different magnitudes, right? So again, they are borrowing dollars short-term, lending them out long-term. More interestingly, maybe, is that for the investment funds, they flip their behavior, basically, when we move on to dollar-denominated transactions. And this is then more in line with the US version of the basis trade, where you would go long the bond. So again, this would be how hedge fund would leverage such a position. OK, and with that, we can go on to the third fact, which is that repo is predominantly collateral-oriented, with NBFIs playing an integral part in the ecosystem. So one key thing to study when you want to understand repo markets is whether a transaction is motivated by the need to source funding or because you want to get a specific security. So based on the US literature, we would expect that we should find the funding and collateral-driven motive to be roughly equal in importance, whereas euro area data would suggest that, that we should have a clear dominant role for the collateral-driven motive. What we then actually find is that in euro-denominated transaction, 89% of transactions have a collateral-oriented motive, whereas this is the case for 65% in dollar-denominated transactions. And you might notice me calling these collateral-oriented instead of collateral-driven. And this is because for this statistic, we look at whether there's a general collateral basket involved or a specific security. And I think all of us can agree that for the general collateral basket, this tends to be a funding-driven transaction, right? But for a specific security, this is not always super clear. And in fact, we would actually argue that you cannot perfectly disentangle the collateral-driven and the funding-driven motive from these transactions always. Therefore, in the paper, we also do robustness by taking the repo rate into account, so measuring specialness of these bonds, and then use that to define a collateral-driven segment, still finding that this would be dominant in both currencies relative to the funding-driven motivation. But we stick with the collateral-oriented motive in this presentation, and when we look deeper into these, we find that there's an importance for different kinds of non-banks with different kinds of strategies. But again, let's look at all of this graphically. So this chart here shows daily outstanding volumes by trading motive and currency. In purple, you see euro-denominated transactions with the general collateral basket, so what we would call funding-driven. Blue would be euro denomination with specific securities, so what we would call collateral-oriented. And then we have gray dollar transactions with general collateral and red dollar transactions with specific collateral. And what you notice immediately is, okay, red dominates gray and blue dominates purple, so the collateral-oriented motive dominates. However, what I also want to stress here is that the funding-driven motivation is relatively more important in dollars than it is in euros. And this can have important implications for other parts of the market, as I will talk about in a later fact, but I want to stress this already so that you keep this in mind. But regarding non-banks, here we show outstanding net positions by sector. First for euro denomination, again, positive values being net cash borrowing, negative values being net cash lending. And overall, we see, okay, dealer banks tend to be the net providers of euros and non-dealer banks tend to be the net takers of euros. But you see at the gray line at the top here that these are insurance corporations and pension funds, and they also seem to be major takers of euros, so providers of euro collateral on that. And at the bottom, you see the black category, and these are investment funds. Again, as I said earlier, they are net cash lenders here in line with the euro version of the basis trade, and you see that this is especially pronounced in 2022-23. After that, it kind of dies down. So also showing that this data, in combination maybe also with derivative data from EMIR, is able to identify these sorts of trading strategies as well. But these investment funds is also what I would like to look at here. This is the same chart, but now for the dollar-denominated transactions. And as I said before, investment funds are net cash borrowers in line with the US version of the basis trade. But what is maybe striking here is that starting in mid-2023, they are really building up that position, right? And by the end of our sample here, they are actually the major or the main net cash, net dollar borrower in our data. Okay, so then we arrived at the fourth fact, which is that internal capital markets are behind a significant amount of cross-border repo activity. So it has been shown extensively in the literature that internal capital markets are crucial for funding within banking groups. However, what we show here is that they are also very important for cross-border activity, where intra-group transactions account for 36% of euro-denominated and 25% of dollar-denominated non-centrally cleared or bilateral repo volumes. And the key locations here are the US and the UK. And this is easier to show graphically. Again, here we have simple network graphs where we show daily average outstanding intra-group volumes, and we define three broad jurisdictions: the UK, the US, and the euro area, and we distinguish between euros and dollars. So when we start on the left with the euro-denominated transactions, we see that the vast majority of euro-denominated intra-group activity is flowing between the euro area and the UK. So there's also a significant role for intra-euro area intra-group transactions, but the majority is between the UK and the euro area. Similarly, when you look at the dollar-denominated transactions on the right, you see that the majority of dollar-denominated intra-group transactions in the data flow between the US and the UK. Maybe a bit surprising because these must be euro area subsidiaries or branches located in the UK and or the US, and they seem to be doing intra-group transactions with each other, less so than directly from the US to the euro area, for example. And what we believe this highlights is that, well, London is a very important international trading hub because it seems everything is going through the UK. And we would like to stress that it's important to understand these transactions, because obviously it opens up a channel for shock transmission, right? If all these major jurisdictions are connected via intra-group transactions, there's some room for risks here, so these transactions should be clearly understood. And then we arrived at the last fact, which is that negative haircuts are a common feature in repo markets. So high quality data on repo haircuts so far has been relatively scarce. There's been notable exceptions, for example, the paper by Juilliard and co-authors who use data from the UK, as well as some recent work by the Office of Financial Research who has collected better data on this as well. And then there's a few papers that report an incidence of negative haircuts but do not really dig deeper into the empirical drivers of these. So what we do in this paper is, first of all, we document that negative haircuts are prevalent features in these markets, and especially so in euro denomination, where we find that they account for roughly 9% of outstanding volumes on average. But we also discuss reasons of why these come up. So one of them is counterparty risk considerations, market power, high demand for very specific collateral. Overall, we believe that this shows that we need a more refined view of haircuts in the repo market and as a risk management tool, and not just see them as a protection for the cash lender or a cap on leverage. And to see this also graphically again, we see here the share of negative haircuts in outstanding transactions over time, purple for euro and blue for dollars. And we see for euros, it tended to be around 10% most of the time, and now it's declined to roughly 7%, whereas for dollar-denominated transactions, it's somewhat stable between 3–4%. But obviously, this begs the question, where is this differential coming from? What makes these markets different that we see this different share in negative haircuts? And for that, we believe it's useful to go to the end of our paper, where we have two analytical deep dives. One is on US monetary policy transmission, which I will not talk about today. But the second one is on drivers of negative haircuts. And this helps to understand why we see this differential that I just shown you in the graph. Because how should we think about haircuts? One of the key factors that we find is important is collateral demand. So a positive haircut would protect the cash lender from counterparty default, but a negative haircut would protect the cash borrower from losing access to the security that they have given out. So there's these two perspectives, and that means that depending on whether the collateral-driven or the funding-driven motivation is stronger, we should see differences in the share of negative haircuts. And this is why I was saying earlier in fact number 3 that it's important to keep in mind that in the US or in the US dollar market, the funding-driven motive here is more prevalent, which explains why we see such a large difference in the share of negative haircuts between dollar and euro-denominated transactions. But this is not the only part that explains negative haircuts. We also discuss other reasons for this. One is market power. So we find that dealer banks tend to enjoy negative haircuts in that sense the most. So they, when they trade with non-banks, so it seems like they are requiring non-banks to overpay for collateral via a negative haircut. And the intuition here would be, okay, non-banks have less dealers that they actually trade with, leaving them in a worse bargaining position to determine haircuts. And a last feature that we also discuss in this context are internal capital markets, so connecting to our fact number 4, where we find negative haircuts to be especially prevalent. And one hypothesis for this could be that they use this to move relatively much liquidity for relatively little collateral, because with a negative haircut, you could be able to do that. Yeah. All right, so this rounds off our paper. So to wrap it up, I have discussed the significant USD activity involving European banks, which highlights the deeply integrated banking and funding markets across the Atlantic. I have discussed the prevalence of longer-term maturities and collateral orientation in these markets, and that there are some differences between currencies here. And I've talked about internal capital markets and negative haircuts being prevalent features of these modern repo markets that need to be better understood. And we believe that all of these 5 facts do have important implications for monetary policy transmission, financial stability, as well as any theoretical modeling that you want to do on the repo market. But with this, I would like to thank you for your attention, and I'm looking forward to the discussion.
Thank you. Mr. Jam, please. You have 15 minutes.
So thanks for having me to discuss this paper. It's a fact paper, and it's very well done. I learned a lot. I don't work in this area. After reading it, I feel I should probably start working in this area. So to start with the first summary stat table that in this paper, if you see these marked 2 red numbers, these are 2 outstanding volumes of the repo activity in euro and dollar and in the Eurozone. So you see that the dollar activity takes about 40%. And that is something, there's a notion in academic literature about market segmentation and home bias. And immediately you see that this seems to challenge that notion that literature has been documenting. And the second observation is that if you look at the breakdown of the outstanding volume in terms of overnight or non-overnight, the term contract, or even open-end, I think, and you see that actually most of the outstanding volumes are coming from repo contracts and trades are longer than overnight. And number of trades, of course, is much larger and if you compare overnight and non-overnight, but the average and the medium size of the trades are very similar. So this is also something new to me, and I'm trying to, later I will show that how this could be a natural thing. And there are more facts the paper is documenting. So they also document that there's the significant amount of collateral-driven repo activities that is related to non-bank financial institutions. And also they document, I think for the first time, the cross-border repo activities in intra-group, they call it the inter-capital market activity. And the last thing they also document is there is also the prevalence of negative haircuts, which is something usually, if you think about repo is funding driven as a protection to the lender of cash, there should be a positive haircut, and why there's a negative haircut. But if you actually later, I would argue if you think about a collateral driven perspective, negative haircut could be quite natural to think about. So here's a plan of my discussion. Because it's a paper of facts, and I'm not going to repeat the facts because I trust the scientific approach the authors has been done. So I'm going to organize my thoughts around this very topical topic at this moment about the treasury cash future basis trade. It is a relative value strategy that has been popular again since 2019. And many facts the authors are documenting here, I think, are consistent with this type of trade in the hedge fund industry. So I'm gonna talk about those when I go there. So to start with, let's just refresh your memory a bit on the futures pricing 101. So what is the future price? Future price is, let FT be the price of the future at day small t, and the settlement day will be the capital T in the future. So future contracts essentially allows you to get delivered a unit of the commodity or to deliver that commodity at the settlement day. So the price of the future contract is forced to be the same as the price of the underlying at the settlement day. I call ST. You can think about it as an index of a bond market or stock or orange juice, or if you want. So if you go long a future contract on day T, no money is change hand. And the next day, the price of the future contract is going to be FT plus 1. So you're going to get paid, or your gain or loss is going to be the differential of FT plus 1 minus FT, right? So, and as the pricing 101 tells us, the future cash flow discounted by a certain discount factor should become the current market price. So these pay off between T and T plus 1, because there's no money change hand when you enter a futures trade, the market price of that is 0. So you have this relationship. The discounted change of future price is 0. So if you just backward induct this relationship, you then can solve a formula for the futures price is essentially a discounted rolling cash return times the terminal underlying price. Or in terms of the market's risk-adjusted measurement or the risk-neutral measurement, it will be the expectation of the rolling cash return, which is in the red letter, excess the bond yield between now and maturity. That's a risk-free rate or risk-free return if you invest in bond or treasury, multiplied by the terminal settlement price or the terminal price of the underlying. Okay, then using some quick mathematical manipulation, we could express the difference between future and the spot price, which is represented by the ratio of these 2 minus 1, and decompose it into two components. One is the expected future rolling return of cash, and another is a covariance term that you don't need to worry about much at this moment, or many practitioners would just simply ignore that term because we're living in a risk-neutral world, let's say. Then, and this covariance term is 0. So if you see there's a wedge between futures and spot, or the cash, you would want to explore the fact that at terminal date, capital T, those two is going to converge. So this quantity on both end side is going to go to 0. In financial market, if you know something positive is going to 0 or something negative is going to 0, for sure, like a straight line, you should just take infinite leverage and explore that, right? That's essentially the idea of the basis trade. But this is not so simple like that because this trade is path dependent. So if you take some leverage to enter this trade, some events along the path until the settlement would actually shock you into a situation of margin call, or you would have been run into trouble. So but this is something quite popular or common in the industry with hedge funds. I think around 2019, this trade has been popular again. As an illustration, this is a long basis trade that you see that the future is above the cash bond. And to enter this trade, everybody can do that. You can short the future and long the bond at the same time, right? The return, the basis point is rather small if the holding or the investment period of this is about a month or two, you would have like half percentage point return, if ignoring all the costs and things. So one has to take some leverage to gain a significant amount of return. So how do a basis trade happen? So my hedge fund trader friend would probably start with a short futures contract, which you don't need to do anything. You just enter this short. There's no money change hand. And you need to buy the future. You need to buy the treasury, but with some money that you borrow from someone else, right? So in repo market, it allows you to do this purchasing of treasury with leverage, because that allows you to simultaneously borrow money to buy the treasury and put it down as a collateral that you use to borrow that money that you use to buy the collateral. So this sounds very self-looping, that in theory it sounds like an infinite leverage trade, right? Because you can do this as much as you can, but because there's a haircut, so there is actually a limit to that, and then you do have a leverage through this trade. So through repo, you can lever up to use portion of the cash you would need to buy the treasury while shorting the future. And then you can do this trade using a rolling strategy that you can do this trade every single day. By the end of the day, you sell the treasury you hold, and then you pay the money back to the repo counterparty, and then the next day you borrow money again from another repo counterparty, and you can roll this over and over until the settlement of the future, and then you deliver the treasury, and then you keep all the cash or things that you earn on the way as profit, right? But there is an issue here because as you can see, because of this rolling, it's very path dependent. So any movement in interest rate would just shock you when you're in the middle of this buying and selling trade, that it may actually push you to the margin, and then you would have to fire sell some other assets if you're already highly leveraged. So alternatively, traders may manage risk by financing through repo with a term that is matched to the expiration of the future contract. So you don't have to do it every day, You can buy a futures contract with a month or 3 months maturity, and then you just enter a repo term that has the same maturity that is matching that. So that seems to be consistent with fact 2 that the authors has been finding, that this seems to be also quite a common usage of repo. That is maybe not as we imagine as a funding need. So about the negative haircut, so coming back to this theoretical formula of the profit of this basis trade, right? Because this is path dependent, the left-hand side is going to converge to 0 when t goes to capital T, but on the way, it may change sign. It may go negative when you start positive, or it may go positive when you start negative. What is driving that on the path is going to be this covariance term. This covariance term is essentially composed by the volatility of the rolling cash return and the volatility of the bond return and the correlation between those two, right? So conditionally, if there is an event that shocks the bond market volatility, this term could be significant, and the correlation, if the correlation goes to the opposite direction, it could really go into the opposite direction for the trader, regardless if you're going long or short this basis trade, okay? So I think that is something consistent with factor 5, because you could go for a short basis trade, and the dealer always has a better hand in it, because when you borrow cash, they take a haircut. Now, when you short basis, you need to borrow collateral, meaning you need to borrow the treasury because you need to short. And they would also take a haircut, but now the haircut becomes a negative haircut. And that is what is somehow going on. And you see that there's more negative haircut in the Eurozone. It seems like also in line with this behavior of short basis trade, more likely in the Eurozone than the long basis. That's what's going on in the United States. I think that's also consistent with the picture. So some minor thoughts. So if you go back to see this first headline summary statistics table, the outstanding volume of repo is about 1.8 trillion. The government debt, if I do a very quick calculation, is about 80%, because there's a ratio between government and non-governments. So if you do that, it's about 1.44 trillion euros. And if I go to the tick data of the US Treasury website to calculate the total value of Eurozone held and US government debt is about $1.6 trillion. So these two numbers are roughly matching. So somehow all these treasury or government debt are held by the Eurozone institutes are probably involved in this repo activity in this market. So that's just one observation. Second, the authors documented a significant amount of offshore dollar volume. That's a purple portion of this. So about 35% of those are dollar repo, but they are not have any jurisdiction in the United States. So that makes me wonder whether you could actually check these are the Cayman Island hedge funds, right? These guys has been quite active since 2018. So the left-hand side is their treasury holdings. Actually, you can also read from the tick data set. Actually, they hold about 400 billion US government debt, but obviously their activity now goes up to 1.8 trillion. So where does those 1.4 trillion come from that they're trading, they're evolving with? And the right-hand side is a repo, right? So that's about the amount, right? Because 1.4 is through the repo, and 400 is what they hold. So that may be interesting to check. I'm not sure if what you have shown is the most recent sample, but what I received, the draft, is until 2024, April. So my final comment is maybe it's quite interesting to look at the recent episode. This is the repo activity of the Fed. So in the last 2 months, they've been quite active in our market. And the reverse repo on contrary has been fading out things 2023, I think. So it's going to be a very interesting episode ahead, and I think it will be interesting to include that 1.5 year data, which is about 40% of your full sample. That's all what I have to say. Thank you.
Okay, thanks, Felix, for nice presentation, and Chan for very nice comments. So I'd like to take a question from the floor. Okay, so gentleman at the back.
Thank you. Marco Brancolini from Nomura. And first of all, let me say the paper I found it excellent. I really found very exact as well. The parallel with euro-dollar is something I've used in the past. And now, well, I guess because I'm at the ECB, I feel compelled to ask two questions like the journalists do on the presser. And the first is on the collateral-oriented transactions. And I was wondering how you classify, for instance, a transaction that specifies German GC or a country specifically in terms of GC, and whether you've tried to slice it slightly different and you find anything interesting in the data. And the second question is, again, I found very, very interesting the analysis of the net positioning in the repo. And I think it displays very graphically, very, very plastically how it changes over time, and I think that's important. So a part of it is structural, but a part of it really depends on the opportunities in the bases and things like that, and also outright positioning. And I think, on the other hand, we can all agree that the outright positioning, well, the positioning in the outright market, so in the underlying bonds, effectively is what is a main driver of the pressure on repo. And I think you can see that very clearly in the UK right now, for instance, where you have a gilt repo 50 basis points or more over bank rate at the same time as European GC is actually trading richer. And I mean, partially is because the balance sheet is shrunk, and partially because and STR has been taken up, and we're further along onto the sequencing that Isabel Schnabel explained earlier on. But I think to a large extent is also because people are very long gilts, whilst positioning is very, very balanced in Europe. So I think it was very good from your data set that we could show that. But I believe that going forward, it'd be interesting for policymakers and partially also for market participants to have a sense of how the positioning of levered investors, so market makers and hedge funds, are trading. So, and I was wondering if you had access to other data, if you thought about it, because effectively in Europe you don't really have anything equivalent to the CFTC, and the data you've showed is very private. So, yeah, that would be my other question. Thank you.
Thank you.
Okay.
Go ahead.
So first on the GC question on whether we treat, for example, general collateral baskets with only German collateral differently. We don't in this paper. So everything that has a general collateral basket is categorized as funding driven. I did look at differences here, and it's not so easy to classify it, but we can classify baskets that are purely based on one country's sovereign bonds, another country's sovereign bonds, or even a mix of non-sovereigns and sovereigns. And there are some differences in the rates and the haircuts that are associated with these kind of general collateral baskets. But in this paper, we lump them all together, basically. And regarding your second point, I agree. It would be very great to have that extra data on who actually buys these bonds. And I don't have access to that data, unfortunately. I don't know if it exists at the ECB. If someone knows, reach out to me. I would also be very interested in that, but I don't.
Okay, thanks. Okay, Jenny.
Thank you. Very interesting paper. I have two comments. First, in the repo market, transactions usually are motivated by two purposes. One is to borrow cash, another is to borrow specific securities. So the point is the different motivations might significantly affect the repo pricing. Like the negative haircut, it's likely because they want a specific collateral. So it's maybe useful for any of your analysis separating the two motivations. Is this funding related? Is that the security related? My second comment is repo market is quite segmented. There are tri-party, bilateral. Even within each one, there is the centrally cleared and uncleared ones. And there are significant investor clientele in those markets. For example, take the US as example. Those broker-dealers only borrow from the tri-party market, and then they lending significantly in the bilateral market to the non-bank financial institutions. So again, those clientele play an important role to any of the analysis of stylized fact. It might be more helpful to give us a more institutional background. Who are the clientele in each of the segment of the repo market?
Okay, thank you, first of all. So I totally agree with the first point that, these two motivations are crucial for understanding pricing via rates as well as haircuts. And yeah, that we should always try to separate the two. But as I said earlier, it's not always easy or even possible to separate both of them. So this analysis of haircuts and rates becomes very complex because you have to take into account the two motivations, collateral versus funding, but also other things like market power, risk structures, and so on. But I totally agree with you, and this is why we do that distinction in the paper of trying to separate them as best as we can. Regarding your second point on the segments, I actually think it's a very interesting. I didn't know that you could have this case of sourcing funding from one segment and then taking it to the other one. I think that's a very interesting point. But maybe generally a few words on how we would think about the structure, at least in the euro market. And that is that we have what we would call this cleared segment would be as soon as a CCP is involved, we call this a cleared transaction. As soon as a tri-party agent is involved, we call this a tri-party transaction. And everything else that does involve neither of them, we would classify as non-cleared or bilateral. And so since you asked about the participants in these markets, we find that this cleared segment, so everything with CCPs, interbank, only banks, basically. Then we have the tri-party segment, which is where money market funds are home, basically. And then we have the bilateral segment, which we can again split into an intragroup segment and a bank to non-bank segment. So basically there's no such thing as a bilateral, don't quote me on this, but no such thing as a bilateral interbank market. But yeah, so the rest of the bilateral segment we find to be non-banks trading with banks. So this would be the institutional structure that we found.
Okay, thank you. There was a gentleman with that.
Thank you, Felix, for your excellent research and the 5 facts. I'm going to challenge you on new because a few of those facts have been in the ICMA ERCC repo survey for a very long time. But I just wanted to make two observations and ask one question. Going back to the point of whether the trade is cash motivated or collateral motivated, and you kind of intimated to this a little bit. It's really difficult when you look at European data sets to distinguish for the simple reason GC baskets are very rare. I mean, it's not a major segment of the market. Most GC involves giving a specific security. So the only way to differentiate is really by looking at the rate differential. So I think that there's probably, I'm going to guess there's a lot of noise in terms of the percentage that you quoted. Second point on haircuts, and as you rightly said, negative haircuts are nothing to be alarmed about. They're not a market failure. They can be easily rationalized. But the question goes back to, again, a fact that we've observed for a very long time in the European market, the term structure of repo. And maybe I misunderstood, but I kind of get a sense that you're intonating that having a market with a healthy term structure, what we would call a healthy term structure, is actually a risk. But maybe you could elaborate on that. Maybe it's something I misunderstood. Thank you.
Yeah, thanks for the question. So just briefly on the distinction between collateral and funding driven again. So we do end up having these 3 segments of funding driven what we call specific or oriented and the driven one. So this is so far as best as we can, but we were told, I was told repeatedly actually that for the general collateral baskets, this is first of all rare, and we also might just use specific securities in that case, but tough to identify. So we're trying to do the best we can with the rates and with the collateral indicators. But if you have other thoughts on that, happy to discuss. Regarding the term structure, fair enough. I was in the presentation, I was implying that this implies rollover and funding stability risks. But this is, of course, only one side of the coin, right? You can have the other side. If everything would be super short term, that is very exposed to, rollover risk as well, actually, and to any sorts of monetary policy shocks, for example. So there's both sides of the coin.
Okay. Fortunately, we don't have enough time, so maybe you can pick up the question during the break bilaterally. Okay. Thank you very much. So let's go into the second paper, which looks at the market from different angles. They look at the losses in the security portfolio and how they actually might affect banks' ability to lend in the market. So Dominic, please, you have 25 minutes.
Excellent. Thank you very much to the organizers for including this paper on the program. That's a joint work with Maria Assunta Giannetti, Martina Iasova, and Caterina Mendicino. Caterina is here. She's at the ECB, so the usual disclaimer applies. This is a paper about security losses, interbank markets, and how they all fit together in the monetary policy transmission to the final product, which is the credit supply to the real economy. And the motivation for this paper comes really from, back in 2023, we had a bit of a banking turmoil or banking drama, and the collapse of the Silicon Valley Bank highlighted how securities losses on banks' portfolios of securities triggered by the hike by the Fed can affect financial stability and lead to bank runs or even insolvencies. However, security losses are often overlooked if banks are well capitalized or they do not directly affect the regulatory capital. And in this paper, we argued that security losses can actually reduce the credit supply to the real economy, even in well-capitalized banking system, and even if they don't directly affect bank capital. And the mechanism you have in mind is the bank-based collateral channel of monetary policy. Sort of the starting point for this mechanism is that banks face inherent liquidity risks due to the maturity and liquidity mismatch of their assets and liabilities. And to manage the negative liquidity shocks, banks use actively their securities as collateral to pledge in the interbank markets or with the central bank to tap liquidity and counteract these shocks. And if the value of the security holdings falls, for example, due to the monetary policy tightening and the prices of the securities falls, this effectively lowers banks' borrowing capacity and limits their ability to insure liquidity risk. And for precautionary motive and to limit the exposure to future liquidity shocks, banks may reduce their willingness to provide very liquid loans to the private sector. So despite the potential importance of this channel in the transmission of monetary policy, the empirical evidence remains limited. And so that's where our paper fits in. We try to fill the gap and ask, what is the effect of monetary policy on bank lending through this collateral channel? And so to answer this question, we are going to zoom into the recent tightening cycle by the European Central Bank that started in July 2022 when ECB hiked rates for the first time in over a decade to fight the rising inflation. And this hike in the rates triggered a decline in prices, especially for long-term securities. And as banks in the euro area, but also in many other countries, hold a large fraction of their assets in these long-term securities, this triggered a large heterogeneity in security losses that banks experience. And in order to answer this question, we are going to leverage a micro-level data from the euro area on sort of the three pieces that are essential to answer these questions. First, we observe the bank ISIN level security holdings information, including the holdings, but also the prices that allow us to compute the amount of the security losses at the most granular level. Then we are going to use it to study the impact on the interbank lending and borrowing, both the secured and unsecured markets at the loan level. And finally, we will leverage the loan level firm credit registry data to study the propagation to the real economy. So before delving into the paper, let me give you a quick summary of the main findings. So the main sort of contribution of the paper is the documentation of this bank-based collateral channel of monetary policy. And this collateral channel, sort of the findings can be structured around three main lines. The first thing we look at is the interbank market, and we find that banks that experience security losses in the collateral that can be pledged in the interbank markets are experiencing a constrained amount of borrowing that they can receive in the interbank markets. Right? The falling value of the collateral makes them being able to tap less liquidity. And consistent with the collateral channel, we find that this effect is stronger for banks that are especially close to the collateral constraint, which is measured using the collateral utilization rate. And obviously, there may be other channels going on, for example, the net worth channel or the creditworthiness channel, but we do not find much evidence in support of it. So specifically, we do not find evidence of security losses having impact on unsecured borrowing that should be specifically, strongly driven by the creditworthiness. We also do not find evidence on differential impact across banks' capitalization rates. And we also differentiate across two types of securities that banks hold, those that are available for sale, those that the losses feed into banks' capital, as well as those that are held to maturity, so they don't affect banks' capitalization. And we don't find any differential effect of losses across these two groups in the access to the interbank market. Second, we examine deeper how banks manage this decline in the access to liquidity market through their intra-group borrowing and lending. So many banks belong to the banking groups, and we find evidence of a role of liquidity redistribution through the internal capital markets of the banking groups. However, there is an important segmentation there that we document. Specifically, we show that domestic subsidiaries of the banking group, so those that are headquartered in the country of the head, are able to substitute the decline in the access to the interbank market with the intra-group borrowing. However, this is not the case for the foreign subsidiaries who are not shielded from this shock and face tighter constraint. So we find evidence that this segmentation happens along the national lines. Finally, we study the propagation to the real economy and look at the impact of losses on lending to firms. And we find that banks experiencing larger security losses that cannot, that face decline in their borrowing capacity also decline corporate lending, in line with sort of this idea that the banks use interbank markets as a way to manage liquidity risk. And consistent with the supply effects, we show that the banks not only decline the quantity of loans, but also charge higher rates and shorten the maturity of these loans. And finally, we show that the domestic subsidiaries, because of this access to the intra-group borrowing and internal capital markets, are partially shielded from the shock, while the foreign subsidiaries and standalone banks are much more exposed. So this points to an incomplete banking union where these internal capital markets cannot really serve as a way for banks to share this liquidity risk. And these internal capital markets do not overcome national segmentations where local liquidity pools and deposit insurance firewalls at the national level fragment the transmission of monetary policy to the real economy. So let me skip the literature and dive directly in the paper. So a few words on how we compute security losses. So we leverage this granular data on banks' ISIN-level security holdings. And we measure the losses at the bank time level as a cumulative change in the value of security, cumulative vis-a-vis the Q1 of 2022, so prior to the tightening. And in order to overcome potential confounding impact from banks reshuffling the portfolio, we're going to keep the portfolio holdings of banks fixed at the pre-tightening period. We will normalize the losses as a share of banks' total assets. And we will construct the losses separately for different types of securities. For example, the held to maturity and available for sale will be we observe which ones are which, so it will allow us to construct these losses separately for these two groups. So this is the evolution of securities losses over time. So at the end of our sample, they are on average about 0.5% of total assets or 10% of equity. And most of the losses were realized in Q2 of 2022 in anticipation of the rate hike, and right after the rate hike in Q3 of 2022. Now, importantly, there might have been other shocks going on related to, let's say, lack of fiscal consolidation after the COVID, which might have been driving the prices of long-term sovereign bonds, which are the big chunk of securities banks hold. So in order to account for that, we are going to absorb this potential impact of political or country risk effects by including in the model, in the regression, the country time fixed effects. So in the first part of the paper, we look at the impact of security losses on interbank borrowing. And in the first column here, this is kind of the main result of the paper. We find that the banks, after the monetary policy tightening, experience a decline in the value of the securities they hold, and they are able to access the interbank markets less. Their borrowing capacity is falling. And it's quite economically significant. One standard deviation increase in security losses is associated with about 3.8% decline in the credit that they can receive in the interbank markets. Now, we find a lot of evidence in line with the collateral channel. So specifically, first, we can differentiate securities between two groups, the ones that can be used as collateral in the interbank markets and the ones that are not accepted. And we find that the decline in the value of only the pledgeable securities, so those that can be accepted as collateral, leads to a reduction in banks' ability to borrow in the interbank market. We do not observe a similar effect for the non-pledgeable securities. Second, we also differentiate banks in how constrained they are in terms of their collateral utilization rate. So some banks may have used a lot of their collateral prior to the tightening to borrow either from the ECB or the interbank markets. And those are the banks with high utilization rate, with being closer to the collateral constraints. And those are the banks that experience a larger drop in the interbank borrowing. So what I showed you in the table, we can also present graphically in the form of dynamic effects in the diff setup, where we look at the impact of these exposed security losses across banks over time. And consistent with the parallel trends, we find that there is no differential impact of those exposed losses and banks' exposure to them prior to the policy tightening. Only after ECB started the hike and banks started to accumulate larger and larger losses, we see them leading to a decline in the amount that banks are able to borrow in the interbank market. The next step in sort of the support and corroboration of the collateral channel is splitting the interbank borrowing between the repo, so the collateralized one, and the unsecured, the non-repo borrowing. And the security losses appear to have only the negative effects on the ability of banks to borrow in the market that they actually matter. So in the repo market, while they don't have any effect on the unsecured market. Next, we also differentiate banks with respect to their capital position prior to the monetary policy hike. And we do not find any evidence that there is any differential effect suggesting that alternative channels such as the net worth channel is not really what's driving the effects. In line with this, we also split the securities between AFS and HTM, and we find that the effect on interbank borrowing is very similar. So how did banks react to this decline in the ability to tap liquidity in the interbank market, where many of them are part of the large banking group, so they can use intragroup borrowing to substitute the decline in the in this sort of interbank market. So the first thing we look at is splitting the interbank borrowing into the ones that is coming from banks that are outside of the banking group and then within the banking group. And we find that this decline in the interbank borrowing is entirely driven by borrowing from banks outside of the banking groups. Now, if we zoom into within groups, it has opposite effects. It has banks are able to substitute with just tapping the internal capital markets. And it's quite sizable, but it doesn't offset the overall decline in interbank borrowing. Now, we are further splitting the banks into foreign and domestic subsidiaries of the banking groups. And we find that only the domestic subsidiaries, those that are operating in the country of the headquarters of the banking group, receive more intragroup credit in response to security losses, while the foreign banks are actually not shielded. And how does it work? If we further split the lending bank between domestic and foreign, we see that foreign banks do receive some liquidity from other foreign banks, but that's not large enough to shield them, while the domestic banks are borrowing from other domestic banks within the banking group. So there is some liquidity insurance. So overall, these internal capital markets exhibit very strong border effects due to the national deposit insurance and local liquidity pools. So in the final step of the paper, we are zooming into how these security losses further propagate into banks' corporate lending. And so we will be using for that purpose the loan level unaccredited data, where we observe bank firm borrower lender relationships, and we examine the impact of bank level security losses on the amounts that banks are willing to supply to the real sector. And importantly, we will be controlling for the credit demand with firm time fixed effects. And so what we see in the first 3 columns is that these losses that banks accumulate that constrain their access to the interbank market propagate to the real sector. We see that banks experiencing larger losses also lend less to the private sector compared to other banks. And the magnitudes are quite large and economically significant. One standard deviation increase in bank losses is associated with about 5.5% decline in lending to firms. Next, we are further differentiating between the type of securities that banks, on which banks are experiencing the losses, so between HTM and AFS securities. What we find is that overall the lending declines are primarily driven by the losses in securities that are accounted at historical cost. So those are the held to maturity securities that do not impact banks' capital position. Now, for the AFS securities, the effect is still negative, but it very much depends on banks' capital position, because those are the losses that banks need to internalize in terms of their capital. And they are larger for banks, the negative effects on corporate lending are larger for banks that ex ante had lower capital position. And finally, we provide an additional evidence that it is indeed the collateral channel driving the effects within the firm lending outcomes. So for that purpose, we add additional interactions of losses with 3 proxies for the collateral channel. The first one is the collateral utilization rate. So that's the one where we show that banks that are closer to the constraint, that they have higher utilization rate, also experience a larger decline in interbank borrowing. And those are banks also that extend less illiquid loans to firms after they realize those losses. Further, we look into the bank's differential exposure through their ex ante excess liquidity. So those are the amount of reserves that they had ex ante before the shock. And we find that banks with especially low excess liquidity before the tightening, those are the ones that have weaker liquidity buffers, and they reduce the credit by more. And finally, we also differentiate banks with respect to how stable is their funding overall. So this is a proxy for us to see how likely they are exposed to the large liquidity shocks. And we are going to measure it with the net stable funding ratio. In the final column, we find that banks with less stable funding, so lower NSFR, are the ones for which the effect is attenuated when liabilities are stable. So the ones with more stable funding are gonna cut the lending to the real economy by less. All right, finally, we are also zooming into the differential effect on credit to firms between banks depending on whether they are standalone or they are part of the banking group. And we find that standalone banks contract their lending by a lot more. So those are the banks that cannot tap internal capital markets in order to counteract this decline in the ability to borrow in the interbank markets. And then we further split the banks that are part of the banking group into foreign and domestic. And we find that foreign subsidiaries are especially more likely to contract credit by more than the domestic ones. Again, because they are operating outside of the country of the headquarters, so they are less likely to be able to tap these internal capital markets, which is again consistent with sort of this reallocation of liquidity along within the banking groups and the constraint at the national borderlines. All right, so to conclude, in this paper we document a collateral channel in the bank-based transmission of monetary policy. We show that the monetary tightening is reducing the value of securities that banks use as a collateral to access interbank markets and limit the ability that they can borrow in these markets, which further propagates into firm credit that banks are willing to supply. And importantly, we find that these differences in the banking structure between standalone banks as well as domestic and foreign subsidiaries of the banking groups may actually mitigate in the case of the domestic, but may amplify in case of standalone and foreign banks, the asymmetry in the transmission of monetary policy. And that can kind of happen at the national borderlines where banks operate in the local liquidity pools and national deposit insurance, which can segment the transmission of monetary policy along the country lines. Thank you so much, and I look forward to Jenny's discussion.
So Jenny, you have 15 minutes.
Well, good morning, everyone. Thank you for having me. It's great to be here facing this audience to talk about monetary policy, banks, liquidity, and repo collateral. I know this is going to be your favorite launch topic. Let me start let me start simple, okay? So when the inflation rises up, you know, the central banks, they try to curtail inflation, they will increase the policy rate, okay? This is quite straightforward. What is less obvious is what happens next. How this hike rates will travel quietly through the bank's balance sheet. And this paper looking at the angle from the securities held on the bank's balance sheet. So when the rate is increasing, the fixed income securities price goes down. This is the US Treasuries index. You can see it goes down. And with that happening, both the securities available for sale or held to maturity, they're going to have the unrealized losses on the balance sheet. Okay, and the US providing us a vivid example is Silicon Valley Bank. So during the dynamic, SVB was swimming in the deposit, mainly from the tech firms. And they invest largely of their deposit into the safe long-term treasuries. And then everything, as you know, inflation spiked, Fed tried to raise the interest rate. And SVB has $91 billion bond portfolio had fallen to $76 billion with $15 unrealized losses. So when SVB tried to sell some of the bonds to meet the withdrawal, it revealed such losses. And those uninsured depositors see those losses, they run. And they run faster than a Bloomberg alert. Boom. And that is the first Twitter-fueled bank run, a very classic case. So this paper, the authors try to ask, that is there such a similar channels in the usual areas? So specifically, they ask whether the interest rate monetary policy tightening, they will causing this valuation loss of security, and whether this valuation loss of securities will reduce their collaterals and further strain the bank's liquidity. And with bank liquidity, they're going to affect the bank lendings. Okay, so we all agree that at the beginning of the point, that interest rate increase will reduce the security values. We also all agree on the ending point. With bank liquidity stress, they will curb their lendings. So the point is in the middle point, these collateral channels. And that is today what my comments mainly it is. This question is important. It perfectly sits between the monetary policy and the market plumbing. So I will make some suggestions for this middle part of this collateral channel, and this is what I believe the authors can tighten the boat a bit. Okay, so let's go to the first order issues. When the monetary policy increases, they're making the yields on the fixed income securities rise too, and their prices fall, okay? And in terms of the accounting, the market value of available for sale securities will decline. But this decline, because it's only showing on the book, it's not showing on their P&L profit and losses, but it will reduce the total equity of the banks. So that's the capital side. For the holding to maturity security is different because they are using the book values. So they will have unrealized losses unless the banks sell it. This has zero impact on the net income and zero impact on the bank's equity. The most important thing is a valuation loss is not automatically a liquidity problem. You know, as central banks, monetary policy tightening, monetary policy expansion, that's a normal exercise. It happens many times. Indeed, historically, the valuation losses have very limited impact on the system-wide liquidities, okay? And then why it does not, we have not observed those things historically. Well, very importantly is this impact depending on the bank's total banking liquidities. Where is their reserve buffers? Where is their alternative funding sources? And this is also related to the overall funding environment. So that is the first important thing you need to keep in mind. Valuation loss is not equal to a liquidity problem. Next, let's see, is the valuation loss big enough to matter? So if you're looking at this figure, 3B and 6B, the left is showing the holding to maturity available for sale security losses. It's less than 1% of the total asset. If you're looking at the right panel, at the country level weighted average, all the 7 countries in the sample, all of them is less than 1% of the total asset. To give you a benchmark, according to the European banking authorities, in those 2 years of the sample period, the European banks' high-quality liquid asset is about 21 to 22% of the total asset. So far, no fire alarm, right? But as the plumbing, as if you do the plumbing, you know it, small cracks can matter in the plumbings. So the key is the micro heterogeneity might be matters. And the paper is actually show even modest this valuation shift can actually affecting the collateral value. This is a neat contribution of these papers. Now, when we're going on, we need to check what is the specialness of this European interbank market. You know, this morning you have heard a lot from Syria about the US interbank market. The two cross-Atlantic are not the same. That is when I reading the paper, my first response. Because this paper is showing security valuation loss reduce their collateral value is because of the banks can borrowing less from this interbank market. And because of that, their banking liquidity will reduce. The point is, interbank market in US and in Europe are different. In the United States, like the Schreier's paper, when we talk about interbank market, we actually refer to the short-term lending and borrowing between banks to manage the reserve balance at the Fed. So this is unsecured short-term fundings. The interbank potentially, theoretically, can also do through the secured short-term funding in the repo market. But as my paper with Sebastian also showing, the banks do not lend directly each other in the repo market. If they do, it's only lending to their affiliated broker-dealers, not to this interbank transaction. So this is what we mean, the interbank in the US. Now, we need to see the distinguishment of the euro areas. Let me borrow a slide from Mrs. Schnabel's earlier talks. Okay, so she's showing, this chart is showing the European banking interbank market. The yellow is showing the secured interbank lending, and the blue is unsecured. So takeaway point is very simple. In Europe, it's predominantly by this secured repo transactions. So that is making this paper that's more important. You need to distinguish why this interbank market matters, because Europe is different. In Europe, it does affect collateral, but in the US, it plays a very limited role. Okay, so what does this paper do? They try to check whether the security losses will cut the interbank borrowings. And they're using this setup of the regression. I will address it in 1 second. And they pretty much to show banks with larger collateral losses, they will borrow less in the interbank market, not distinguish between the AFS and the HTM. Okay, so let's, it's a good test, but I will suggest a few ways to make this paper sharper. So if you're looking at this identification specifically, they are using 3 types of fixed effect. Borrower-lender fixed effect, country level, the borrowing bank and the lending bank's country level time varying fixed effect. First, if you are using the lender-borrower fixed effect, your result is pretty much reflected within pair variation. So within each borrower-lender pair, this average, this borrowing is reducing. But this is not necessarily bilateral transaction, not necessarily reflect the bank's overall borrowings. So the key is overall borrowing matters more. It's total liquidity. It's not bilateral matters. And the controlling for borrowing bank and lending banks country by time fixed effect. This is not sufficient. We all know banks' liquidity, banks' credit condition, they play a big role to their lending, even in the interbank market. So we need to include in this bank time fixed effect, or at least controlling for the bank levels liquidity and credit condition. More importantly, this data is at the loan levels. For each of this loan, and your topic is collateral. You know, we study their loan amount, but loan price can affect loan amount, loan maturity, and loan collateral type. All all of those loan level characteristics can affect the loan amount. So you also need to controlling for those characteristics to tightening these regressions. And ultimately, it's not the interbank that kind of borrowing matters. In order to affect the bank's lending, it's the bank's total liquidity matters. So my suggestion is, first, in the interbank market, instead of looking at what is the banks borrow, looking at their net borrowing. Because banks both borrow and lend in the interbank market, and it's pretty much in the equal kind of magnitude. So the net matters. Outside the interbank market, you should examine the substitution across different funding sources. From today's Mrs. Schnabel's talk, we also see there's a lot of these refinancing facilities. Banks heavily use it. What is their access to central bank facility? What is their access to wholesale deposit and intermarket? Those things matters. Like my paper with Arvind Krishnamurthy showing, if you want to understand a bank's liquidity, you need to look at both the asset side market liquidity and the liability side funding liquidity. All of them matters for this liquidity. If you have less interbank borrowing, this might not necessarily mean the less liquidity, because if the liquidity is offset somewhere else. And also, we need to consider the context. This is again borrowed from Mr. Schnabel's one of the keynote speech 2 years ago. So, and this Jonas also mentioned in his second paper this morning, there is a significantly Fed unconventional monetary policy, for example, the PEPP, APP, and things. So beyond those policy rate increase, you also observe this shade blue area, that is excess reserve. So we are in the ample reserve period. Banks have tons of liquidity sitting on their balance sheet. And if this is a country level information. So with such record high excess liquidity, interbank funding still matters. If you can get access from the central bank and alternative, and controlling for the bank level reserve ECB facility, it actually matters to tell the audience whether it's uniquely this interbank market or it should go beyond this aggregate liquidity market. Lastly, this paper shows something very interesting within this intra-group liquidity transfers. And the paper's finding is that the banking groups reallocate liquidity towards subsidiaries with losses, substituting for the interbank borrowing. But this is only works for the domestic subsidies. Okay, so let's think about some simple examples. Suppose I don't know how to pronounce its name, Unit Credit Bank AG, that is a German bank, but it's under the Italian parent. So they have a bank subsidiary in both Munich and Hamburg. Why do they have significant different security losses large enough for one to transfer liquidity to the other? You can imagine they all under similar guidelines by their parent, but why they're significantly internally heterogeneity? Who coordinates such internal transfer? Is that its headquarter companies or the branches? And what incentives and terms to govern these internal loans? Those are all the important questions. And also, this bank has foreign siblings all under the Italian parent. So why do their Italian siblings want to transfer liquidity or the vice versa? Is there any frictions for this internal transfer? This is a super interesting word, but I think a little bit more institutional color can make this story much richer. So in the end, I think this paper tackles very timely and critical questions. That is how valuation losses on securities, they do affect monetary policy, not through threatening the solvency, but rather tightening the liquidity. But the authors can use their regulatory data in the granular data to tightening some of these bolts to make the analysis sharper. But I think this paper can make more contribution to understanding bigger questions. As I said, historically, valuation loss have very limited impact on the system-wide liquidities. The key is to understand under what conditions monetary policy tightening might trigger liquidity pressure, when and how and whom. As we have learned again and again, valuation losses rarely matters until the moment they do. Thank you very much.
Thank you, we're right on time. So let's take questions from the floor. Yep.
Thank you very much. Very quick one. I did not see, or maybe I missed it, any remark regarding hedging practices applied in banks, especially when dealing with valuations. And given your example related to SVB, which has been documented for not having very strong hedging practices, I wonder if that should be part of the analysis as well. Thank you.
Yeah, so that's an important question. Thanks for that. So hedging is going to be very relevant when you have available for sale securities. So those are the ones that you need to account for in your capital position, and that's going to mitigate the impact. For the securities that you pledge as collateral, hedging is not going to be that relevant because it's just the mechanical value of the collateral that matters for how much you are able to borrow. So for liquidity purposes, it's the actual value, with or without hedging, that matters here.
Okay, who's that lady over there?
Hi, thank you. Angela Maddaloni from the ECB. So I have one observation is, it links a bit to the discussion of Gianni. These valuation losses most likely have induced also some portfolio reallocation, I guess, and also possibly some reallocation in the collateral that is pledged also to the central bank. So I wonder if you have looked at this. And the second thing is an idea when you look at corporate lending, if you have looked at the sectoral implication, because I was thinking maybe basically banks finance only certain kind of loans, only to certain sector. Sort of marginal loans to specific industry that are financed through this channel, and this would sharpen a bit, the identification of why you have this kind of effect.
Thanks so much. Thank you also, Jen, using this opportunity for the excellent discussion. So So actually, what's surprising is that banks do not really sell those securities, neither ahead of time nor later. And the issue here is related to the regulations. So if you have held-to-maturity securities, which are the biggest chunk of banks' portfolios, you are effectively not allowed to sell them because they are held to maturity, right? So if for example, in the US, it would taint your entire portfolio, so you would need to account for market values of your entire securities book if you were to sell. In Europe, you need a special sort of approval for selling them, and it did not really happen. So even if we were to compute the losses accounting for some of the sales, which would be primarily the available for sale securities, the results are effectively unchanged because the available for sale securities are a smaller fraction and mostly short-term, so smaller losses that they account for. Now, in terms of how banks use collateral, between interbank market and sort of the central bank, what's interesting and what probably contributed to the fact that this had such strong implication is that ECB, at the same time as they started the rate hike, they also constrain the amount of liquidity that they provide to banks through the TLTRO. So banks had to, they effectively faced with higher costs of borrowing through TLTRO, they repaid it. So they had to shift some of their borrowing from the central bank into the private market, where haircuts are higher as well. And so that's kind of this sort of, it kind of worked as a double-edged sword, that the hike coincided with the tapering of the liquidity. And we exploit in the paper some of that. We look at the sort of how banks were ex-ante reliant on central bank liquidity, and so those are the ones that especially had to shift to the private markets, and they are transmitting the liquidity shock through the decline in security values by more. Now, on the comment for the sectoral allocation of credit, I think what we do in the paper is that we try to isolate credit demand, because that's one of our worries, that banks may be exposed differentially to different firms or sectors in the credit that they provide. So we zoom in within a firm borrowing from two differently exposed banks to security losses, and that's kind of how we isolate the supply effects. But it would be definitely interesting to think how it might have shifted the supply across different sectors. We can look at that. Thank you.
Thank you. There was a question here.
Yeah, Francesco Papadia from the Bruegel Institute. Following up on this discussion about the connection between collateral for borrowing on the private market and collateral borrowing from the central bank, what can one extract from your evidence about a different issue, which is the possible easing or constraining of monetary policy that comes from changes to the collateral framework of the central bank? So how far can we be more specific on this issue, drawing from your evidence, just from saying, oh yes, if you loosen the collateral framework, it will ease monetary policy, if you tighten it will tighten monetary policy. Is there evidence that can make this statement more precise? Thank you.
Yeah, I think, so that's kind of related also to my earlier work, which, when you think about the policy of the central bank in providing liquidity, I mean, I think that the haircut policy is extremely important, and that's kind of like how ECB acted as a lender of last resort. Banks were able to tap their funding, and especially were able to pledge the collateral that was kind of high risk, but because of the more favorable haircuts that ECB provided compared to the private market. So I think it really matters how much value in terms of borrowing you can extract from a unit of collateral, and it's both the market value that matters, but also the haircuts. So I think there is obviously a complementarity there. Now, iterating sort of an earlier point, I think that the tightening of the liquidity provided by the ECB coinciding with the rate hike is something that, even though banks may have ample reserves, but sort of their ability to borrow against the collateral they had really shrank from both the central bank and from the private market, which why the propagation to the real economy was so strong.
Yeah, okay. Any other questions? Okay, go ahead.
Giuseppe Morafino, LMR. Thanks for the paper, very interesting analysis of this channel of monetary policy transmission, the collateral channel. My question is for the discussant, to be honest, in the sense that I want to understand why in your presentation you consider the ratio between HQLA and total assets. In reality, it should be HQLA versus expected net outflow for the liquidity cover ratio. Because in the context of sell-off on government bonds, my HQLA decline, LCR decline, ceteris paribus. As a bank, I want to increase the reserve share to be more protected in case of outflow. So this is an important channel, in my opinion, of propagation of collateral devaluation to lending volumes. And exacerbate, I would say, the tightening impact on policy rate tightening. Thank you.
I appreciate the question. I'm not studying the European market. I think that is important, as you mentioned. So I have very limited access. I tried my best to get the public data on the Europe. I'm much familiar with the US market. So that's the only thing I got it is HQLA by the total asset. That's what I found. But your question actually inspired me to think if I do a study on the European market, it's crucial to looking at the component of each HQLA and their relationship. If I can have those access to the data, I think I probably can do much better job. But so far, all I have, I don't have the regulatory data. All I have is based on the public information, and they don't show such things. So that's a simple reason. Yeah. Thank you for your question. US, I can do that. Yeah.
Okay. Maybe one more quick question, see if you have any. Okay, go ahead. Can you make the question very concise? Yeah.
So you talked about isolating the demand effect, but I think it also has to do with pricing, right? It could be that banks restricting loans because the securities lose value, but it could be also that they lose access to cheap funding and offer higher pricing for the firms which say no. How will you get this?
Yeah, so we looked at the loan rates, and that's, because the quantity is falling and the rate is increasing conditional on the same firm, we interpret it as the shift in the net supply of credit. So yeah, it's not just the quantity dimension that is changing. It's also the rate and also the maturity being shorter. That's kind of telling you that banks are maybe willing to provide credit, but at way shorter, more liquid, way shorter maturity that are effectively more liquid loans that are to be repaid sooner.
Okay, thank you very much, everyone. It's very nice presentation, nice discussion, and a lot of nice questions from the floor, which makes our discussion quite lively. And also, there are a lot of issues that we have to think about going down the road. And if you have any further questions, maybe the authors and discussants were happy to discuss bilaterally during the break and lunch. So thank you very much, with big hands to present.
Thanks so much, Jenny. If you could send us the slides, that would be awesome.
Welcome back to the conference. I hope you had a good lunch. Didn't get too cold. It's the cold corner in the building. And we have a wonderful speaker to warm you up. Jeremy Stein doesn't really need much of an introduction, but that's what I was asked to do that anyway. So Jeremy is the Moise Safra Professor in Economics at Harvard. And he has also been at the Federal Reserve as a governor and served as senior advisor at the Treasury, the secretary, and if I get it right, was also before that on the staff of National Economic Council. So that's basically where we're next to the White House. And I remember that very well because we had very interesting conversations during the crisis about what to do with failing banks and whether they need to be restructured and the like. And that was wonderful, and I have very fond memories of those conversations, Jeremy. But I got to know Jeremy really from the literature because we have a little age difference, and I had to study all those beautiful papers that are crystal clear the way they're written, but also it's really impressive because it's increasingly rare in academia to be broad and to span more than one field, and Jeremy spans at least 3 fields. So you have basically financial intermediation, monetary policy transmission, and market functioning. And the beauty of that is this spans exactly the 3 organizing business areas here, so it's of interest to everyone. And I think beyond that, what increasingly is very clear in your work is that you are bridging from academia to policy. I mean, of course, having been also on the other side. And I think that's, to most of us here today, you're known for that, in particular, the interaction between market structure, central bank balance sheet design, etc. So it's really how to bring models, also to combine them with practical policy insights. And then all the public service you've done, editing the leading journals and the associations we all care about and all that. It's too much to name. So we have a very interesting paper by Jeremy with some very long-standing co-author and some more recent ones on the treasury market dysfunction and what are possible implications for the central bank. It's very much written from a US lens, but you are allowed to ask questions from a Euro area perspective. I encourage you to do so. But before we open for questions, the floor is Jeremy's for 40 minutes or so, and I get out here. Thank you.
Thank you, Luke. Thanks very much. I especially appreciate the reference to my age. Yes, really. Yeah, so this is a joint project with Anil Kashyap, Jonathan Wallen, and Josh Younger. Just to give you some motivation you probably don't need at this point in the conference, we started out thinking about, and again, this is sort of US-centric, we started out thinking about events in the Treasury market in March 2020. Just a really, really quick recap. There was a ton of selling. Roughly, you can think of that as coming about 1/3 from hedge funds, about 1/3 from bond mutual funds, and 1/3 from foreign official accounts, foreign central banks, okay? And that amount of selling, each of those were sort of on the order of $200 or $300 billion. So cumulatively, that sort of overwhelmed the dealer community, which manifested in a bunch of different ways. Trading liquidity in the bonds, in the treasury bonds was badly impaired, especially in the off-the-run issues. The ability of the dealers to intermediate repo, i.e. the spread between the rate at which they borrow in the repo market and the rate at which they lend widened, and a bunch of other things. So the Fed stepped in. They did various things. They started out trying to repo lend. They at some point excluded treasuries and reserves from the leverage ratio. None of that was sufficient, so they come in and they buy just an enormous quantity of bonds. And just to remind you of the scale, there was a 10-day period where they bought almost $700 billion of bonds. That's $70 billion a day. We thought we were doing something pretty big with QE3. That was $85 billion a month. So this was just enormous, ends up being about 1.6 trillion by the end of May. And one of the things I sort of want to draw your attention to is the tension that this, so on the one hand, I think as a pure market function thing, this was overwhelming force and it was successful in restoring market function. Question I want to kind of have you guys thinking about is, were there any costs? And one cost I want to kind of highlight, unlike I think the Bank of England later on with the LDI episode, they did not do a great job of drawing a distinction between market function and monetary policy. And in fact, if you read the various statements, the first one, I guess in March or whenever the first thing was market function. And later on, it starts talking about market function and the effective transmission of monetary policy. And it all starts to kind of bleed in that direction. And I think not coincidentally, they end up just doing an enormous amount of bond buying. I think the whole episode from start to finish ends up being something like $4 trillion. And you can ask yourself whether this is costly. Ex ante, it's sort of treading to some extent on the role of the finance ministry by overriding their debt maturity decisions. Ex post, this ended up being very costly because there was inflation and rates went up, so the Fed ends up losing a lot of money on this position, which is it's a real cost to taxpayers, much as if the Treasury had decided to dramatically shorten their debt maturity. And then there's this confusion with monetary policy. And just to make that feel a little bit more salient, imagine this happened again. And now we're in a world where inflation is running above target. You don't want to come in and buy a ton of bonds and have people think that you're easing monetary policy. So that's kind of the problem that I want to have you focus on. Anyway, so what do we do in the paper? We're going to try and talk about I'm going to try and talk about three things. One is just to understand kind of how the interplay of various actors in the market creates some fragility. I'm just going to sort of tell you a story of sort of the genesis of the fragility. I'll show you some data which kind of is consistent, and then ask, if this is the story, and if you believe the story I'm telling you, what does it say about how the Fed might do this differently next time? Okay, that's kind of what I want to get to, is sort of a policy thing, but I want to get there by kind of telling you a particular story about where market function comes from. All right, so depending on time, I may do an equation or two, but I think I can kind of do the story in words. So there's basically three players in this thing. What I'm going to call the asset managers. By this, think of this as some mush of pension funds, insurance companies, and bond mutual funds. Okay? Then they're going to be relative value hedge funds, and then there'll be the primary dealers. Okay? So the people that I'm calling the asset managers, they're going to be the only ones in this model who actually are long duration. That is to say, long interest rate risk. But the key assumption that I'm going to make, or that we're making about them, it's empirically accurate, is they like to take some of this duration risk by holding the physical treasuries, but they like to take some via the derivatives. Okay? And what's the story for that? One way to think of it concretely as a pension fund or a life insurance company. On the one hand, they have long duration liabilities, right? So just sort of matching duration would suggest they'd want to have long duration assets. Okay? So one way they could do that right away is just buy a bunch of 10 or 20-year treasury bonds and be done. Okay? But you might want a little bit of extra interest or extra yield. So a way to get some yield is, in addition to having the duration, is to take some credit exposure. Okay? So at some level, the ideal security for them might be like a 10-year corporate bond, right? Because then they'd have the right duration and they get some extra compensation for the credit risk. Problem is, there just aren't that many long-term corporate bonds in nature. Certainly not nearly as many as sort of the demand coming from this very, very, very big sector. So what's one way to do this is you synthesize for yourself a long duration corporate bond by holding shorter maturity credit physically and some derivatives on top to lengthen your maturity. Okay? So that's kind of the primitive friction that drives everything. Okay? These guys have a demand to hold some extra duration in derivative form. Okay, then I'm going to be a little mushy about whether the model is too simple. I'm going to be a little mushy about whether it's futures or swaps. I think empirically, bond funds tend to be more futures. These other guys tend to be more swaps. I'm going to kind of blur that distinction. Okay? But think what that does. There's sort of this demand for, I'm going to call it the futures, but there's this demand for futures that's going to push up the price of the futures relative to the physical treasuries. Okay, so you've got this sort of incipient pressure on that spread. Okay, in is going to come then the relative value hedge funds, right? They're going to take the other side. In so doing, the economic service that they're providing is basically warehousing. In other words, the asset managers didn't have enough balance sheet to do this all on balance sheet, so they're going to end up renting some balance sheet from the hedge funds who are going to have to be compensated in equilibrium for doing that. Okay, so the hedge funds are going to be short the futures that the asset managers want to be long, but then they're going to hedge by holding the physical treasuries. That's they're doing the warehousing of the physical treasuries. Okay, in equilibrium, you'll see the spread is pretty small. The spread is pretty small. You know, think something like 5-10 basis points wouldn't be all that interesting, but for the fact that you can lever this thing very dramatically, right? You can get a lot of repo against treasuries. And so, you know, if you can lever it 99 to 1, then the 5-10 basis points becomes sort of interesting. Okay? So that's going to be the hedge funds, and that's sort of the story there. And of course, you can see that's going to build in some fragility if the way you make this work is with 99% leverage. And then the last set of players are going to be the broker-dealers. And you can think of them in normal times as basically doing two things. One is just market making, buying and selling treasuries. The other is intermediating the repo market, borrowing from borrowing in the tri-party market, say from money market funds and lending on to hedge funds. And then they're doing a little bit of this basis trade. I'll show you the data, but you know, roughly in normal times, 90% of it is being done by the hedge funds, and the sort of secondary bit of it is being done by the dealers. But of course, then what can happen? That's what I had here. You know, normal times, the dealers, they've got their capacity. They're allocating it primarily to sort of dealer stuff. Okay, as the treasury market is growing, the asset managers are demanding more of the derivatives. That's leading the hedge fund position to get bigger and bigger. And then there's some fragility. In March 2020. I think one way to tell the story is that as volatility in the bond market went up, the futures exchanges started asking for more margin. And again, if you're levered 99 to 1, if they ask just for 1 or 2 or 3% more margin, that's very large in a relative sense. That forces the hedge funds to delever. So they're now selling this stuff. Who in the short run steps in? It's the dealers. Okay? But now the dealers have a sort of certain amount of balance sheet capacity. If they're going to start doing more to absorb this, they're not going to have as much capacity to do the other stuff. And when they're balance sheet constrained, sort of the most simple first order condition is going to say if the basis spread spikes, other things are going to have to spike too, because they're going to have to be sort of equating things on the margin. Okay, so under stress, you're going to get not only the basis widening, maybe you don't care deeply personally about the basis in its own right, but that spike in the basis is going to be very correlated with liquidity in the treasury market drying up, with repo intermediation spreads, because again, the dealers are kind of on the margin of all of these. Okay, so that's going to be kind of my story of how you get fragility. Okay, what's a policy kind of thing? And again, let me be careful. I don't want to argue that a frontline policy response should be Fed bond buying, okay? And in fact, you can be agnostic roughly as to how good or bad you feel about that. You might say there's a lot of moral hazard. I want to make a much more qualified argument, which is suppose the Fed finds itself in a position where its judgment is this is pretty bad and we need to buy bonds. So conditional on buying bonds, I would say, why do you need to buy them outright? Okay, you can think about this two ways. One way is, what are the hedge funds liquidating? What is the nature of the fire sale? They're not just they were fully hedged, right? They're doing a relative value trade. Okay, so what are they unwinding? They're unwinding a package that is long the treasury and short the future. Okay, so what does it mean to absorb the other side of the fire sale? You can absorb that same thing, which would mean buy the treasury and sell the derivative. Okay, that's one way to think about it. a little bit stronger, I think, is even if the selling hadn't come from hedge funds, okay? Suppose the selling, as it did in 2020, came in large part, sort of was naked selling by, say, foreign central banks. There's a core fact here, which you may or may not know. I didn't know. This is Jonathan Wallen's fact. The dealers are always duration neutral. You think of them getting kind of bombarded by all this selling. They are getting bombarded by selling of physical treasuries, but they always hedge it. Okay? So their problem, the problem the dealers had in March 2020, was not that they were overloaded with duration. Their balance sheets were stretched because they were absolutely taking a much bigger position in cash treasuries, offset by a bigger position in derivatives. Okay? That, for a variety of reasons, leverage ratio, basis risk, whatever, that does stretch your capacity, but not because you're eating too much duration. So the Fed, if the Fed's goal is to sort of unclog the dealers or take stress off the dealer balance sheets, it can do that without taking a naked duration position. It can do that by buying the physical and hedging. Okay, that's the core of our argument. And then it's not that that's problem-free or moral hazard-free. I'm going to try to convince you that that may be better in a relative sense than doing the just naked buying duration. You can't confuse it with monetary policy anymore. It's not designed to lean against the term premium because you're not taking, our standard theory of QE is you take interest rate risk out of the market. Here you're not doing that. Okay? It doesn't expose you to losses because, again, you're not taking interest rate risk out of the market. So it's a sort of qualified argument to say if you were going to go do bond buying for market function, one way of making it very clear that it's market function and non-monetary policy is you can do it on a hedged basis. And at least if you believe our diagnosis of the problem, that should basically have the same positive effect on market function as doing it unhedged. Okay? So that's the basic argument. All right, I'll do a couple of equations. So this is a very, very simple model. It's just got one period. So I'm going to define, there's going to just be one period zero coupon treasury. I'm going to call its price, anyway, PT is the price of the treasury, PF is the price of the future. It's just a one period model. So if there was sort of perfect arbitrage, the price of the future would be the price of the treasury times 1 plus the short rate. Okay, we're going to imagine situations where there's a violation of this parity thing, and I'm going to call X the basis. And the sign convention is that a positive X means that the future is expensive relative to the cash treasury, so the indicated arbitrage is going to be to sell the future and buy the cash. Okay, so that's the basis. As I said, I'm going to have three sorts of players here. The first set are the broker-dealers. I'm going to assume, and I'll show you some kind of remarkable data, that they're hedged, that they just don't take outright, they take basis risk, but they don't take outright interest rate risk. So I'm just going to assume, it does, okay, oh yeah. So I'm just going to assume that their long position in cash treasuries is exactly equal to their short position in futures. Okay, and I'm going to say again, as I said, to start, I'm going to make it very simple. They just do market making and a little bit of this basis trade. And they have some balance sheet, total amount of balance sheet space that they can allocate among the two. Okay? Skip a little bit. The basic obvious thing is there's going to be, if the balance sheet is in a constrained situation, right? So if their balance sheet's scarce, the basis spread X is going to be proportional to the market making spread. Okay, in other words, you're going to kind of allocate capital efficiently. So if one goes up, you're going to draw capital away to the point that these things up to a sort of constant of proportionality are going to be equal. So first empirical prediction is under stress, there's going to be correlation between market making and basis spread. Okay, and how much will the dealers want to buy treasuries? Well, it'll have to do with their total capacity. They'll do more when the basis spread is bigger, and they'll do less when market making opportunities are good. Okay. Hedge funds are sort of similar. I'm going to make these guys just basically do, these are not all hedge funds, these are sort of the relative value hedge funds that trade the basis. Key assumption here is that they do that with very little equity. Okay, so 1 minus gamma is the amount of repo that they use. So these are their returns. They also have some other activity that they can do, just to kind of give them a bit of a trade-off. And so, you know, how much are they going to do? Again, they're going to be fully hedged. They're going to do an amount that has to do with their total capacity, again, the basis, and some measure of their other opportunities. But again, we're getting some gamma squareds here, which is telling you just that this leverage is really important. When gamma goes to 0, their positions are going to get very big. Okay, that's kind of the key point. They're going to be super sensitive, even a small basis. What this is saying is even a small basis can drive enormous demand if you can lever. Okay, it's kind of intuitive. All right. And then finally, the asset managers, they're the only ones who actually take interest rate risk in this model. Okay, as I said, I'm going to assume that they do it by doing both cash and treasuries, some mix. I'm going to make a very crude assumption that they just decide they always want a fraction of their exposure via the derivative. Okay, that's very crude. I think a better sort of fuller model would have this theta depend on stuff. Like if credit spreads were big, they really, really want to have more credit in their portfolio, then they need to do more derivatives. If credit spreads were to collapse, they would be like, I can do this all on balance sheet. Okay, but just as a sort of very simplifying thing, they're going to have this sort of inelastic kind of cash futures trade-off. Okay, and again, the broad motivation here is this is an enormous kind of industry, but there's just not that many corporate bonds of long maturity. So if the ideal thing for you is a long maturity corporate bond, this is one way to get it. Actually, another little piece of intuition is think about, and maybe this is most mechanically like the model, think about an open-end bond fund. Okay, so, and imagine it's trying to match a benchmark. As the Treasury issues more debt, because Treasury debt tends to be longer maturity, right? That's going to just mechanically push out the maturity of the duration of the benchmark. And then they're going to want to basically keep up with that. And derivatives is one way of doing that while not abandoning having some credit exposure. Okay, so that's a pretty mechanical sense in which they're going to want to do some, and in which their demand for the derivatives will be kind of yoked to total Treasury supply, which we're kind of doing here. Okay, and so these guys, we are having them take duration risk, and then this is just, you can think of this as just a simple mean variance kind of trade-off. This is now their total duration exposure. I'm just going to assume it's proportional to the term premium. And the only trick here is I'm expressing the term premium as a weighted, the long side of the term premium is a weighted average of the return you get by doing it synthetically and the return you get it in cash, because that's kind of how they're doing it. But this is effectively, in our model, this is the term premium, and A is like some measure of their risk tolerance. Okay, so that's that. Okay, and then it's pretty, you don't need to look at all the math. There's basically 2 markets we have to clear. We have to have the total demand for treasuries equal the total supply, and we have to have net zero demand for the futures. Okay, so I'm going to clear the cash treasury market, clear the futures treasury market, and then this decouples exactly as you think it should, which is since the asset managers are the only ones who are long duration, right? The term premium is going to be completely determined, this is number 9 up here, is completely determined by the supply of treasuries relative to their risk tolerance, right? They're the only ones who are eating the duration. And the basis, the only guys who are playing the basis are the hedge funds and to a lesser degree the dealers. And so the basis is going to be tied down basically by their behavior. Okay, it just decouples. Okay, and you can see, by the way, the basis mechanically increases so this is the first kind of important implication. Treasury supply goes up, the basis goes up. Why? Because the asset causes the asset managers to demand more futures. That basically puts pressure on the basis. That also then draws in more hedge funds. So you'll see that the hedge funds' positions goes up as well when the Treasury market gets bigger. Okay. And then you can ask what happens if we put this market under stress. I've done the simplest possible experiment here. I've just said, suppose for whatever reason, the hedge funds blow up. Could be because of margin calls. It could be because some of their other trades have gone bad and they've been forced to. Suppose they basically just step out of arbing this thing. Okay? So before, obviously, their risk tolerance and their capacity was very important. If you take them out, all that's left are just the dealers, and so now it's only the dealers' capacity that's going to set the basis, and that's going to give you a big spike in the basis, right? Because you've just taken out the primary players. Okay, so that's kind of an account of fragility. Okay, I mean, people sort of know this story, know about the hedge fund basis trade, and this is just kind of a model of that. All right, let me just show you. Oh, another thing you can do here is just, this is for free, basically. Up till now, I have assumed that the hedge funds can borrow essentially at the riskless rate. There's no kind of repo spread. It's very easy to add a repo spread to this market. Assume that basically the dealers have to use some of their balance sheet space to intermediate the repo market. They borrow, call it at the riskless rate, but they turn around and lend at a spread. If that consumes some balance sheet, now you're going to have all these spreads co-moving together. The repo intermediation spread, the basis, and measures of market liquidity under strain will all kind of co-move together. If that's the case, that's going to create one more source of problem that's going to force the hedge funds to unwind. Okay? Let me say two things. On the one hand, something like this is good motivation for something I'm kind of fond of, which is the idea, and I was involved in a G30 report with that Tim Geithner led with Darrell Duffy and Pat Parkinson, where we were trying to make the case that the Fed should be willing to repo lend to anybody that could bring Treasury collateral. It was about bypassing, essentially, the dealers when their balance sheets were clogged. Okay? So on the one hand, this makes that sound like a good idea. Maybe, I mean, barring other considerations. On the other hand, it also makes it clear it's not a panacea, because I got a pretty big problem going even when I assumed the repo market was functioning completely frictionlessly. You know, the fundamental problem is really kind of a wealth shock for the hedge funds. It's not just a liquidity problem. So, of course, giving them liquidity on better terms may be helpful, but it may not be kind of a panacea. All right, so let me just show you some facts. Okay, so this first fact just comes directly from a paper by my colleague Jonathan Wallen with Lena Liu, who's at the Boston Fed. And again, maybe many of you knew this. I didn't, and it was super eye-opening for me. So what they did, they were able to get from confidential Volcker Rule reporting data. They're able to see for the biggest 5 US dealers at the daily level for each trading desk what their risk exposures are. So they just literally report their DV01, which is sort of how much their portfolio moves for a 1 basis point change in rates. And this is for their aggregated position, derivatives plus cash. Okay? So the top graph is essentially their DVO, the combined DV01 of these dealers. And the units are such that, like, the biggest number you ever get here is 20 million, and a 20 million DV01 is like saying it's the same interest rate exposure as if you had 20 billion of 10-year bonds. Okay? Not a whole lot, and that's the biggest it ever gets. And what I really want you to see is around 2020, they were pretty much flat. They were pretty much flat. Okay? So they're not taking interest rate risk. Okay? The bottom thing is saying, well, what are they actually holding in physical bonds? I want to, by the way, this is already an understatement because it's cash, but it's netting the long cash positions against the short cash positions. So there's already some of the hedging in this, but you're already an order of magnitude or more bigger. This is sort of 250 billion. So of course, it's absolutely the case that when there's a lot of selling of bonds, they're on the other side and they're buying bonds, but they're not getting long interest rate risk. So again, if you're trying to fix their problem, you don't need to take interest rate risk as the Fed. That's really the whole kind of takeaway here. And that's true irrespective of who's doing the selling. If the hedge funds are doing the selling, they're taking both sides from the hedge funds. If it's a foreign central bank doing it, they're taking the bonds, but then they're going out and doing the hedge themselves, so they're still winding up essentially flat. All right, so that's kind of one thing. This is to show you, this is using CFTC data, where you can see the short positions of the hedge funds. So, this is the blue. So here we were in March 2020 when we had the sort of episode, and the hedge funds were short about 500 billion of Treasury futures. One thing I just want to draw your attention to, if you thought this was a problem, it's getting a little bit worse, because now we're sort of order of magnitude $1 trillion. Okay, and just to make the point that this probably is the trade that we're thinking of, I also have their hedge fund net repo borrowing in Treasuries, and it pretty much is the mirror image, both visually and actually scale. So it really is as if every unit of short futures is essentially 1 unit of repo, which is what you would get if they were almost 100% repo financed. Okay, so that's the hedge funds. This is trying to show you how the whole system kind of holds together. The blue line is the exact same blue line. As I said, who's the demand on the other side? It's the asset managers. So if you look at the asset managers, their position is pretty much the mirror image. And then if you squint at the red line, which is the dealers are sort of on the right side of the trade. They're kind of doing the same thing as the hedge funds, but much smaller scale. Okay, so they're not really, the frontline arbitrageurs normally are the hedge funds, and the dealers are kind of just dipping their toe. And you can do a regression which sort of makes that point, which is if you just look kind of at a $1 change at a weekly level in the asset manager's position, it's going to be met by about 80 cents by hedge funds and about 17 cents by the dealers. Okay, so that's sort of a rough sense of the relative roles they're playing in normal times. Okay, this is the basis. This is just the spread in some sense between the cash and the derivatives. Turns out, some of you will know this. This is actually a little trickier to measure than you might think, because you really have to be smart about cheapest to deliver and a bunch of stuff. When we tried naively to make this series, it was a little harder. I know you know this, right? But it was a little harder. We ended up throwing up our hands, and Anil got Ken Griffin to give us the Citadel series. So I think this is a pretty good series, but it's a little, this is like a case of don't necessarily try to do this at home. But again, the point to make here, the basis is generally positive. It's small in normal times. It's a handful of basis points. It's not attractive, again, unless you really lever it. And then we got this enormous, it was about a 9 standard deviation spike in 2020. Okay, some of you will ask, well, this is weird. What about, I always thought it was the other way around. And it used to be. So an interesting thing, LTCM famously blew itself up with the exact opposite trade. Back in the day, the spreads were the other way around, and it was that the treasury, the physical treasury, was more highly valued, so LTCM was shorting the treasury and long the derivatives. Something really dramatically and persistently changed in a very sharp way. I'm showing you here the swap spread, changed right around the financial crisis. I don't have a great story. Sam Hansen and co-authors have said some of this has to do with the GSEs, Fannie and Freddie, used to have big portfolios of mortgages that they would hedge, and that gave them a sort of demand to short futures. Some of it may have to do with regulation, although it's really pretty sharp. I don't have a great story, but it has been persistently, basically post-GFC, it has had this kind of shape. Okay, here's the one little regression that we ran, which is asking, again, the prediction of the model, if you will, is that as Treasury supply increases, futures positions will, the hedge funds futures positions will go with it. Okay, so we have some regressions that are basically, you can look, for example, weekly around Treasury auctions. And if you want to be a little bit careful, you can do this like in a panel, because you have physical treasuries of different maturities, 5, 7, 10, 20, and you have futures. And so even with like auction fixed effects, you can ask the question, is it the case that if the supply of, say, 7 years goes up a lot, that hedge fund positions in the 7 years go up a lot? And the answer seems to be yes. And the magnitude is sort of like 5 cents on the dollar. which is like saying if there's, if Treasury supply increased by another 10 trillion, we'd get another 5. I mean, this is an absurd exercise for me to be doing with weekly data. But if you wanted to do the absurd exercise, it would tell you something like another 10 trillion of Treasury debt would give you another 500 million of hedge fund position. I'm not taking that seriously, but it does show that there is some correlation between that there's something going on where Treasury supply tends to drive this thing. All right, let's look a little bit closer at what happened in March 2020. So again, you get this stress on the hedge funds. I think in this case, it was margin calls. And so again, they're in blue. So you see the blue line going up. So now this time scale is very short. You see the blue line going up by $150 billion in a very, very short period. It's going up because they're covering their short positions, which is like a positive move in their net futures position. So that's going up. Who's taking the other side of it? In the short run, you can see it's the dealers. So that's basically what's happening is they're fire selling this position and the dealers are having to take it. Okay. In the longer run, what you would expect, right, is the dealers is sort of a lot of stress, the basis is going to spike, that will call forth an adjustment. This was not in our model. So in our model, the asset managers were inelastic. They were just theta. But of course, that theta should depend on how expensive it is for them to use derivatives, right? When the basis spikes, it's getting very expensive to do things with the derivative relative to the cash. Okay, so over a more gradual horizon, the adjustment is done by the asset managers, right? So you get a spike in the basis, it's telling these guys don't do this synthetic thing very expensive, and they gradually adjust. But at the sort of horizon of weeks, it's basically taken up by the dealers, okay? And that's, I think, what the Fed was in effect trying to help with, okay? So now I just want to show you kind of how various measures of stress were moving. Interestingly, and kind of nicely for our story, the first thing to really go is this. This is the Treasury spot future spread. This is the Citadel kind of series. And this is all in units of standard deviation. So basically, this guy goes up by about 9 standard deviations. Okay, very, very big move. And then other stuff starts to go. As I said, repo market should be pretty integrated under stress because the dealers are basically moving balance sheet around. And so there you go. So repo, the GCF tri-party spread, that's sort of the repo intermediation spread. That's also like 9 or 10 standard deviations. Okay, the swap spread, in principle, our model doesn't really explain why this is not done quite as leveraged as a trade, I suspect, because its convergence properties are less good. So I think people are not as overextended in that. So it spikes, but it doesn't spike. It's more like a 3 or 4 standard deviation spike. And then, as we all know, various measures, I mean, Darrell Duffy has like 20 of them. This is just one. But any measure of Treasury market liquidity you're going to want to look at is going to also spike around this time. Okay, and again, this is sort of what you would expect. All right. So this is our idea. And again, I don't think, I think we probably wrote this paper a little wrong in the sense that we started out being very focused on the fragility created by the hedge funds. This policy proposal, I don't think really rests on that. I think it really ultimately just rests on the observation that the dealers tend to be hedged. So if for whatever reason you decide you want to be taking sort of this, load off the dealers, you can do it on a hedged basis. Okay. Yeah, there's really no reason for the Fed to take duration risk. So I think there's going to be all kinds of worries about something like this. I think the first thing that people are going to say, reasonably, entirely reasonably, geez, I mean, you're talking about bailing out the hedge funds. That doesn't feel good. So, yeah. Okay, again, I'm trying to make a much more kind of modest relative statement, which is if you were just about to unroll the unhedged QE to deal with this, that has moral hazard issues too. I think it has worse ones because, in effect, if the market dysfunction correlates with anything at all with the term premium, you're kind of capping, you're putting a Fed put on the term premium more generally. That's a much stronger kind of thing, and then you're taking all that risk out of the market, and you're creating a moral hazard just for people who want to like play carry trades, for example. Okay, so I think this in some sense has less moral hazard than outright buying would have. The other thing you can do a sort of Badgett spirit thing, which is you don't have to, completely cap this basis. There's various ways to implement it, but you don't have to completely cap the basis. We saw it went up 9 standard deviations. Suppose your policy is, I'm going to let it go 3, but not further than that. Then you'd be leaving a considerable amount of risk on the table for the hedge funds, but you'd still be maybe preventing the worst market function stuff. So I think you can deal with it. But all right, now I'm going to say some stuff that is not like meant to be serious policy, I guess, given the realities of the world, but I think it's sort of a useful thought exercise. What would be so bad? Suppose you really committed to do this quite aggressively. In fact, let's go even further. Let's take the hedge funds out. Well, let me do it in 2 steps. If you did it pretty aggressively, if they always knew you were going to step in, it's true that make the hedge funds more aggressive would also take all the profits out of the trade. So maybe that's not so bad. Okay, let me go a step further. Suppose you really want the hedge funds out of this. You don't want them to be getting any kind of moral hazard benefit. The Fed could just do this themselves. You could imagine a world where the Fed just says, I'm going to stabilize the basis. Okay, again, I know you guys aren't going to do this, but like, why not? Okay, so think about what I'm sort of saying here, right? I want you to, the Fed is going to take no credit risk. They're going to take no interest rate risk. All they're going to take is basis risk, which they'll never lose on because they're the Fed and they print money, so they can always hold the trade to convergence. Okay? This is, I think, it's very much in the spirit of the Friedman rule. It's saying, look, there's this demand for warehousing, right? There's this demand for warehousing. Who can provide this warehousing service for free, right? No credit risk, no interest rate risk. I'm going to pose this as a little bit of a puzzle. I mean, by the way, the Fed does intervene. It intervenes with like, deviations of the CIP basis with swaps. It's a sort of puzzle, like intellectually you're sort of drawn to like there's something to this. Now, if you don't do anything more, it sort of explains too much. It's going to get you to flatten do you really want to flatten like the equity basis? No, no way. But I don't know, the logic kind of puts you here. So again, you're not going to go there, but going part way may not be the worst thing in the world, maybe, okay? There are some design issues. You say this to Fed legal or to other Fed people, they just sort of reflexively don't really like it. You know what this is? Economically, this is just repo. It's just repo. I'm not talking about the legal whatever. It's just repo. What is it? It's a purchase with a forward agreement to sell. The only thing that makes it different than repo is in repo the counterparty is the same to both legs. Here, in effect, you've got a different counterparty. Okay? But economically, it's the same thing. It has a much smaller footprint economically than unhedged purchases. Matt Levine called this synthetic lender of last resort, which I thought was actually a pretty good thing. What else did I want to say? Yeah. Again, there are going to be concerns about should the Fed be in derivatives, and there are concerns about counterparty. But I think at some basic economic level, we're not proposing something that looks all that different. Another thing to mention is, the other way to do this is the Bank of England way, which is rather than literally forward selling, is when you buy the bonds, you say, I promise, this is market function, I promise I'm going to sell them in a week, in a month, or whatever, right? So why do this as opposed to that? 2 points. One is, they did it and it worked. You've got to have more confidence in when the period of kind of turmoil will end if you're going to make a date commitment. Here you don't need to do it because it's embedded in the fact that you've already done the forward sale. You can roll the futures. You're already duration neutral from the get-go. The other problem is if you have a very kind of pure view that the only way monetary QE works is stock of duration multiplied by weeks or months of duration, then committing to get out soon is good. If you think there's also flow impact of asset purchases, then if you buy a ton today and say, don't worry, I'm going to reverse this next month, you're still going to have an impact on the long rate. Okay, and you're still going to have some of, I think, the blurriness with monetary policy. So I think of this as a sort of more elegant way of kind of committing that it's really pure market function. Okay. Last thing, this is kind of outside of our thing, but given kind of the topic of this conference, when all this sort of talk about the Feds, and I don't want to say this about the ECB because I think there are different issues, but for the conversation around the optimal size of the Fed's balance sheet, there seems to be an idea that we want to get it as small as we can before we bump into problems. And I've never completely understood this. And this is just the same kind of Friedman rule thing, which is I don't see the argument against a really quite ample balance sheet. So you're far away from any trouble. I completely understand the discomfort with the Fed taking a lot of duration risk. Okay, completely understand that. It's in some sense overstepping kind of its role versus the Treasury Department's role. It's creating legitimate interest rate. It's in some sense overriding the Treasury's debt maturity decision. Get that 100%. But I think the right metric for sort of big central bank footprint is units of either credit risk or duration. A purely large in dollar terms balance sheet that holds very short duration stuff. So imagine you had super ample reserves, but it's just because they're holding a lot of 1-year duration stuff. I really have a hard time seeing why that's something you want to be super conservative about. Okay, it's the same idea. There are some things that the Fed can, here it's providing monetary services, in the other case it was providing, I don't know, warehousing services. But if it can do it better than anybody because it prints money, I don't really see the big deal. So that's the sense in which this maybe kind of connects to some of the other themes. So that's that. Let me stop and we'll do some Q&A. Okay.
Thanks, Jeremy. I'm waiting for hands. As I wait, just a question on, you said it's not so clear to you why the basis switches from negative to positive around the GFC. I mean, could it have anything to do with, after that you talk about the supply of treasuries. I mean, the GFC is exactly the point in time where the US switches from a low public debt to a high public debt regime. Right?
That's got to be right. So if
below
it was
60% to plus 100.
I think if you put that together
within a year, actually.
Yeah, you put that together with the GSE argument, that may go a long way.
Okay.
Yeah.
Good. And we have Isabel and then Loriana on this side. And I apologize, we have a third question here. We take three.
Thank you very much for a fascinating speech. I will come back to the point that we already discussed briefly before your speech, which is actually your final point. So why should the central bank care about the size of its balance sheet?
Yeah.
And so I would argue that the Friedman rule applies only when you really have a frictionless world. So when you do have frictions, then, for example, by providing an infinitely large balance sheet, you're basically crowding out entirely the private market. There will no longer be an interbank market, which, as far as I know, also from supervisors, is actually super important in order to assess the creditworthiness of the banks and so on. So you're losing very useful information. Of course, you could also take the view, and actually for us, it's also one of the principles that we have, that you kind of support the open market economy. So you do not crowd out a private sector activity if it's not necessary. Then there is the Acharya Rajan argument about a large balance sheet also creating this kind of liquidity dependence, which then creates financial stability risks. Then there is the question of fiscal dominance. So is it a problem if or monetary financing, is it a problem if the central bank buys all these government bonds? And there are further arguments, but these are just to give you a few ideas that we've been discussing here when we decided for an operational framework that has the explicit intention to have the balance sheet rather smaller than larger.
So we talked about your first argument was new to me a half hour ago. That's the best one I've heard. I don't know if ultimately you end up, I don't know how scarce you have to get for there to be enough of a kind of, unsecured lending market, but that seems like a totally legit thing. I wouldn't push back on that. The Acharya Rajan thing, I don't know how many of you are familiar, and I don't want to go off on a whole thing. This sort of idea that you get addicted to liquidity, like the sort of strongest version of their argument goes something like this. Banks find themselves with a lot of reserve. It has a weird history dependence to it. Banks find themselves with a lot of reserves. They're like, oh my gosh, what am I going to do with all these reserves? I'm going to write a bunch of credit lines. Then when reserves go down, they're like, I kind of like writing all these credit lines, so they don't bring them back down, and now you've got some kind of a liquidity problem. If there was sort of good empirical evidence for that, I would take it. I'm just not sure how much I believe that. The dominance thing is obviously something we need to be thinking about in the US now. I think I would argue if what you're doing is just buying T-bills, you're not really doing, what would be an enormous fiscal dominance concern is if they decide, I don't like interest rates going up because of inflation worries, so I'm going to do yield curve control. That's like the pure thing. I think just passively buying short duration stuff while you're still controlling the short rate doesn't have that same concern as far as I can see. But it's the argument's very contingent on not getting big in the market for duration.
Okay, then we have Loriana next. So in the middle, if you could answer a mic. And maybe if you could stand up and mention your name or affiliation, whatever you want to say.
Okay, so Loriana Pellizzon from Goethe University and SAFE here in Frankfurt. I want to stretch your argument on the fact that central banks can also consider to use derivatives, so future, that I know is clearly a very delicate topic. And the reason why I want to stretch it a little bit is because, I have a paper also with Davide Tomio here, where we are looking to the basis, negative basis in this case, that during the QE period has been generated here in Europe between the Bund and the future on the Bund and the BTP as well.
Yeah.
And there in that paper, we were also suggesting that, if also by doing QE, you can also consider the use of futures rather than just buying the bonds, because in this way, you are going to reduce this pressure on the bond and, in this case, use the future to close the basis. Do you think that then, indeed, we can stretch your argument and arrive to the point that the central bank should start to think also to include in their tools also the use of derivatives rather than just the bonds?
Yeah, I think I think it must be essentially this. If you say, we are now going to do QE, standard monetary policy QE. When we do standard monetary policy QE, we do pay attention to the relative prices of stuff on the yield curve, right? You sort of try to buy the relatively cheaper stuff. So if you just expanded that a little bit and say, well, right now we're in a configuration where the futures is a cheaper way to execute. Yeah, I think that probably has good normative. There are a bunch of situations where I feel like if the Fed behaved commercially, it actually has the right, it kind of aligns with welfare, which is you're just giving the market the thing it values more. And why not? Yeah, I mean, again, then somebody might say, oh my God, now you're in derivatives, which I agree raises a set of kind of counterparty issues and who's clearing and all of that. And I don't mean to sort of, downplay that. But I think it is also worth recognizing when the economics are very similar. You know, I mean, I think some of the legal objections I've heard have, in the end, been not really legal objections, but like, we haven't historically done this and it feels a little uncomfortable. But then I think it's at least worth pushing to see really where the discomfort's coming from. Yeah. I agree. I agree. And again, what we're proposing is effectively economically a form of repo, which is the most comfortable kind of go-to thing. So it's just a little unconventional, right? And it's just like buying futures is really not that different than buying the bond, right?
So could I push this a bit more, because you focus now on treasuries.
Yeah.
But would you go as far as to say that one could apply this to any other type of asset?
No.
That
So this is where I think there is just...
Like we bought corporate bonds.
Yeah, there's a hole in my understanding, which is like, let's start with something I think we're all comfortable with. If the CIP basis blows up, central banks tend to intervene with swap lines, right? And we have some intuition. At the same time, I'm guessing that if the equity futures basis blew up, people would sort of shrug their shoulders, right? So we have some intuition that the former matters more for the real economy than the latter, but I don't really, you know, well, the CIP basis is much closer to being like a cost of synthetic dollar funding, so we think it matters for credit. Here, I think the linchpin of my argument would have been, we don't care about the basis itself, but it's so tightly tied up with the other things that dealers do. It's sort of a co-holdings argument. It's the same guys who absorb that fire sale are the ones who are making markets and treasuries and intermediating repo. Maybe we don't believe the same about convertible bond arbitrage spreads, right? But I think there's actually just a whole, I mean, I feel like this is like an actually interesting topic of, and the reason I wanted to push this logic is to just sort of, why do we believe that like some of them sort of make sense and I don't have a great answer. I would certainly be uncomfortable with the idea that the Fed is going to just like smush every basis, but I wouldn't have a great argument as to why I'm uncomfortable.
Good. Then I would like the mic to go to this side, third row here. Yes, thank you. If you could mention your name.
Sorry, I will remain seated because I have coffee here and I don't want to spill it. I'm Hinako Kijima from BIS and BOJ. Fascinating read, eye-opening, I would even say. And so if we could go back to figure 4 in your slides. So
can I do
looking
that?
at the, oh, you don't have, oh, sorry.
Should I
so
try
just looking at the hedge funds, treasury, futures positioning and repo borrowing.
Oh, I've lost control of
Okay,
I'm sorry.
We could all look back in the paper, but so it most likely that the basis trades are at its historical peak by looking at those
The size
metrics.
of it, yes.
Yes. Despite this, so in April, so after the announcement of US tariff announcement and the market turmoil, so the basis positions and the cash future basis remained relatively calm and muted compared to other like swap spreads. So my question is, perhaps, do you have any ideas what would explain the stability compared to what we saw in March 2020? Would it be like something more structural improvement in the intermediation of leveraged basis trades, or?
I don't know. I'm not inclined to take too much comfort, just because it's the nature of all these unwind phenomena is that they're super nonlinear, right? You go, it's stabilizing, and all of a sudden just everything. So maybe we were lucky and we just didn't quite hit that point, you know? There was more action, and this is sort of a subtle question, there was more action apparently in the swap spread this time around. Because I think for various reasons, people had gotten themselves a little bit more levered in that trade. No, I actually took it the other way. I thought, oh, you know, we dodged a bullet, but there was still some, yeah, I don't think that, I'm not too comforted by that.
All right, we have many hands here. Let's just take the mic in the same row here in the middle. Yes.
You mean, yeah.
very interesting and insightful. I'm curious how you think about the push for, easing balance sheet regulation for dealers in the context of this. Because the idea is, if you want to relax the supplementary leverage ratio, do central clearing, that helps dealers to step in bad times. But I guess given your findings and the extent to which this depends on reverse repos, do you think that this would also create more of a buildup of the problem in the first place, so that how much capacity is going to be used up ex ante and how much is there left to be used up afterwards?
This is a really good question, and I came into it with I just sort of hate the leverage ratio. I just hate it, like personal animosity. And so I came in with a pretty strong prior that was kind of to blame for a lot of this. The Fed did the obvious thing by excluding treasuries and reserves from the calculation of the leverage ratio. That didn't do as much as you would have hoped. I think I've come around just by virtue of sort of not having that's helpful, but that's not the whole thing. So, this trade is not, it doesn't have duration risk, but of course it has a bunch of basis risk and a lot of sort of deconvergence risk. So if you think of yourself as a dealer firm trying to step into this, right, especially when the market is super volatile, your risk models are going to kind of, apart from any leverage ratio, steer you away from it. And that's kind of how I started to think about, again, this Friedman rule kind of thinking. The Fed can step into one of these trades and not worry about basis risk because by virtue of printing money, you never get forced out of a trade soon. That's, in some sense, it's the friction that gives the Fed arguably an advantage here. So again, I think there's lots of good reasons to not like the leverage ratio, but again, I don't think that getting rid of it here is magic in any way.
I'm going to take the privilege of the chair to kind of take you a bit out of the paper, since we have you here very rarely. So one question that the paper triggered among the team. And by the way, the team here is this is my favorite conference here because we have the markets experts, the monetary experts, the researchers, they organize it together, and it's quite unique to have that blend here with the policymakers. So we have a monetary policy wing and a markets, market functioning wing, like most central banks have. And so the question that was triggered by this paper, but I know you have thought about a lot yourself, also when you were at the Fed, what do you make today of this separation between market functioning and monetary policy functions in central banks?
Well, I think it's not an accident that, for example, the BOE was more effective in handling this than the Fed was. I think the separation is pretty helpful. And I think that alone, even if there were other issues, would have prevented this sort of bleeding in that you had. Like, again, if it's just interesting to read the Fed statements, where it's at first all market function, then it's just language that's kind of a mush of market function. And I think if there was just a clearer separation, you wouldn't have that. So I think I don't know if you have to do it by literally having a separate committee, but there is some virtue in really having people. And I think it just, the other thing that I think the BOE does is it just forces you you can't just sort of punt the financial stability stuff in the way that I think the Fed has on occasion. The thing that used to frustrate me is we would have these very good financial stability reports, and then you'd bring them to the FOMC, and it would be, well, got some lights flashing yellow, nothing flashing red, let's set it aside, right? There was sort of a default tendency to want to bin it a little bit, and I think that a different system, a different sort of committee system might be helpful on that dimension.
Good. On that note, I'm unfortunately running out of time here. Jeremy, thank you so much.
Thank you. It's a pleasure. Thank you very much.
I want to alert you to the fact that we have a very interesting session now, of a poster session. It's quite special in the sense that, so we have this what we call European system of central banks. So it's some larger, some smaller. It's more than euro area, so there are other countries still that are not part of that, and they do research together. And this time around, we're showcasing in the back some of their work. Much of that work is between these national central banks and ECB colleagues. So please go take a look, ask questions. And with that, thank you, Jeremy.
Thank you very much.
Hello, everyone. I am Gerardo Garcia. I'm the Director of Operations at Banco de Mexico, and I want to thank the organizers for inviting me to chair this session entitled Global Funding Spillovers. The session will cover two thought-provoking papers about two topics that are actually very close to my heart. I have been investing in the international reserve portfolio at Banco de Mexico for over 20 years, and I have had to deal very closely with the topics that will be presented today. One is the deviations from covered interest rate parity. That's the first topic. And the second one is about US Treasury auctions, US Treasury demand, and its impact on FX and bond markets. First, we will have Umang Ketan. Umang is a finance PhD candidate at the University of Iowa who will present synthetic dollar funding. The discussant will be Katarina Bergant, who is currently a researcher at the IMF. I must say that I really enjoyed reading the paper, as I think it contributes to current literature in at least 3 dimensions. First, it helps us understand why CIP deviations persist, but it does so from a very novel perspective in the sense that it does not focus on the traditional supply side frictions in US dollar supply, but rather on the demand side that some banks and global banks face in wholesale markets and some of the problems that they face in sourcing US dollar liquidity and then have to turn to the FX swap market to obtain a US dollar funding. So I think that's the very first important contribution. The second one is that it allows us to have a better understanding of how dollar funding stress is transmitted. And I think that is particularly important in the sense that you have today a lot of financial authorities, and this topic is very important for them in the sense that your paper, I think, also might give them some advice on how to enhance policy mechanisms. So if you want to give some recommendations, you have an audience that is financial authorities, and it's the right time to do it. And I think the third thing is that it stimulates further analysis of closely related issues. I think that your paper focuses on US money market funds, but certainly what comes to my mind is what happens also with other institutional investors that are important in sourcing US dollar liquidity. And I'm talking about pension funds that might be long-term investors, but also some sovereign wealth funds and even central banks who also participate in the sourcing of US dollars. So with that introduction being said, let me turn to you for your remarks. You have 25 minutes, please.
Thank you. Great. Thanks, everyone, for being here. My name is Umang. I'm a PhD student at the University of Iowa, and really happy to present my paper, Synthetic Dollar Funding. Now, this paper is motivated by the vital role of US dollar liquidity in the international financial system. We know from existing research that a large number of firms around the world need dollar liquidity for trade credit, working capital loans, as well as long-term debt. And they mostly source these dollars from large global banks, which are the key intermediaries in these markets. But the interesting thing about dollar intermediation from international perspective is that a majority of dollars are actually lent by non-US banks. For example, Deutsche Bank or BNP Paribas here in the Euro area, or Barclays, Standard Chartered in the UK. And that's interesting because these banks traditionally don't have large dollar deposits in the US, and that raises the question of how do banks fund such large quantities of dollar assets. So when we look at the short-term dollar funding markets that these banks do rely on, we can categorize them into 2 broad types. The first is the traditional wholesale funding market, and we had a lot of discussion today about repos, for example, where banks issue repos, commercial paper, etc., mostly to money market institutions like Vanguard and BlackRock to raise dollar funding. But the second market that has become very important, particularly after the financial crisis, is the so-called synthetic funding market. The way this market works is that banks first raise a foreign currency, foreign from the perspective of US, of course, for example, the euro or the yen, and then enter into a foreign exchange swap to temporarily obtain dollars. Swaps are derivatives, which is why this form of borrowing is also known as off-balance sheet. And it's going to be the focus of this paper because the synthetic funding market is large and it has grown quite a lot. To get a sense of how big this market is, here is a chart from a recent report by the Bank for International Settlements, which kind of shows that a pretty large part of total dollar debt of non-US banks can be through synthetic sources like foreign exchange swaps. But beyond aggregate statistics, we don't really have a full understanding of what are the frictions that drive banks to use synthetic dollars and what are its broader implications, both for asset markets as well as banks' dollar lending? And these questions are important because in the post-financial crisis world, we know that banks have faced increasing difficulty in raising dollar funding through traditional wholesale funding markets, partly because new regulations want to limit how exposed local investors are to these non-US banks. But this question has also taken on a renewed urgency in the last few months. There's a lot of concern expressed in the financial media that dollar funding markets themselves could be used as a negotiating tool in the evolving tariff policy, potentially restricting the flow of dollars to non-US banks. So the broader question we need to answer here is, what is the role of swaps in banks' dollar funding portfolio? Do they act as an independent source of funding, or do they interact with existing wholesale funding markets? And the second part of the story is about prices. We also know from a large literature which focuses on swap markets that the pricing in swap market is quite misaligned from fundamentals. Essentially what that means is that the cost of synthetic dollars tends to be higher than the cost of wholesale dollars. And that gap has real implications. There's work by some people in the audience here which shows that it in fact affects cross-border investment of firms. But what we don't have enough of is any kind of causal evidence on whether this particular demand from banks contributes to this pricing wedge. And these questions collectively are important because they help us better understand how wholesale funding frictions might affect bank lending in the presence of these synthetic markets. The key challenge in answering these questions is that swaps, because they're off balance sheet, we don't typically observe quantities data from these markets, definitely not in the standard quarterly call reports, for example. And that's exactly the challenge that my paper will try and overcome. I'm going to jointly analyze banks' use of wholesale and synthetic funding markets, and I'll show you three things over my remaining time today. First, I find that banks increase the use of synthetic dollars when they face constraints in the traditional wholesale funding markets. Why do they face constraints in funding markets? Because they run into these occasionally binding constraints on the amount of dollars that they need for fulfilling their dollar credit demand. And I'm going to show this with the help of a regulatory change that led to a very large decline in the availability of wholesale funding for banks, in response to which they significantly increased the use of swaps. This finding has two important implications. First, it tells us that there is a part of swap demand that's not driven by cost optimization between these markets. It is driven by quantitative limits in the wholesale funding market, which means that even though swaps are typically more expensive, banks sometimes have to use them to fill their dollar funding gaps. And the second implication, probably more from a policy perspective, is that to understand the full extent of dollar debt on the books of banks, we have to look beyond the on-balance sheet sources. We have to account for the use of swaps, which typically sit outside of balance sheet liabilities. Now that takes me to the second finding, which I'll talk about today, which is that synthetic dollar demand from these banks contributes to covered interest parity deviations. Covered interest parity, or CIP, it's a fundamental asset pricing condition in international finance, which basically says that the cost of dollar funding in synthetic and wholesale markets should not be very different. And if it is, then it's basically an arbitrage opportunity. And that condition means that the cross-currency basis, which is the difference between synthetic and wholesale dollar funding cost, should be close to zero. In practice, since the financial crisis, the basis has been consistently negative, which means synthetic dollars are typically more expensive. And this has not gone unnoticed. There is a very large literature which documents this and tries to rationalize this phenomenon primarily by looking at the supply side constraints within the swap market. By that, what I mean is that the swap arbitrageurs who supply dollars using swaps, they face increased balance sheet and regulatory costs. For example, leverage ratio that we heard about, which means that these swap arbitrageurs pass on these costs to the borrowers of dollars in the swap market. What I add to that is a demand side counterpart. I find that when banks increase their demand for swaps, that turns the cross-currency basis more negative. And I make a causal claim here. I make use of frictions in the wholesale funding market to instrument for banks' swap demand, and I show that that indeed turns the basis more negative. And this finding has two important implications. First, it tells us that there is an important demand-side element to the kind of pricing phenomenon that we observe empirically. And importantly, from the perspective of these banks, it means that they're going to pay a premium to raise dollars in the synthetic market. And this cost scales up with their increasing borrowing. And when this cost scales up, it will naturally put a limit on how much banks can use these synthetic markets for raising US dollars. And that exactly takes me to my third finding. In the last part of the paper, I quantify the impact of funding market frictions on banks' ability to lend dollars in the presence of these synthetic markets. Now, this is going to be a very simple calibration exercise of the Ivashina-Schaafstein-Stein's model, where I'm able to trace what level of wholesale funding decline will actually affect bank lending, given that they can use swaps to offset some of that trade-off. And this is important because it helps us directly link to policy counterfactuals. For example, if US regulators were to further restrict non-US banks' ability to raise dollars in the wholesale funding market, when will that actually affect their lending behavior? So to visualize this model in a very simple schematic diagram, imagine that there is a representative bank which raises dollars from both wholesale and synthetic markets. When it faces a decline in wholesale funding, it switches to the synthetic market to make up for that shortfall. In the process of doing that, it ends up paying an extra price, which is the cross-currency basis. The extent to which it will pay that price depends upon the revenue it can make on those dollar assets. So in equilibrium, the cost and revenue curves intersect, beyond which the bank finds it more unprofitable to raise dollars in the swap market. As a result, they could either increase the cost of dollar credit to the end borrowers or cut down on lending altogether, both of which can be quite detrimental. So in my remaining time, I'll focus on the first two elements of this picture, which is that when there is a decline in wholesale funding, banks increase the use of swaps, and that has an asset pricing impact in the form of cross-currency basis. I'll leave the details of the model to the paper and just conclude with a brief takeaway from the calibration exercise. Okay, so I don't have time to go into the details of the literature, but I briefly want to mention what is my incremental contribution in light of all the work that has been done here. I'm going to talk about quantitative constraints in wholesale funding market that drive banks to use synthetic funding markets to make up for the shortfall, which has an asset pricing implication that goes beyond quarter ends, for example, which has been the key focus of the literature so far, and therefore my findings are generalizable beyond just quarter ends. All right, so we'll start off by talking about the demand for synthetic dollar funding. In terms of the data, I'm going to use money market funds as a laboratory within the wholesale funding market universe. Money market funds like Vanguard or BlackRock, they lend well over $1 trillion to non-US banks, and that makes them important players and suppliers of wholesale dollars. We also have very granular data available on money market funds. We can observe at a monthly frequency the dollars that they lend to all types of institutions at a non-anonymized basis, and that allows us to construct instruments using the granularity of that data. But we have to remember that these money market funds are quite constrained in the amount of dollars that they can lend to these banks. The key institutional feature of this market is that money market funds focus on capital preservation as their primary objective, not on very risky lending to generate very high returns. There's also other reasons why these funds can have quantitative constraints on how much they can lend to banks. For example, these funds are subject to investor outflows, especially after the 2016 reform, which I'll detail in a few minutes, and that directly impacts the banks that borrow from these funds. These funds also are subject to explicit regulatory limits. For example, they cannot lend more than 5% of their assets to any individual borrower on unsecured basis, which puts a cap on how much banks can borrow from these funds. They also have more internal limits, essentially to control credit risk that they can incur when lending to banks. The second market that we're going to focus on is the synthetic funding market, which is primarily executed using foreign exchange swaps. The swap itself is a very simple instrument. It's just like a collateralized term loan. And in the flow chart here, you can see that there's two main legs to this trade. At the inception of the swap, the borrower provides euro, let's say quantity Q, against which they borrow dollars, Q multiplied by the current spot rate. At the maturity, they will reverse the transaction. The borrower gets back the euro that they had lent, and this time repays dollars, but at the forward rate. Both the spot and forward rates are known at inception, so there is really no price risk in these instruments. And the difference between the forward and spot rate is essentially the swap premium, which should neutralize the interest rate differential between euro and USD in this context. In terms of balance sheet flows, if you imagine you are Deutsche Bank, you have very large dollar assets, which are the loans that you make in dollars. You typically don't have equivalent dollar liabilities. So you raise euro funding and then enter into an off-balance sheet swap to obtain the dollars to support your dollar lending. The challenge, of course, is because swaps are off-balance sheet, we don't observe quantities very easily. So to overcome the challenge, I make use of daily transactions data from CLS, or continuous linked settlement. This is one of the largest settlement agencies in the foreign exchange market and covers about a quarter to a third of the market in terms of transaction volumes. It allows me to quantify at a daily frequency dollars borrowed by different types of institutions in the swap market against a whole range of currencies and different tenors. There is a limitation of this data set that I would like to mention, which is that I observe these transactions, but I don't see the names of individual counterparties. I see their sectors to which they belong. And that's not going to be a challenge for identification because I use granularity of wholesale funding markets, but it is important to know in terms of what the data allows us to do and what we cannot do with it. All right, so here's just one slide on stylized facts from the swap market. This is a monthly time series of the total amount of dollars borrowed by global banks using swaps against all the currencies put together. And I'd like you to have 3 takeaways from this. First, it's a pretty big market. In my sample alone, there are months where banks borrow well over $1 trillion using swaps, which highlights that it's an important source of funding for large global banks. Second, it's a short-term market. Almost all of the borrowing is for up to 1 month in tenor, which is consistent with the fact that wholesale funding markets are also short-term. So when we think about substitution within these 2 segments, maturity imbalance is not going to be a major source of difference. And the third takeaway is that when interest rates go up, banks tend to reduce the use of swaps a little bit, like in the last 2 years of my sample period. And you might think that might be because at higher interest rates, maybe the demand for dollar goes down, but that's not what has happened. What's happened is that at higher interest rates, households move their savings from checking accounts to money market funds, which increases the availability of wholesale funding for banks, reducing their reliance on swaps. And we can see that directly in the raw data itself. All right, so that's going to be our first hypothesis, where we will test whether banks use swaps to offset wholesale funding decline. The regression we run here is very straightforward. It's changes in the synthetic dollar demand of banks against every currency C in month T on the availability of wholesale funding, which I proxy using money market fund holdings, controlling for prices, macroeconomic factors, and progressively adding fixed effects. And we can see that in this reduced form setting, there is a strong negative relationship between these 2 markets. As the availability of money market holdings declines, banks increase the use of swaps simultaneously. Economically, for a standard deviation decline in money market fund holdings, we're talking about a 23% increase in the use of swaps, which is meaningful. Now, this is, of course, a correlation, and one of the concerns you may have is that banks are probably just choosing the cheaper of the 2 funding sources. And so to the extent there is a change in the relative pricing between these 2 products, banks could switch from one to the other, so this shouldn't be a surprising result. I'm going to try and show you that this is largely driven by quantitative restrictions in the money market fund industry, not so much a cost phenomenon. And to do that, I'll make use of a regulatory reform, which greatly reduced the availability of wholesale funding for banks, in response to which they increased the use of swaps. In 2016, the SEC in the US implemented a series of reforms to the structure of money market funds, with the idea of improving their liquidity situation and preventing the kind of runs that we saw during the financial crisis. There were many provisions of this reform. For example, they had to introduce liquidity buffers, they had to introduce redemption gates, and change the way they report their net asset values. The immediate outcome of this reform was that once it was implemented, end investors withdrew a large amount of money from the money market funds, which directly impacted banks which were borrowing from these funds. The worst hit were the so-called prime funds, whose majority of asset allocation was in banks, and therefore banks across the rest of the world lost about $250 billion in a very short period of time in the form of wholesale funding. Now, I'm going to use this reform as an exogenous shock to the availability of wholesale funding for banks. And I'm going to make use of a difference in differences framework to estimate the impact of banks' use of swaps. Banks are going to be my treated units because they were directly hit by this reform. And other users of swaps, for example, funds or corporations, are going to be control units because they were not borrowing from these money market funds to begin with, which means the impact of this reform on their swap demand should be relatively limited. And that gives me a difference in differences setting where I can trace the impact of banks' use of swaps following the implementation of this reform. And I find that once this reform was implemented, banks significantly and persistently increased the use of swaps for raising US dollars. And this is not driven by pretrends, which lends a causal interpretation to this result. Great. One question on your mind might be that why can banks not simply pay more for wholesale funding? Why can't they offer much higher interest rates to money market funds? Because that might still be cheaper than raising dollars in the swap market. So why is that not scalable? And the reason for that is that money market funds focus a lot on capital preservation. Typically, they do not seek very high returns at the cost of bearing very large default or credit risk. And one way to show that in the data is to understand what's the relationship between the interest rates that money market funds charge and the amount of dollars that they lend to banks. And that's the plot on the left. Here, with issuer fixed effects and time fixed effects, I show that the relationship between the interest rates that banks pay and the amount of dollars they borrow from funds is not very strongly positive. In fact, it increases a little bit in the beginning, but then it just becomes a pretty much no correlation, which means that funds prioritize not lending more rather than lending at very high interest rates. In contrast, the plot on the right uses the maturity of these instruments instead of amount, and we can see that the relationship is much strongly positive, and therefore risk is a main factor that money market funds consider. Great, so we're going to move on to talk about the asset pricing implications here, asset price being deviations from covered interest parity, which is of independent interest as a major asset pricing phenomenon. But through the perspective of my story, what it means is that banks might be paying a premium to raise dollars in the swap market. And if they do, that would limit the usefulness of these markets in times of major funding stress. So what we really want to find out is the price impact of an increase in banks' demand for swaps. What we know from the literature is that swap arbitrageurs, they face balance sheet and regulatory costs of doing these trades. And therefore, the supply curve is essentially upward sloping. What we want to find out is how much will be the price impact for a given change in banks' demand for swaps. And we're going to run into a basic identification challenge, which is that quantities and prices are simultaneously determined. So we cannot just run a regression of changes in prices and changes in quantities. We essentially need an instrument that can shift the demand of banks independently of prices. And I'm going to construct that instrument using the granularity of wholesale funding data. The key idea is that banks are going to increase their demand for swaps when they face restrictions in wholesale funding market. And if we can capture these restrictions, and if they're independent of prices or any other swap market factor, we basically have an exogenous shock to their swap demand. And to do that, I'm going to specify the demand of banks in the swap market as a three-factor structure. There's going to be a price, which is what generates a simultaneity bias. There's going to be some kind of macro common factor to which all banks react. Omitting that generates omitted variable bias. It's the third component that we want to focus on. That's the idiosyncratic residual, or the quantity of swaps that only bank I will demand because it's not able to raise additional funding in the wholesale funding market. So what's the micro foundation? Why should we expect these idiosyncratic or bank-level shocks to exist? There's a number of reasons. Let me just talk about the first one in the interest of time. There is a lot of cross-sectional variation in the availability of wholesale funding to different types of banks, even within the same country and same month. For example, banks have differential exposure to different money market funds. For example, if Vanguard lends to only 3 European banks out of 10, and if Vanguard suffers some kind of outflow because, let's say, they increase their fee structure, it only affects a subset of 3 banks and not everyone else, sort of like a shift share setting. These idiosyncratic shocks to the availability of wholesale funding, I extract them using the granular instrumental variables framework, and then I aggregate them to the banking sector level using the size of these banks. I call my instrument excess wholesale funding because what it essentially represents is the availability of wholesale funding to large banks in a particular country over and above the average or the mean trend in that country. Okay? In the first stage, I show that the instrument is relevant to explaining my endogenous variable, which is the swap demand. The regression here shows that an increase in excess wholesale funding strongly correlates with the changes in synthetic dollar demand of banks. Now, this is statistically significant, but importantly, the sign here is very sensible. It's a negative relationship, which is consistent with the story I've laid out so far, which is that when banks obtain large wholesale funding, they reduce the demand for swaps, and that's what the first stage here seems to confirm. I also verified that the instrument meets the exclusion restriction, especially that it does not capture wholesale funding constraints faced by, for example, US banks, which are likely swap arbitrageurs in this market. In the second stage, we then go ahead and look at the causal impact of banks' swap demand on prices, prices being changes in covered interest parity deviations. In the first 3 columns, I'm using the first principal component of bases at 1 week, 1 month, and 3 months tenor. And then I have 1 week and 1 month separately in the last 2 columns. And across these 5 columns, we can see that there is a strong negative relationship. As the synthetic demand of banks goes up, the cross-currency basis turns more negative. Economically, for a 10% increase in demand, we're talking about more negative 7 basis points of the basis, which is pretty meaningful because the average basis is minus 26 basis points. What's also very important to note is that this result is neither driven by nor restricted to quarter ends. Quarter ends are special dates in these markets when banks tend to window dress their balance sheets. Even if we remove all of those months, we still find that this price impact goes through, which means that the economic force generating this result, which is wholesale funding frictions, is not restricted to just a few days of the year. Great, so with that, the last part of the paper, I have only 2 minutes left, so I'll go through this very quickly. We want to try and understand what all of this means for bank lending. Specifically, we want to quantitatively determine the extent to which synthetic funding markets can meet decline in wholesale funding that banks get. And to do that, I'm going to calibrate the Iwashina-Schaafstein model, where we have a bank which is able to raise dollars from both of these markets. But when it raises dollars in the swap market, it ends up paying an extra cost. The extent to which it will pay that extra cost crucially depends on the revenue it can make on dollar assets. So we're going to try and find out what is that threshold beyond which this cost-benefit trade-off becomes worse for banks, after which there can be a decline in wholesale in the dollar credit that is provided by these banks. Okay? So here's the key result from the model in just one picture. What I have on the x-axis is the availability of wholesale funding, going from 100% available on the left extreme to nothing available on the right-hand side. And on the y-axis, we're going to try and see what's the amount of dollars that banks can borrow from these two markets put together. Initially, as wholesale funding declines, banks are able to scale up the use of swaps to raise dollars synthetically. But the red dashed line is the threshold beyond which the additional cost of swaps becomes much more than the revenue that banks can make on dollar assets. At that point, they will either reduce lending of dollars if the end users are not willing to pay an extra price, or they'll pass this on to the end borrowers, both of which can be negative outcomes for these borrowers. Great, so I'm going to conclude here. This paper is motivated by the growth of synthetic funding markets, in particular after the financial crisis. And it is one of the first papers that jointly analyzes dynamics in both wholesale and synthetic funding markets to make 3 contributions. First, I show that banks increase the use of swaps when they face decline in wholesale funding, quantitative decline. Second, this particular demand is a contributor to more negative cross-currency basis. And third, this negative cross-currency basis ultimately places a lid on how much these markets are useful for banks to provide dollar credit. Thanks very much. I look forward to the discussion and your questions.
So we will now have Katarina discussing the paper. Katarina, you also have 15 minutes.
Perfect. Thank you so much. Thank you so much to the organizers for inviting me to discuss this paper. Obviously, everything I'm going to say, especially around swap lines, are my views and not the IMF's or its board or its management. It was a pleasure to read this paper. There is a lot, far too much to go through in 25 minutes, so you should all read it and check it out. This paper is very nicely done, very cleanly done. Also, I saw in the acknowledgements there were at least 10 discussants before me and another 20 people who commented. So he has taken on board many important comments, and this is already a very clean version. You should check it out. But because there is so much in this paper, I thought I should summarize very quickly the key takeaways, I think, at least for me. And then I'm going to offer 3 comments, 2 more for in the audience, policymakers and the markets, and 1 maybe how you can make it more appealing for an academic audience or a publication. But let me just summarize very quickly in a graph style what's happening here. So what's happening is that here we have a non-US bank, let's say German Deutsche Bank in Germany or even in the UK. It's a non-US bank. Where it is located is not important in this sense. But what is important is it's not a non-US bank. It doesn't have the deposit insurance on its US dollar liabilities, US dollar short-term funding. So what it does, it issues US dollar short-term funding, and a big holder of this US dollar short-term funding of non-US banks are US money market funds. On average, the paper says that 954 billion, that's not trivial. So basically, What this paper does, of course, it shows in a panel regression, but I much more like the exogenous shock of the money market fund reform, which decreases this lending by around 250 billion. So again, not trivial, more than a quarter. And then these non-US banks basically don't have enough US dollar short-term funding. So what they do, they go to synthetic US dollars, and the demand for that goes up, which means the price goes up, which means covered interest parity breaks. I mean, at some point, just because the price goes up, not mechanically, but at some point this affects covered interest rate parity. And then he does all of this with nice identification and instruments, and if this wasn't enough, there is also a model and a calibration, how this feeds to the real world. And the question is, does all of this now affect the US dollar lending by these non-US banks, which is why they borrow the US dollars in the first place? And the answer is yes and no. No, because small fluctuations in their funding shortages can be made up by the synthetic market. But if the curtailing in this lending is very large, and here this calibration is 20%, you have to take this with a grain of salt, but then the banks will actually cut their dollar lending, because as every regulator in this room knows, they're no welfare organization. Their primary goal is to make a profit, but then the marginal base exceeds the marginal returns, and they will either scale back the lending or increase the price, which both ends up in a decrease in the volume. So here you have the last stage. From this, you then go back to the non-US dollar, non-US bank that then cuts lending. So this is this paper in a nutshell, and a very complete exercise. I'm gonna make 3 comments, as I said, because what we haven't heard from Umang today is, where does this leave us? So what should we take away from this story, from this very clean and nicely done exercise? I'm gonna offer some implications for economics and for economic policymakers and academia. Maybe for policymakers it's more interesting. And then I'm also gonna say something on the academic contribution of the paper. So this is a paper about the determinants of covered interest rate parity. So just to make very clear how the covered interest rate parity comes here, is that covered interest rate parity is defined by the fact that on the left-hand side, the dollar interest rate should be equal to, let's say, I'm taking the euro dollar here, because we're here at the ECB, it should be equal to the euro interest rate, and then the ratio of the spot and the forward exchange rates. So basically, you can't make, there's no free lunch, and you can't make profit by just trading this. And you can rearrange this by saying the CIP deviation is 0 when the difference between the two is 0. And in this paper, in Umang's paper, in general in this literature, I think Do et al., the JF paper, if I'm not mistaken, comes up with this cross basis, and you end up with this. Equation that the cross basis, which you can interpret as the covered interest rate parity, is equal to this dollar interest rate minus the euro interest rate minus, and this is now the swap price. So if you go back to the whole model as we had it, the price here comes into the CIP here. But how big now is this? How big does this have to be? And what the paper doesn't tell us is how big this really is in explaining covered interest rate parity. Let us take another step back and say, are CIP deviations actually rare? Because this is how you also motivate part of the study. And if you take this paper by Do et al. In the Journal of Finance, you see that actually before the GFC, there were very little CIP, but after the GFC, this is a pretty big phenomenon, and you take this as a motivation. Well, actually, now we have more data, and there's a new paper by de Gorse et al. Who dug out this CIP data since 1920, and he shows that actually this little phase here before the GFC was actually more an exception, that it was really small. Large CIP deviations are more the norm. And it is a question in terms of your story, how much you contribute to this. So taking your micro findings back to the aggregate would help us to understand how much of these large deviations we're explaining. Because do you explain everything with this? If you look at large patterns for CIP deviations, here the US dollar, this is work done by my colleagues in money capital markets. If you look at CIP deviations relative to US dollars, you see that largely they correlate with crises and macroeconomic uncertainty. They're not solely driven by the demand for swaps, but demand for swaps can certainly be an amplifier. And I think this is how the paper should be pitched. It's basically how it works is that we have an adverse macro financial operational shock, which changes the FX flows, financial flows, trade flows, remittance flows, and then it's amplified by some factors, for example, currency mismatch, dealer concentration, NBFI, and also these dealer balance sheet constraints. And it would just be interesting to see how much this contributes to the aggregate. So where does this leave us? What are the risks now for going ahead for policymakers? What should we think about? I think what the risks are is that these FX markets, which are growing, by the way, in size a lot, create overall tighter financial conditions, and what you're showing is this can spill over to other assets. What the paper is very silent on is what we could do about it. So we just heard that this would have been your chance to make policy conclusions to a large audience. So I'm going to do it for you. I think the most important to take away is that swap lines are very important. Okay, they're unilaterally supplied, mainly supplied by one entity, which I would say at the least I can say that the predictability is becoming less accurate. And the ECB has a standing swap line with the Fed, but many rely on these crisis-induced swap lines that they use. I mean, just in COVID, several countries like Korea, Australia, all of these had at least 60 billion of swap lines. I think the ECB had something like 140 on its standing swap line. So this is very important to secure this, because stress in these markets is getting more and more important for macroeconomic. Another thing is reduce FX mismatches in the first place. If you hold the same duration on your asset and liability side in US dollar, that's another one. Ensure adequate capital, but also reduce dealer concentration. Because if you're reliant on a specific set of suppliers of your short-term funding, of course you're more exposed. So I'm gonna close with my last comment, so what I said until now, I think that's how you can make your work more appealing to the policy and the markets audience, but you probably want to sell this to a journal because it's very nicely done. And for this, I think you need to really flesh out the contribution. I do agree with you. It's the first paper that together studies this wholesale and demand channel. However, it's important to clarify what the answer to which questions have we really learned is new. Because we start with Borio et al. That already says that the sign for CIP deviations reflects the demand in swaps. Then we have Wenchins and al. JF paper that says that demand for hedging determines CIP deviations. Leo et al. Focus on EMs. They also look for the demand for swaps by foreign investors that then drive CIP in emerging markets. Then this panel's Tony paper also looks at hedging channel for exchange rate determination. And you just need to be really clear in what additional question you answer in respect to their work. And most importantly, probably there's Anderson et al. That uses the exact same instrument that you use on the money market reform. And what's particularly interesting of your paper in relation to theirs is also that they show a bit of a different channel, right? They say that the money market reform hits and that kind of reduces the arbitrage capital. And then also subsequently the supply should go down, where in your story, actually the demand from the bank side goes up. So it would be very important to show how you reconcile this supply and demand story with their work. But to conclude, this is a great paper, well written, well identified arguments that will certainly enhance our profession's understanding of covered interest rate parity. I know Uma, I think he's also going on the job market, and if you won't hire him, we certainly will. So maybe I shouldn't have advertised this.
So now let me open the floor for questions. Let me see if there's any. Yes, please.
Thank you very much. So I'm Ileana Pietraru, and I work for a non-US bank in Europe. It's not Deutsche Bank, it's a French bank. Thank you very much for your presentation. I have to say, I don't recognize always some patterns that I see in our bank or in, among my peers, meaning that since the great crisis in 2008, we learned many things. First of all, was not to rely on FX swaps and or cross-currency swaps to be funding assets that are, in different currencies. And I'm pretty sure that supervisory teams are also very keen to look at that in a bank's balance sheet. So I would say that banks don't really use them for funding reasons. We have to keep in mind that the funding in a bank and the market making are quite separate. So maybe there are also some clients that are on the other side and who actually can be taken for bank demand. Also, I would think that when you look at the page 5, you had this chart on the basis since 2008, and you see that in that time it was really a huge shock. And my question is, do you think that this, and since then, the shocks were smaller? Do you think it has to do with the positioning of the transformation of the liquidity? Do you think that banks now are less short than before, and this is why the basis, when it widens less than in 2008? Because the difference between 2008 and now is that banks are far more liquid. So my question is, did you look at the maturity transformation in your data and your paper?
Yeah, absolutely. So thanks for the questions and thanks for the great discussion, Katrina. So for sure, you're right that these same banks could be doing market making as well, and they could be supplying some of those dollars to their end clients. And that is actually true, and we do see that a little bit in the data. So here, for example, is the both borrowing and lending side of the swap market from the perspective of banks. And if you see on the lower part that's below zero, they're actually lending dollars in the longer tenor of the swap curve. And that's the maturity transformation as well. So you're completely right that banks use these swaps maybe not only for internal funding, they could also be supplying it down the line to their end clients. And we see that in the data. But even if you take that, if you take account of that, it still seems like there's a large amount of dollars that banks still keep. Now, whether they use it for making, let's say, trade credit or they use it for other purposes is a bit hard to see in the data since we don't observe the full balance sheet of banks. But I think your point is quite right. And if I understood your second question correctly, also on the basis widening more after the financial crisis, it's not just that the demand has gone up. We know that the supply side constraints have also picked up, especially from the perspective of swap arbitrageurs. And you need an interaction of both for the price effect to actually hold. So I think both of these factors are relevant. But my story is more on the demand side from the perspective of global banks, which I think is less well understood. Thank you.
Yes, we have one here and then one there, please. Okay.
Thank you for the presentation. I'm the group treasurer for BNP Paribas, so another French bank. And so before you go sell your paper, I would strongly advise that you come for a discussion at one of the breaks. Because indeed, we do not finance dollar assets, neither with FX swap nor with repo. And you have to make a clear distinction between unsecured world, which is essentially the banking book, and the secured activity where you have the dealing activity and the market making. And when we talk about repo, it's true that in the matchbook you have maturity transformation. When we talk about FX swap, it is not. And most of the time, it is even the other way around. We can lend shorter than we actually borrow. And when I say we, it's because within the banking group, the dealer is part of the bank. So regarding the causality, which you mentioned, my answer, and I have the visibility on absolutely every corner of the balance sheet of the full group, I can tell you the answer is a strong no, absolutely not. Yeah, so happy to discuss further after.
For sure, let's talk more.
Over there, please.
Hi, I'm Gene Frieda from the London School of Economics in Blue Crest, and I'm not French. Not yet. Firstly, thank you for the paper. It was, you know, in financial markets, we talk a lot about the left tail of the dollar smile. And we have this kind of, you know, conceptual framework of dollar demand in periods when there is financial stress and dollar demand in periods of exceptional US growth. And I feel like it was the best exposition and quantification of that left tail that I've seen, so congratulations. The question I kind of had was, you know, you link the provision of synthetic dollars to wholesale funding of the banks, but it kind of hits a point where the curve, you know, the supply curve flattens as a function of the marginal cost being equal to the marginal return. And I guess I think about it a little bit differently. You know, that left tail concept is basically telling you there comes a point where the provision of synthetic dollars becomes part of the propagation mechanism itself. You actually the supply starts going down as a function of uncertainty over the value of that marginal return. And it sort of made me wonder, and this gets at some level to the questions that the discussant raised, as to, you know, how one would distinguish between that cutoff point where the Fed comes in to provide dollar liquidity, and whether you could actually distinguish between, because I don't think empirically you can thus far, distinguish between episodes where the Fed is providing liquidity liberally and the Fed is providing dollar liquidity to foreign counterparties, and particularly other countries, liberally.
You're right. So in the data, we don't have that much granularity. We do see the swap lines data that does come from the New York Fed. And they've become kind of standing facilities after the COVID crisis. So there is still drawdown that happens, but of course of much smaller magnitude. And in terms of Fed liquidity to foreign banks, I'm not aware of any granular data that would allow me to do that kind of exercise, but I can look a little bit more. What I do see is the foreign banking organizations in the US, so basically branches of foreign banks, they do report some of this at a quarterly frequency, the amount of dollars they draw down, for example, from the Fed reserves. And that tends to be a relatively small number relative to kind of markets that we're looking at here. But I can look a little bit more into what kind of granular data might be available for looking at the link between Fed supplying dollars to these non-US banks. Thank you.
We have time for a final question. Pat Maguire over there, and then if we have time, we can, yeah.
Thank you. Pat Maguire from the BIS, and I'm sort of reacting to the paper as well as I think the comments from our French bank colleagues on the other side of the room. So I think this CLS data set has become quite popular. BIS has just bought this. But I think there's something really important to keep in mind with this data set, and that is you're capturing basically the interdealer market. You know, our other BIS statistics are putting outstanding FX swaps at about 120 trillion. The dollars on one side of virtually all of those. CLS has like 23 trillion, 2 trillion of which is with non-banks. So some of the work we've done with the data set shows that, you know, the same top 30 banks in the world are market makers in these markets, and they're offsetting clients who are buying, you know, borrowing and lending dollars. They have to match. So small changes in the hedging ratios of a pension fund in Asia generates, you know, trillions of dollars of flows in swaps that the dealer banks then offset in the interdealer market to balance their off-balance sheet books. The story we told during the crisis was that there were big on-balance sheet mismatches on the commercial banks. Too few dollar liabilities, too many dollar assets, and they funded those and hedged those with swaps. That is almost no longer the case for many banking systems. French banks are dollar providers. UK banks are dollar providers because of their on-balance sheet assets. So some of the graphs you showed in there of short-term dollar borrowing in the CLS data is, in my view, would be reflecting more client flows coming in from the 80 trillion in non-bank swap activity that you can't see that gets offset in the dealer market. So just a comment.
Thank you. So there is two cuts of the data that CLS provides. There is one cut, which is the interdealer segment, like you rightly said, and some of that is sort of a derivative flow coming from the client's end. And there is a cut, which is between these select set of banks and other smaller banks, so non-dealer banks. And the graphs that I'm showing you is from this large global banks facing these non-dealer banks. I'm also accounting for the client flows to the extent we see it, but you're right that CLS data doesn't capture a large share of it. So that's definitely a source of bias in the data for sure.
Fortunately, we have, but very quick comment or question, please.
So when we created the swaps with the Fed, we never thought that they would become a highly political issue. Now they have become a very highly political issue because of the attitude of the Trump administration. And the attitude of the Trump administration is creating uncertainty about the availability of these swap lines. My question is whether you see any evidence of this uncertainty in the market for swap on the dollars. I mean, the difficulty in foreseeing whether this would be available or not, is it already having an influence on prices?
So unfortunately, my data sample ends in 2023. If I get a more updated data, maybe I can answer that question better. But CIP deviations, they seem to still be there. And I think we can take a look at whether these recent price moves may have something to do with that uncertainty. I haven't done it, but that's definitely an interesting thing to look at further.
On my side, CIP deviations haven't moved as much given this uncertainty that you mentioned. So I would say that at this point, not, at least from my perspective and coming from Mexico, I haven't seen that widening of CIP, and I think it's the case mostly all over the world, but it's certainly something to take consideration and to look at. Thank you. So let's now move to the second paper. Let me introduce Ingomar Kron. He will present demand-driven risk premium in foreign exchange bond markets. Ingomar is a visiting economist at the BIS and also has previous experience as a senior researcher at the Bank of Canada. Tony Sang will discuss the paper. Tony is a visiting associate professor of finance at Arizona State University. I must say also that I found the paper absorbing and provocative, more so as coming from an emerging market. You can imagine that we have experienced spillovers coming from advanced economies firsthand, and it's becoming more frequent, so certainly it's something to bear in mind. In that spirit, I think the paper very nicely elaborates on the phenomenon of demand-driven risk premia, not so much from the asset pricing classical perspective, CAPM or APT, but rather from a quantity-based asset pricing view. The paper shows how a positive shock in the demand of US Treasuries has an impact of both exchange rate markets and also fixed income markets, mostly by showing a mild depreciation of the US dollar and also a positive effect on advanced economies, fixed income markets. I think one of the very nice things is also that the study shows how the impact depends on the correlation of short-term assets across countries and that of the US. And the paper left me with an unanswered question and an open question, and I will just mention it, is how would the results change under our extreme condition? Somehow my intuition says that there might be a different outcome, that there might be non-linearities or even state dependency, in the sense that when there is a very strong demand for US Treasury securities, maybe what will happen is that the dollar will appreciate and that you will have an increase in interest rates. That's certainly what will happen in an emerging market economy, but you are their expert, and we are eager to hear from you. So please, the floor is yours, and you have 25 minutes.
Excellent. Well, thanks so much for the kind introduction, Gerardo, and obviously to the organizers for including our paper into this wonderful program. This is joint work with Andreas Utermann, Rishi Vala, and Jun Yang, who are all at the Bank of Canada. I'm visiting the BS at the moment, so the disclaimer is a little bit longer than usual. The views are ours, not those of the Bank of Canada's Governing Council, nor those of the Bank for International Settlements. As Gerardo said, I'm going to talk about demand-driven risk premia and foreign exchange and bond markets. And motivating this paper is very simple, and it's particularly after such a nice keynote. So we should care about treasury markets, right? We know that the US outstanding debt, let's use that as a rough measure of supply, has grown substantially over the recent years. Here on this plot, I show you the time series dynamics from the early 90s, and we see that debt has grown from about 3.5 trillion to more than 35 trillion the last year, right? The rough measure of supply, we can obviously look at the flip side of the coin and look at demand by looking at the bid to coverage ratio. So basically the amount that it's bid for at each auction relative to what is supplied. And what you clearly see in the picture here on the right is that moving average, this black line, is clearly above 1. It's actually at around 2.5 on average over the entire sample period, meaning that investors demanded more than 1.5 times that what's actually supplied at these auctions at each and every point in time. So the question we want to ask in this paper is what happens if demand for these US safe assets is shifting? And since they're anchoring investor portfolios around the world, we are particularly interested in how do shocks transmit internationally via the foreign exchange and global bond markets. And we are trying to take into account explicitly which of these shifts are coming from the demand side. And I'm going to tell you how we identify that. In the paper, we basically have a little theoretical framework that builds of these preferred habitat models. Which basically have constrained intermediaries at the core of their models. I'm only sketching the mechanism in today's presentation, but we have a little toy model in the paper. What I want to spend more time on is basically talking about the identification strategy. And I want to explain to you how we use high-frequency data around treasury auctions to make the point how to extract demand shocks that then eventually spills over into international financial markets. And then I want to show you a couple of pictures with our empirical findings. And I'm going to argue that an increase in treasury demand leads to a foreign currency appreciation. To put it differently, the dollar depreciates. And we see that foreign bond prices go up. That is a common phenomenon in the G10 currencies that we look at. But we're going to argue that the transmission mechanism across these market segments depends heavily on how close the foreign country's monetary policy is co-moving with that of the US. And we're going to measure that by the degree of short rate correlation between the two countries. More broadly, we're going to argue that in the paper we provide an empirical framework that actually helps us to causally identify how demand shocks transmit internationally. And it basically gives us a direct validation of these quantity-driven theories of international risk premia in a combined setting. Okay? A very light slide on the literature. So obviously there has been quite a bit of interest recently in the asset pricing space on demand-driven theories, not only in the international finance literature, but more broadly. Our paper is mostly related to Gorinchas and Greenwood et al.'s paper, and the empirical strategy is similar to what Ray and Gorodnichenko have been doing. You see there's quite a bit of literature on the US dollar and its safe haven properties, and if you look at the years of these papers, you see it's a very active research agenda, and we're contributing to that, obviously. But more broadly speaking, our paper is also contributing to the discussion on the international transmission channels, not only from a monetary policy perspective, but more broadly about the role of US fiscal policy. Okay, let's sketch the mechanism that we have in mind in one slide, very, very simplified. The toy model we have in the paper is basically based on Gorinchas and Greenwood et al. Papers, where we have two players in the market. We have preferred habitat investors. So again, as we heard of earlier, think of your pension fund or your mutual bond fund who has very strong preferences to invest in instruments with specific maturities. And the second type of investors are global arbitrageurs, which absorb shocks in international markets, but obviously have limited risk-bearing capacity. So they cannot absorb these shocks they can only absorb them to a certain degree. The point of the model is that these demand shifts then transmit across asset classes via changes in risk premium, and not immediate by changes in quantities. So what's sort of like the timeline that we have in mind? We're going to have a demand shock, and I'm going to tell you how we're going to estimate that. We have a demand shock which is exogenous for US Treasuries. As a result, arbitrageurs' risk constraints are going to be relaxed. Why is that? Because their interest rate exposure goes down, their risk limits are less binding, the US term premium goes down, and the Treasury prices go up. That's happening in response to the shock in the US, but we see more globally that then these shocks are transmitting to global bond prices, in particular to those that are highly correlated with the US market. So for countries where the short rate correlation is high, we see that the drop in term premium is particularly high as well, and bond prices go up. Since exchange rates are bound by UIP, this shock transmission is not only visible in the bond space, but we're also going to see it in the exchange rate. And we see that across, again, the G10 currencies, foreign currencies appreciate against the US dollar. So this model only has one risk factor, so it's basically duration risk that moves in response to this Treasury auction shocks, but it gives us some very nice predictions that we can take to the data. On the one hand, we have a prediction about the foreign exchange market response. Again, we see foreign currencies are going up. We have a prediction about how bond markets should respond. Again, we see bond prices are going up. And we have this cross-sectional prediction that the response depends on short rate correlation. In the paper itself, we're also going to talk a little bit about the state dependence, and I'll show you a couple of pictures of that, but probably I won't have too much time to talk about it. All right, so let's talk about how we identify these demand shocks. We're going to look at US Treasuries, and I'm going to try to promote a little bit why I think these are nice experiments to use them. First of all, if you think of the US trading day, which is supposed to be this timeline here, it's important to notice that the majority of these auctions actually take place at 1 o'clock Eastern time, so at 1 o'clock New York time. We're going to use high-frequency data from US Treasury futures 10 minutes before and 10 minutes after these US Treasury auctions to see what the impact of these auctions are on prices. So similar to a large literature on monetary policy shocks, we're going to use an event study to extract demand shocks from treasuries. What's important is that it works so nicely here because supply at these auctions are actually fixed and they're well known in advance. So in advance of these auctions, the treasury will tell you how much they're going to issue at a certain point in time. So supply is fixed. We use high-frequency identification within 20 minutes, so investors' expectations about long-run macro fundamentals should not change in these 20 minutes. So the only thing that is actually moving prices is changes in demand, which investors learn about because the Treasury is actually providing information about bid coverage ratios shortly after the auctions. So that's the first condition why these Treasury auctions are actually a nice experiment. The second one is that these auctions are actually isolated intraday events, which again are well known in advance. They do not interfere with other intraday events that we have studied extensively in the literature. So macro announcements in the US usually happen at 8:30. Some of them happen on the same day as Treasury auctions, but they generally don't drive the results. FOMC announcements happen at 2, and by construction, there are no FOMC announcements and Treasury auctions happening on the same day, so we don't have to worry about that. And there are a bunch of other events within the day that people have studied, and particularly in the FX literature, that you might think could affect our results, such as the London fix, FX option expiry, or opening and closing of equity markets. But again, as this figure is sort of suggesting, none of that is really interfering with this 20-minute window that we use to identify the shocks. So it seems like a really clean setup to use. In order to do that exercise, rely on quite a bit of high-frequency data. So we look at 20 years, So we started in 2004 and end of last year. The auction data is publicly available. We get that from treasurydirect.gov. The foreign exchange data is from ALSEC Tick History or Refinitiv. We use the G9 currencies, so apologies, we are not looking at emerging markets. We look at the Australian dollar, Canadian dollar, Swiss franc, euro, pound, Japanese yen, Norwegian krona, New Zealand dollar, and Swedish krone, which in aggregate cover about 2/3 or 3/4 of the market. We start with tick-by-tick data and then aggregate that to 5 minutes to alleviate concerns that anything that we find is sort of confounded by market microstructure noise. In the same way, we extract data on Treasury futures prices, which we get from CME. Again, we start off at the tick-by-tick level, aggregated to 5 minutes, and we have different maturities for this Treasury futures that we could use, everything from 2 years to 30 years out. Most of our analysis, in particular what I'm going to show you today, is looking at 10-year futures. In addition to this high-frequency data, we're also going to use daily data on global zero-coupon bonds, which we get from Bloomberg. And they are going to be used in order to estimate the price impact that we want to observe in the bond market. Let me spend a slide on these auctions, a few summary statistics. So first of all, again, these are frequent events. Over our 20-year sample, we have almost 1,400 auctions. If you compare that to your FOMC announcements that are commonly used in the literature over the same sample period, you have only 160 of those. So almost 10 times or 9 times as much for Treasury auctions. A lot is auctioned at each and every event. So on average, it's about 30 billion. The maturity of instruments varies, everything from 2 to 30 years. On average, it's about 10 years. And again, to kind of put numbers to the figure that I showed you in the very beginning, the bid coverage ratio is always larger at 1. So the minimum is 1.22, so even that auction is oversubscribed. But you see that the maximum figure there actually goes up to 4. So demand for auctions is always higher than what is supplied. In the paper itself, we also look a little bit about who is bidding at what point in time. The Treasury gives you a little bit of a split up, distinguishing between direct, indirect bidders, and primary dealers. In today's presentation, I'll largely abstract from the analysis. They also give you a little bit more information about how much has been actually allocated to different dealer types. Again, we do the analysis in the paper. I'm going to skip that today. How do these shocks look like? Well, first of all, it's important to notice that there are more and more Treasury auctions the further we come to the late 2020s. So this looks like equally spaced, but in fact, here at the beginning, the distance is 3 years, and then you see like from 2016 onwards, this is actually almost yearly spaced. So the number of Treasury auctions has actually increased significantly over time. You see that if we look at the split up, the largest share of bids are coming actually from primary dealers. Then you have these indirect bidders, and a small bottom part here are direct bidders. Maybe the important thing to notice there is that the share of indirect bidding has been actually going up in recent years. And then if we look at the two shocks, so one is here the dollar portfolio in the foreign exchange space, and then the dollar portfolio in the global bond space. What I mean by that is simply the unconditional average of US dollar denominated returns in both markets. You see that these shocks look exactly like we would expect shocks to look like. They can be sizable at times, but they also look pretty random, right? Which is sort of nice because we don't want any systematic pattern in one direction or the other. Now, if you believe me and take it for granted that these are actually cleanly identifying demand shocks, then we can run simple price impact regression. That's what I want to show you here. So I'm going to show you a table with currency returns on the left-hand side and our demand shock on the right-hand side. And then the second part of the table is going to have the global bond prices on the left-hand side. And then again, the same Treasury demand shocks on the right-hand side. What do we find? Well, let's focus on the dollar portfolio first. So again, this unconditional average. We see that in response to a 1 standard deviation increase in demand for US safe assets, the foreign currencies appreciate against the US dollar by about 2.3 basis points. Highly significant. If we look at the bond space, we see that foreign bonds appreciate by about 10 basis points. That's a result that's pretty consistent in the cross-section, right? So without spending too much time on the numbers for now, you see that for both markets, we see stars pretty much everywhere. And again, that speaks to the fact that we have about 1,400 of these events, which gives us a lot of statistical powers compared to alternative event studies that have been conducted in the literature. But if we actually start focusing on the cross-section, there are actually quite some interesting pattern there that we're going to explore further in the paper. So let's focus on the FX market first. We see that in response to a 1 standard deviation increase in demand for treasuries, we see a huge impact for the Japanese yen. So there we see the Japanese yen is increasing by 4 basis points, but a relatively muted response for the Canadian dollar, only slightly significant. That's in the FX space. In the bond markets, it seems like it's the opposite, right? The Canadian dollar appreciates, the Canadian bond market shows a very strong appreciation, while the response in the Japanese market, even though it's significant, is way smaller in magnitude. But in total, the table kind of confirms the first 2 hypotheses of these preferred habitat models, right? Exactly what we want to see. So again, an increase in demand leads to significant responses in both market spaces. But obviously, we can explore this cross-sectional response a little bit more. So again, the left regression we just had is now going to be shown here in the left figure, and then the right equation here is going to be on the right figure. So FX on the left, bonds on the right. And again, a positive beta tells us an appreciation or an increase in bond prices. What do we see? Well, on the x-axis, we put a short rate correlation between the foreign country and the US. So again, a measure of monetary policy integration, if you will. Let's start in the FX side. We see that the response of the Canadian dollar was very, very small. It's only about 0.5 basis points. But on the other hand, we have the Japanese yen, which ends up here around 4 basis points. On the other hand, in the bond market, we see exactly the opposite pattern. So while the Canadian dollar only responded mildly to this demand shocks, we see a very, very high impact in the bond space. But conversely, the Japanese yen responds strongly in the FX space, but only very mildly in the bond space. So we have this cross-sectional dispersion depending on how closely monetary policy is co-moving with each other, right? So the extent to which foreign exchange markets will kind of absorb these shocks depend highly on that. And that's not only limited to these 2 currencies or countries, but you actually see it very, very nicely in the cross-section of FX, but also of bond markets. And in fact, if you calculate the correlation, you see that you have a correlation coefficient of minus 0.9 in the foreign exchange space and a correlation of plus 0.9 in the bond space. So this degree of short rate correlation is highly important and sort of confirms hypothesis 3 of these preferred habitat models. Now, we run a bunch of robustness tests in the paper, playing around with the window size. We use alternative data sets where we don't have indicative quotes, but in fact, traded prices, so you don't have to be concerned about stale prices. We use alternative measures and specification of demand shocks. Seasonal effects don't play a role. We also couldn't identify periods that were particularly driving this pattern. It seems to be very strong over the entire 20 years. Another concern that you might have is that maybe there's just like a mechanical relationship between FX and treasury futures or bond prices and treasury futures at this particular point in time. So we run a bootstrap exercise to kind of make the point that auction days are special. Let me be precise. What we're going to do is we take basically all the days when no auction is happening, and we're going to construct the same type of shocks in a 20-minute window around 1 p.m. And then we're going to run placebo regressions between that placebo shock and FX returns, and then basically do that 10,000 times, and we're going to plot the distribution of these shocks over here. This is for the FX market, again, on the left, and on the right for the bond markets. And the takeaway clearly is that on auction days, you have a beta coefficient on the FX space, which is above 2 basis points, while basically on all the other days, there's nothing happening between in terms of co-movement between FX markets and treasury futures. And you kind of see the same here on the right-hand side. So there's no mechanical relationship between the two on all the other days, or on days in general, that would sort of like drive our results. Another concern you might have is that, well, this is a 20-minute window, so why should I really care about this market microstructure noise? So we're going to run some local projection exercises where we're going to regress the shock that we have basically on cumulative returns following these auctions. And what you're going to see here on the left for FX markets, as well as on the right for bond markets, you see that there's a sizable effect, obviously, on impact, as we've just shown you in the previous tables already. But then you see that this impact is sort of increasing over time, in particular in the FX space, and then slowly dying out between like 2 to 3 weeks afterwards. And again, we interpret this finding sort of in line with these models that in the first place, risk premia are going to adjust because it takes time for flows to move. And then over time, flows are going to adjust and risk premia are sort of like moving back to their initial state. Now, let me talk a little bit about the state dependence and the differences how treasuries are perceived over time. So what we're going to do is we're going to kind of replicate this recent high-frequency measure of the stock-bond correlation by basically using high-frequency data on equity futures at the 5-minute frequency and 10-year treasury futures, again at the 5-minute frequency, and then can kind of like calculate this correlation at the daily level. Because we're going to have 288 observations each and every day, that gives us enough observation on each and every day to calculate that co-movement, and then we kind of can distinguish between days where treasuries are considered risky and days where treasuries are considered as like safe assets. So days where they co-move in the same direction or where they move in the opposite direction. And we would kind of expect that, you know, the extent to which our demand effect has an impact varies across these days because, again, treasuries are going to be perceived differently on these types of days. So that's exactly what we're going to do, right? We're going to take our main regression that we had before, but now kind of add an additional interaction term here where we interact our demand measure with this high-frequency stock-bond correlation measure that we extract from high-frequency data. And again, you kind of see that the impact is sort of stronger on these days whenever the correlation between the two is positive and is less strong whenever it's negative. So in the paper, we run a bunch of other additional tests, which I'm going to skip today. So instead of using at high frequency price measures, we actually run the same regressions with quantity measures, so using this bit coverage ratio, and they generally confirm the robustness of our results. We look at these splits that the Treasury is providing publicly as part of their data provision, and that kind of helps us to highlight what kind of bidders or what kind of market participants are particularly strongly driving our results, and it turns out it's in particular these indirect bidders. If we use the information on allocated assets or allocated treasuries that's also provided, we see that the investment funds are relatively more important than all the other market participants. The problem with that data is we cannot really distinguish where these investment funds are located, whether they are foreign or local. And then we do another exercise in the paper where we basically link our results to a convenience yield channel, and we use sign restriction to kind of distinguish between different types of demand shocks, right? So what we're going to do in the paper is we basically have a demand shock that is driven by convenience yield, and we have a demand shock which is driven by this portfolio rebalancing, this preferred habitat kind of approach that we are pushing for. And we kind of see a strong time variation in the importance of these two measures. And the analysis basically suggests that in particular in the more recent times, so post-financial crisis, these preferred habitat demand shocks play a significantly more important role than these convenience yield shock that were particularly important during the global financial crisis and during the early part of our sample. I have a minute left, but let me conclude. So if there's one picture I would like you to take away is this beautiful cross-sectional figure here, again, where you kind of see how the price impact varies in FX and bond markets depending on the degree of short rate correlation. Again, in the FX space, you see a negative correlation. In the bond space, you see a strong positive correlation conditional on the short rate correlation. Thank you so much.
We will have Tony discussing the paper for 15 minutes.
Cool.
Tony?
Thank you. First off, thanks to the organizers for having me here and letting me read and discuss this very interesting paper. In short, I thought this was pretty great. The paper is quite innovative and also quite mature. So I'll have a few things to say, but first off, great job. Broadly speaking, what are we doing with this paper? Ideally, we want to, in economics, you just want to explain the dynamics of exchange rates and bond yields. That's a big picture here. And there's a couple of different ways of looking at it. There's a really important economic question here. Fundamentally, there's a tie between yields across countries and exchange rates. Everyone has learned about uncovered interest rate parities. It connects these two things together. There's a fundamental relationship in international finance. Additionally, there's a very important policy question. We're looking at demand shocks to treasuries. Well, we've talked many times today about asset purchases or quantitative easing. These tools have now become a pretty important part of central banking toolkits, and we want to know when we buy up treasuries, when we buy up other securities, what is going to be the market impact and how will this transmit both domestically as well as abroad? Now, there's a lot of different ways of thinking about this. Perhaps a more canonical, dynamic general, stochastic general equilibrium models. These DSG models, they don't do necessarily a great job of capturing the dynamic effects of, bond purchases or these asset purchase programs. And so perhaps a more fruitful way forward is to think about different types of models. And here we're thinking about preferred habitat models that rely on constrained financial intermediaries and also investors that prefer specific types of bonds or other securities. And so in this paper, Ingomar provides some really nice evidence for this preferred habitat framework and to really push this agenda forward and think about using these models to evaluate policy as well as the dynamics in exchange rate and bond markets. If I could summarize this in this paper in 2 pictures, here's the first result. Positive demand shock leads to declining long-term yields and foreign exchange appreciation. This is the last picture that Ingomar left everyone with. The really nice, interesting thing here is, of course, that you see that the magnitude of the effect of these demand shocks on foreign currencies is pretty well explained by the cross-section of the short rate correlations. All right, so the Canadian dollar, where you see here, highly correlated with the US, has a relatively small impact in the FX market. Japan, which has relatively low correlation, suffers a pretty large effect. The second result that Ingomar did not have much time to talk about at the end, but I found very interesting is that the strength of the impact of the demand shock varies quite a bit depending on which days you're looking at. So Ingomar talked a little bit about thinking about risky days versus non-risky safe days. And basically the idea is that on days that are considered risky, the price impact of the demand shocks gets to be a little bit larger. All right. And so, in general, this paper does provide pretty nice support for this preferred habitat mode of thinking about bond markets and exchange rate markets. The empirical results align pretty well with the theory, in particular with the toy model that Ingomar has in the paper. And the currency betas, the correlations between the short rates are very good at explaining cross-sectional variation in the effects. Moreover, Ingomar is using this new source of shocks, these demand shocks, to try to investigate currency returns and yields. And as macroeconomists, it's always hard to find independent sources of variation when everything's happening at once. And so I always appreciate a paper that tries to study a new source of exogenous variation to see what we can learn from there. This is, as I said, a very mature paper. So, I'm like the third discussant and then a bunch of thank yous as well. So I think it's more useful here if I try to provide 3 relatively high-level comments. I'm going to talk about the magnitudes. Do they make sense? I'm going to talk about another theory that we have about the connection between exchange rates and bond markets, which is like, how do we think about flight to safety in this framework and in the results? And then finally, I want to talk about time series variation in the strength of the mechanism. There we go. Okay, one of the first things I noticed when reading this paper is that the effects, unfortunately, seem a little bit on the smaller side. Why do I say that? A 1 standard deviation increase in treasury demand causes the US dollar to depreciate by about 2 basis points, and foreign bond prices to increase about 10 basis points. And so if you're thinking about a 10-year maturity, this is like a yield effect of like a couple of basis points. And so when I started looking at the regression table, I was like, all right, so why are these effects so small? And it turns out, well, the main reason is because the shocks are so small. All right, we're measuring shocks, these demand shocks, in 20-minute intervals around these treasury auctions. And for the most part, the majority of what's known about these treasury auctions are already known well in advance of the auctions actually happening. It's like pretty well known that the common way that policy is made is that we don't, for the most part, up until modern days, we don't want to surprise financial markets too much. We don't want to cause too much financial market turmoil. And so there's a key assumption that needs to be made here in order to take these results to the next level, which is that you have to believe that these effects that you're measuring in these 20-minute intervals can kind of be projected linearly forward for larger shocks. That's what makes this study useful. We're measuring something pretty precisely in these 20-minute intervals, and then we're going to try and draw conclusions about larger asset purchase programs or quantitative easing that may potentially, that definitely do generate much larger demand shocks. In general, I think it would make the paper a lot stronger in this sense to just do that calculation for us. Instead of telling us, about what the effects are for these one standard deviation shocks, just tell us, what does this imply for quantitative easing? What does it imply for asset purchase programs? Is this weird? I don't necessarily think so. I mean, it's the same problem that we have with monetary policy shocks that we use all the time in academia, where we measure these monetary policy shocks, these changes in interest rate futures around monetary policy actions. They come out to be a couple of basis points each time, and then we have no problem expanding those shocks linearly, so just do the same here. All right, scale it up. There's another, we mentioned this Greenwood paper a couple of times here. Jeremy's in the audience, so I should mention that as well. But the point is that there have been a number of papers in the past that have also summarized the relationship between yields and exchange rates. And it's good to connect back to these other papers and just tell us, do the results that you find make sense? All right, having a brief look again at this Greenwood, Hansen, Stein, Suderam paper. Table 1 here summarizes the relationship between yields and exchange rates. Generally, it does make sense that your results do align pretty well, and it would be good to connect back to this kind of stuff. Okay, that's my first comment. The second comment I want to talk about is thinking about flight to safety. So flight to safety is not really in this paper. However, we know that the flight to safety phenomenon does occur, and there's like dozens of ways of showing this. Here's one way of showing it. So if you're focused here right now on the left-hand panel, I'm going to do this at low frequencies. So on the y-axis, I have quarterly changes in the broad dollar index, so US dollar against G10 currencies. On the x-axis, I have a measure of global risk where this measure of global risk is basically looking at the call transcripts of large public corporations and seeing how often they talk about being risky or is it a risky time. And so if you focus on the blue and red dots together, that's like the quarterly data up until this year, you see that there tends to be a general positive correlation. If you focus on the red dots in particular, these are the quarters that correspond with crisis periods, global financial crisis, COVID pandemic. You can see a much stronger positive correlation. In other words, what it's saying here is that over time, during quarters in which risk increases, you're going to see dollar appreciate. Okay. On the right-hand panel, what we're showing is that currencies that tend to appreciate during crisis periods that have high betas with this global risk measure, these currencies tend to pay low excess returns over time. Okay. So taking these two pictures together, all this is saying is that this, the standard risk-based narrative about the relationship between bond yields and currencies, it still does a very good job of explaining cross-section of exchange rates and bond returns over lower frequencies. So the question is, why is it that we haven't seen any of that in the results that Ingomar is showing? And fundamentally, what I want to say about this is that in this paper, there's the way that the demand shocks are constructed. By construction, there is no flight to safety phenomenon. Okay, this is a paper that's about these high frequency demand shocks. Flight to safety does not exist. Why? In these high frequency demand shocks, the only things that get captured are what information is released in these 20-minute intervals. So if you're thinking about COVID, all right, so like on Monday, on like some random Monday, we find out like, you know, there's a certain number of deaths in one country or another, or on another random Tuesday, you find out that, oh, we have, maybe we have like developed a vaccine and like things are not as bad as they were originally. These kinds of developments are not gonna be in there. They're not being captured in these 20 minutes. During the global financial crisis, you find out that one bank is in trouble, you know, gets announced on some random Friday afternoon. Those effects are not going to be in there, okay? Those effects will already have been priced in before the demand shocks get estimated. The only things that that really matter for these effects are what's in these 20-minute demand shocks. All right, I think the discussion in this paper like should kind of make that point really clear, in the sense that like this is a really highly focused study about demand and basically demand alone. Good. And then so because we think about that, this relates now to my third comment, which is that these effects are really about these demand shocks alone. What is being captured in these demand shocks? You know. So the thing that I found interesting here is that when you think about demand and how demand shocks propagate to the rest of the world through this preferred habitat framework, you're really relying on some narrative about constrained financial intermediaries and their demand for bonds and currencies. Well, we know that intermediary constraints vary quite a bit over time. They vary both in terms of, you know, at higher business cycle frequencies, but also they can vary over time because we just placed new regulations on the intermediary sector. Over the course of Ingomar sample, for example, you had the implementation of Basel III and the like. And so there are many reasons why you see intermediary constraints change. And so I think, you know, when Ingomar has these results that talk about variation in the impact of demand shocks, I suspect what's actually being captured here is that you're capturing what's happening on different days of intermediary constraints. And what's being identified as risky days, those are potentially days in which intermediary constraints are more binding somehow. And as a result, then you see larger price impact from changes in demand. Whereas on safety days, those are perhaps more normal days in which you have perhaps smaller in price impact. So I would kind of try to look into that and see if maybe there's some potential for that story as well. All right. So that's basically all I wanted to say. I think, again, this is a very well-written paper with clear analysis. I like that it introduced a new instrument in the study of these spillovers between FX and bond markets. Not much about flight to safety, but I think there is a lot to explore here. It's a great starting point for even more analysis. For example, thinking about how effects vary over time, and then trying to like blow up the results to talks directly about QE and other asset purchase programs. Thank you.
So let me now open the floor for questions.
Thanks. Yeah, good work, man.
See if there are any. If not, I will start by echoing some of Tony's comments. I think the paper is very nicely written and very nicely done. Somehow I think that the statistical significance of the exercise is great. When you look at your regressions and when you look at the correlations, I think it looks awesome. And then I would compare that with the economic significance of what Tony raised. Like 2 basis points seems like a fairly small effect. But let me now turn to a specific question. And this is because you are using US Treasury auctions as the primary driver of how spillovers are connected in FX and bond markets. But as you know, US Treasury auctions are taking place more frequently and will be larger in size because of what's happening with the fiscal deficit in the US. You also have, on another aspect, some concerns about the dollar being the safety asset going forward or not. So my question for you is more like a forward-looking question and your intuition on whether you think that US Treasury auctions will remain as an important driver for FX and bond markets going forward, as your analysis suggests that it is today. So I will start with that question.
All right. Well, thanks for the question. So let me respond to the first part. Maybe we can scale that up. Actually, we started playing around with that. So I would still say that 2 basis points is not that small, considering that on a daily basis we can't forecast exchange rates is pretty much zero, and having a persistent impact in one direction within 20 minutes, that's quite strong over up to 15 days, is still not tiny. But the point is well taken, obviously. Will that impact persist moving forward? It's obviously hard to predict. Let me say, when we started with that project, we ended in 2022, and we were quite concerned updating the data, and were concerned that the effects were diminishing. And so far, we haven't seen any evidence of that. Also, in terms of demand for treasuries, leaving out a few auctions that happened in 2025, where demand was relatively weak comparatively. Demand for these assets afterwards were pretty impaired. So far there has been not a sign that that will change. But
okay, thank you. Let me see if there are any questions. If not, I had a few, so I will take the privilege of the chair. So, what indirect bidder demand coming from reserve managers? So, how important do you think is this demand coming from a reserve management? And do the effects and yield spillovers differ between periods of reserve management accumulation vis-a-vis reserve management deaccumulation?
Yeah, that's a nice question. So we haven't looked at that, so I can't give a very precise answer. Let's put it this way. I think the general problem with this indirect bidder classification is that it's very hard to pin down to what extent that is coming from a specific group. So I can't really say whether it's reserve managers, whether it's like foreign institutions, foreign official institutions, or foreign private investors. There has been some work by Michael Fleming, who was kind of like trying to link this indirect bidder group with the amount that was allocated to different investor types. And his analysis suggests that it's primarily foreign official institutions and foreign private institutions that seems to be driving indirect bidder demand. But having said that, we also know that post 2009, 2010, the general demand of foreign investors in US Treasury has been declining. So yeah, it's hard to pin it down exactly. And again, there's some time variation there to what extent this bidder category is picking up demand from specific groups.
Okay, thank you. Let me see. Yes, please, Jean.
Sorry, just to try to alleviate some of your burden, Gerardo. This is kind of a speculative question, but given that you looked at this over different subsamples, I thought you said it implicitly, and Tony, I think said it explicitly, this notion that currencies that tend to appreciate in periods of stress typically don't offer particularly high yields. Now, obviously, that can change over time, and it can particularly change in an environment where fiscal positions of countries are changing quite significantly. I'm just wondering, if you noticed that in any of the subsamples you looked at, or if you'd want to take a step further and speculate a little bit. I mean, one currency, if I have to call one out, that I think is interesting is the yen in that respect, where you're obviously seeing it's kind of a chicken and egg question. Are the higher yields a function of the fact that it no longer appreciates in periods of risk aversion, or the opposite? Thank you.
So we haven't looked at individual currencies, I believe, specifically over these periods, but I would probably speculate to say that we know that, for example, the carry trade was particularly weak post-financial crisis. So there we know that the excess returns, in particular on currencies such as the yen, were pretty low compared to the early part of our sample. And that probably has been picking up a little bit over the last couple of years, where the carry trade has become a little bit more profitable compared to the first few years after the global financial crisis. But something to look into a bit more.
Are there any other questions? I don't think so. So I think that we can now call to an end of this discussion. It has been a very good discussion. Thank you to you both. Congratulations on your work. You are very young, talented persons that have raised very important issues. So thank you so much. And let me please conclude with a round of applause. And before we leave, I have a couple of announcements to make. First, what I would like to do is to say goodbye and to thank the people that were connected by the live streaming service of the ECB. Thank you so much. We hope that you can join us tomorrow, obviously. And also some housekeeping issues for the people that are here today in terms of your badges that you have with you. You have to return the badges by the entrance outside or also on the counter downstairs. Tomorrow you will be given a new badge, and obviously you know that tomorrow the event starts at 9, so you may want to arrive early, more or less 8:30, so that you can get clearance on security, you can get your badge, and you can be here on time. We will start with John Williams' keynote speech, the CEO from the Federal Reserve Bank of New York. And finally, as you know, there's also a reception that will be, I think, will take place over here. So please, you are welcome to join us. So with that being said, thank you very much, and we will be having this great conference tomorrow as well. Thank you.